again, what, 4 or 5 years ago when they launched those new chips from the Mac and showed they can do it without Intel, not just do it without Intel, do it better than Intel could ever do a chip in the MacBook. And on the Windows side of things, they're still trying to catch up to what Apple has been able to pull off. And by the way, he also set Apple up for Apple Intelligence. Before we even started talking about ChatGPT, it was Srouji's chips that kind of built that foundation, so your MacBook and your iPhone and all those things were ready to run those AI applications before Apple even started talking about it. So he was ahead of the curve in so many ways on the hardware AI front that his peers just haven't been. So again, this would be a huge loss for Apple if they can't keep him there.
All right, Steve, go back. Thank you very much. Great to see you as always. All right, coming up here at Worldwide Exchange, Congress pulling back the curtain on that massive defense bill and the new actions to crack down on American money flowing into China. We got the details coming up next. But first, new details on last week's most popular stocks among Moon's retail investors both in Asia and in the U.S. Let's start with Asia. The most traded stocks were Tesla, Nvidia, Micron, and SanDisk, which was up almost 9% last week. Then in the U.S., Tesla, Schwab's big cap ETF, SCHX, Nvidia, and TZA. The triple leverage bearish ETF doing the opposite of the Russell 2000. 3 times the Russell 2000 was up 2%, so the TZA that fell 6%. We're back right after this.
Michael J.
Worldwide Exchange. Turning to Washington and the Supreme Court taking up a case testing the limits of the president's powers. The court will hear arguments today over President Trump's push to fire Rebecca Slaughter, the last remaining Democratic commissioner on the Federal Trade Commission. Slaughter's dismissal is seen as a direct challenge to a landmark 1935 Supreme Court ruling upholding Congress's authority to protect the heads or board members of independent agencies from presidential controls. This case could also offer insights on which way the court may side when it hears arguments next month on President Trump's bid to fire Fed Governor Lisa Cook. We're going to stick with Washington. Congress officially unveiling details of a massive defense bill with wide-reaching implications. That includes targeting investments into China. Emily Wilkins joins us now with much more on this story. Emily, good morning.
Good morning, Frank. Well, yeah, the new restrictions on investing in Chinese companies, they're all but certain to pass Congress in the next few weeks as part of a must-pass $900 billion defense package. So that measure within the package, it would limit U.S. investment in Chinese companies in sectors like AI, semiconductors, and quantum computing, as well as sectors related to the military. Now, the Defense Department would either ban investment in certain companies or require notification if an investment was made. The inclusion of this measure, it's a win for China hawks on the Hill. They lobbied for the provision, even as it faced some opposition from members of the business community and tech sectors. Now, a congressional committee on the CCP found that VCs and asset managers had funneled several billion to Chinese companies either working on advanced technology or ones that had been blacklisted by the U.S. government. The committee's chair, John Molnar, said in a statement that for far too long, the hard-earned money of American retirees and investors has been used to build up China's military and economy. This legislation will help bring that to an end. Now, curbing investments in China was only a small piece of the 3,000-page package. Also included were limits on pharmaceutical companies that do business with the federal government. Those companies must decouple from any partnerships with Chinese companies deemed to be a national security risk. Now, that defense package, it is expected to get a vote in the House this week and a vote in the Senate soon after that, and it is expected to pass both chambers. Frank?
So, Emily, with that timeline, it seems like there must be bipartisan support. One part that was left out, and you've done some great reporting on this, is GAIN AI, basically a part of this bill that would limit chip sales to China unless all the American needs were met. You also did a great interview with Jensen Huang, who's on Capitol Hill lobbying about it. Could that potentially be a sticking point for this as it goes through the chambers of Congress?
So since the GAIN AI bill is now out of this legislation, I mean, there's a reason that they removed it, and that's because, yes, this has to be bipartisan, it has to be bicameral. You'll remember the House and the Senate both passed their own versions. They've now gotten together, and so this is the thing that leadership is confident can really get through both. That said, I did speak with Senator Jim Banks. He was one of the main supporters of the GAIN AI Act, and he told me that he is going to continue to try to find a way forward on getting some sort of restrictions to make sure that the most advanced U.S. chips aren't going to China, and he's certainly not alone. I've talked with a number of other senators, and Pete Ricketts, who I think was on the program last week, and he talked a little bit about his bill as well. So still a lot of momentum here to try to find something. It's just not happening in this bill.
Yeah, so much talk about the national security implications. Emily Wilkins, live in D.C. Emily, always good to see you. Thank you very much. All right, coming up here, Worldwide Exchange. Transports continue just to keep on trucking, riding a 10-session win streak. We're going to talk to one top analyst on what's behind that momentum and the stocks that he says are a must-buy right now. We're going to be right back after this. welcome back to Worldwide Exchange. We're watching the Dow Transports, looking to add to its 10-session win streak, longest since August of 2020, all the way back during the pandemic. The index now less than 0.5% away from 52-week highs and less than 6% away from its all-time high. We'll look at what's driving the action. Let's bring in Ken Exter, research analyst at Bank of America. Good morning. Thanks for being here.
Come on, Frank. All right, happy holidays.
So, longest win streak since August of 2020. All remember that was the pandemic. Where, toilet paper, everything was kind of flying around, and transports really took off. What situation are we seeing right now that would lead to that same kind of a streak?
So it's not the demand side. The demand side hasn't kicked in yet. When we came out of COVID, it was stuff. We all wanted stuff, more things. Right now, we're not seeing things move. We're actually seeing capacity start to come out. So we're finally seeing some of the bankruptcies kick in. The government's jumping in with rules on English language proficiency, foreign-born CDLs. So they're cracking down on a lot of drivers that don't have licenses, and you're starting to remove capacity. And then it's leading to the hope trade. The hope trade is, will they start to kick in that supply-demand imbalance and really start to drive up the pricing? And so we've seen spot pricing take a big jump, and we're seeing if that continue.
All right, I want to hit on this because we've talked about this on the show a bit. The administration's effort to crack down on what they call non-domiciled truck drivers or CDL drivers. And not only the fact that that takes some people off the road, but it makes some other people concerned that they could be, targeted for enforcement or maybe have their trucks taken or something else. So how much of an impact could this have longer term? Is this already priced in, the idea that they're cracking down? One report, they cracked down on 3,000 CDL schools that the, at least administration feels, isn't truly teaching people, more of like a licensed mill, somebody told me. They feel like they're licensed mills as opposed to actual schools providing the training. Is this all priced in, or could we see rates go even higher?
No, this is something that I think we're just starting to see the potential benefit of that if it follows through. So you're having the self-selectivity of drivers that say, I'm too scared, I don't want to get in the truck because I may go somewhere where the regulation is tougher. So that's starting to pull out some drivers. And then you mentioned the 3,000 schools. There are 4,000 more that the government has said we may look at those. So the trainers. And so you're looking at something that could start to put pressure on the supply. If it does, you're talking the ATA, the American Trucking Association, talked about 200,000 drivers being in that pool that you're talking about. Well, that's, almost 5% of drivers. You don't need a 5% driver elimination to really cause pricing. 1-2% will really throw that balance into where spot pricing really moves up.
So you're very focused on the supply side. What about the demand side? Goldman out actually with a note yesterday saying they see real income increasing for middle and upper middle income consumers by about 2.5%. We also recently saw an upgrade for Dollar General. They raised their full-year price target. That's stuff. That's all stuff being moved.
It is, but Dollar General also talked about the higher income user coming down to their stores, and so that means you're losing at other places. We're more concerned, and you talked about the kind of the outlook of what's driving it, but that's also pricing has gone up. So we need the number of goods in transportation to go up. That we're still not seeing. As you know, we do a bi-weekly truck shipper survey, and it's down at 50.0. You're talking about a very low historical level in terms of demand. If you take a look at that, we're in still this 3.5-year freight, 3.75 year freight recession. So we really need that demand side to pick up. We haven't seen a sign of that yet.
All right, with the trends that you're seeing, you got to give us your top picks. Give us at least two that people can focus on. I would imagine one would be on the trucking side, and what's another area you see benefit?
So for this kind of theme that you're talking about capacity coming out, supply coming out, we did upgrade Knight Swift, KNX. We talked about dipping our toe in, because if that continues, then we could get more bullish. But this is something we started with. Within the kind of the overall universe, also look at the railroads. CSX put in new management. We've got Union Pacific going through a merger. So look at the railroads. They're consistently taking some share from the trucks right now. So we like some of those.
On lower cost, they're taking share?
Lower cost. Well, they're definitely in terms of CSX, UP, and CP, Canadian Pacific. They are absolutely lowering their cost, and that's what. But they're actually taking some share from the trucking industry, and so they're able to outpace the volume.
Ken Exter, great to see you as always. Thank you very much. All right, we got more coming up here on Worldwide Exchange, including seeking healthy gains. The slice of the market, our next guest says, can offer investors just that in the new year. Stay with us. We'll be right back. And welcome back to Worldwide Exchange. As we close on the 6 a.m. hour, a check of a few big stories that we are following this morning. President Trump injecting fresh uncertainty into Netflix's planned $83 billion deal for Warner Brothers. The president yesterday saying the size of the new company could, quote, be a problem.
Well, that's got to go through a process, and we'll see what happens. Netflix is a great company, and they've done a phenomenal job. Ted is a fantastic man. I have a lot of respect for him, but it's a lot of market share. So we'll have to see what happens.
And the president adding he plans to be directly involved in the regulatory approval process to see if the deal goes through. President Trump also ordering the Department of Justice and the FTC to investigate the U.S. food supply chain for possible price fixing and other anti-competitive practices that are driving up the cost of meat, seeds, and fertilizer. That executive order comes as the Wall Street Journal reports that Trump's top advisors are pressing him to shift his focus to fighting high prices. We're also getting reports the president will unveil his long-awaited foreign aid package today, offering $12 billion in assistance to a key voter base, including up to $11 billion in one-time payments. Elsewhere, the Wall Street Journal is reporting that IBM is in advanced talks to acquire Confluent for around $11 billion. That would be a premium to the data infrastructure company's market cap on Friday of $8 billion. S&P Dow Jones says Carvana, CRH, and Comfort Systems USA will join the S&P 500 effective at the market open on Monday, December the 22nd. The move is part of a regularly scheduled quarterly rebalance for that index. And the information is reporting that Microsoft is in talks to shift its custom chip business from Marvell over to Broadcom. No comment to CNBC from Microsoft. All right, moving back to the broader market, stocks coming off back-to-back winning weeks as investors turn their attention to Wednesday's big Fed rate decision. Take a look at futures in the green across the board now. We saw the Dow fractionally lower earlier. All three indices solidly in the green, and so for much more, let's bring in Aaron Gibbs, Chief Equity Strategist at Slatestone Wealth. Good morning, and thank you for being here.
Good morning.
All right, so we're coming off last week, 2 weeks of gains, and a lot of it was that PCE on Friday at least that kind of kept us going.
Yep.
The fact that inflation came in just a tick lower, giving people confident about the Fed rate cut, what areas of the market does that make you bullish on?
So a lot of what I've been talking about for a while is focusing on down on the market cap spectrum. So look at those small and mids, and these are exactly the companies that are going to benefit the most for this kind of news. And they're also cheaper valuations, and we're looking at much higher growth for 2026. We're looking at about 19% profit growth for next year for small and mid caps versus 15 for the S&P 500. So cheaper for higher profit, good Fed cuts, all lining up for a good year.
A lot of people have called for a kind of a rally in small caps.
Yeah.
Some people call it a catch-up trade, though, and other people pointed out that these companies aren't quite as able to take advantage of AI as some of their larger counterparts. Is that a concern for you?
Look, absolutely they may be in some points not as able to take up an AI when you're talking about really big push-ups, but they are able to incorporate them immediately within their systems and increase that profitability. And as we know that with AI, when you're talking about just getting software in, not necessarily having to build new data centers, there's a lot of different companies where you can make incremental improvements and profitability within your company quite easily.
All right, let's get to your word of the day. It's approvals. That leads us to your pick in the biotech space. So spell out the thesis here. What are the approvals that you're looking at, and why does this lead us to your pick?
So one of the things that we've seen a lot in the headlines is the FDA had a lot of shifts, change in turnover, head counts, that type of thing, and the approval process looked like it was starting to slow down. We're starting to see some of that turnover resolve itself, particularly in 2026. And then catch up on approvals. And so those companies, those healthcare, biopharma, biotechs that really got beaten up are the ones that are there to really be poised to take over once this resolves and get into 2026. My top pick is Neurocrine. It really is positioned as one of the absolute best within the area, particularly it's both mid-cap and a biopharma. And I love it for three major reasons. One, it's focused on neurological and psychiatric, which is actually where the FDA has actually increased approvals rather than slowed down. It has Ingrezza, which means it's a cash cow. It doesn't have to go to the market for cash. It doesn't need a lot of debt. And fourth, I really like it because it has a lot of options that are already deep within the approval process. We're not talking about 3 years out, we're talking about 2026.
Okay. At the same time, even you admit it's a bit risky. When you're looking at biotech, there's a lot of risk there.
Yeah.
Why not focus on something more consumer facing? We've seen really strong spending throughout the holidays.
Yeah.
I mentioned that Goldman Sachs report that came out last night. They see real income for middle and upper middle income consumers rising. Why not look at the consumer parts of the market that seem to remain strong as opposed to the riskier parts?
Well, partially because I did that a few weeks ago when I was on with you. So I did want to pick different names. So I still stand by my picks from whatever it was 3 weeks ago. So still love Ralph Lauren, still love Signet Jewelers, absolutely love consumer discretionaries. Not saying that you shouldn't invest in them. These are just some that I think that are a little riskier, absolutely, but really have that power to take off and fly for 2026.
What about transports? We were just talking to an analyst from Bank of America about transports, some of the tailwinds there. Any excitement in your mind about transports and just the supply chain? We know the president's looking at the food supply chain, but in general, we've been in a recession. Is this possibly an entry point right now?
I think so. I think anywhere outside of your Mag 7, there are pockets of opportunity going into next year. And so I think if you're finding those names that have that catalyst and necessarily have good balance sheets to begin with, we're not talking about beating up stocks because they look terrible from fundamentals. But solid balance sheets and going into next year, lots of opportunities.
Aaron Gibbs, always good to see you. Thank you very much. All right, here's the watch of the week ahead. We're going to get some fresh insights into the labor market with the JOLTS report and initial jobless claims. Then Wednesday, we get the big rate decision from the Fed. We're going to hear from Chairman Jay Powell afterwards. And the days after the central bank's decision, we're going to hear from 2 Fed members. Also, we got earnings this week from Costco, Broadcom, Toll Brothers, and Lululemon. Before we let you go, one more look at the futures. As we mentioned, the Dow, it turned positive just a short time ago, in the green across the board right now. That does it for us. Squawk Box starts right now.
Good morning. It is decision week for the Fed. Not only will we see what is expected to be a cut, but also the comments and the outlook for future cuts, we think. President Trump, meanwhile, signaling that the Netflix takeover of Warner Brothers studio and streaming services could face challenges. And another top executive could be headed for the exit sign at Apple. Monday, December 8th, 2025, and Squawk Box begins right now.
Good morning, everybody, and welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick along with Joe Kernan and Andrew Ross Sorkin, and here we go on Monday morning. It was a strong week last week for the major averages. In fact, the Dow and the S&P are each less than 1% from an all-time high after the gains we saw last week that were added to on Friday. This morning, you do see some green arrows with the Dow futures indicated up by about 12 points, NASDAQ futures indicated up by 63, and the S&P futures indicated up by close to 8 points. If you're watching the Treasury yields with the big Fed FOMC meeting this week, you'll see that the 10-year right now is sitting at 4.15. The 2-year is sitting at 3.57. So yields are higher ahead of that FOMC meeting.
Meantime, President Trump saying he's going to be involved in the government's decision to okay Netflix's acquisition of Warner Brothers Discovery's movie studio and streaming service. The president making those comments to reporters at the Kennedy Center last night. And he said that he recently met with Netflix's co-CEO, Ted Sarandos, and flagged possible issues with the deal. Take a look at what he said.
He came up, he was in the Oval Office last week. I have a lot of respect for him. He's a great person, but he's done one of the greatest jobs in the history of movies and other things. He's got a lot of interesting things happening aside from what you're talking about. But it is a big market share, there's no question about it. It could be a problem.
Shares of Netflix and Warner Brothers Discovery this morning. Take a look. Netflix at $101. Warner Brothers at about $25.71. I thought the most interesting piece of that interview was, I mean, there's sort of a whole thing we could deconstruct there, but the idea that he's saying, I'm going to be involved in the decision making is
Justice Department.
But that's a very unique position to take as the president, at least publicly. I was trying to think back. I think that may very well be the first time I've ever heard the President of the United States saying that they were going to weigh in personally on a transaction of any sort. Now, yes, it's always been a Justice Department that, the lead of Justice Department is somebody they appointed, and all of that. But if you go back to the...
Yeah, but we certainly always assumed that Trump would do that.
Well, but if
that's all we talk about.
But if you go back to the famed AT&T transaction with Time Warner, or what was called Time Warner back then, and the effort to block that transaction, and all of the commotion and conversation about was he involved in trying to block that transaction or wasn't he involved in trying to block that transaction, and the repeated efforts to suggest that he did not, put his finger on any scale whatsoever, if you recall, that typically the Justice Department is supposed to act independently of.
He said it out loud.
Say it out loud.
Okay, that's the only difference though. Because every time,
yes,
you know how many times
we said out loud.
Oh, Comcast can't do it, or oh, such and such, or David Ellison can do it because they, or all these tech companies are having, okay, so we said it out loud.
So now it's
not new news.
Well,
it's a way to come out of the gates on Monday and say, oh my God, look what Trump's doing again.
No, it's a way to say this is a major
unheard of.
It is unheard of.
Even though you knew it was happening.
I think a lot
Even
of
though you said it almost every day that
I think a
Trump
lot of us suspected behind the scenes that he was involved in these things.
Did he at least make it look good in public?
What did you say?
At least he'd make it look good and not cop to it in public. That would be better if he would do it more surreptitiously.
I'm not.
You prefer that?
Well, what's so interesting about this administration, and maybe this is the point that you're trying to make, which is it is all done it is all done in front of you.
How much do you love transparency?
Love transparency.
You do?
There.
Doesn't seem like it. How about, can we just talk about suddenly, remember Tom Lee, going to be really rocky, but going to be a good month? Here we are. It was rocky, was it not? I mean, we were worried about the stock market about a week ago or 2 weeks ago. If you look at everything, I think the Dow's been to what? I don't know if it actually hit 49,000, but it's pretty darn close.
Right.
I don't think the S&P hit 7,000, but it got up there really, really good. Right on the cusp of actually making all that back, even with all the, once again, there's a lot of worry and angst about the market. Bitcoin, who knows? Bitcoin.
Can I ask you one other Netflix-oriented question?
Yeah.
Which I did find fascinating.
You met with Sarandos for a couple hours, right?
So I had actually done some reporting.
They're thinking that.
Well, that's where I was going, where Becky just went, which is, I wonder whether the president signaled to Sarandos or Sarandos misinterpreted the signal, if in fact there were signal, and this goes back to who's doing what and all of that. Because
$5.8 billion breakup fee on it if we have some
because
sense
clearly
that you think things are going to get through.
Right. Clearly Ted Sarandos thinks he's having this meeting with the president, thinks this president is giving him the high sign. You go for it, buddy.
I even thought it a more diabolical.
Okay.
My original thinking is, we met with the president. The president said, looks good, Ted. Looks good. President, though, has to make it look like they're going to do a lot of due diligence to make sure it is okay because of market share. But maybe there was a wink and a nod as long as you behave. That's Sarandos.
So what does behaving mean?
You know, as long as you stay in my good favor. I think he probably said it looks pretty good for you, Ted, but just, as long as you walk the walk and talk. In other words, the kind of stuff that you say Trump is doing to all tech and to all these people. He wants like gold boxes, and he wants everyone to kiss up to him.
This is the king's category.
Okay.
Right. That's what we're talking about.
We're talking about
what kiss the ring of the king.
What hasn't been talked about in the past, but it's good to. I mean, whenever we talk about any company doing anything, we say, "Whoa, I don't know if Trump would go for that." So I think that Sarandos got some good. They met for, I think, 2 hours.
Yeah, a long time.
So I think that he got some very positive overtures from the president, but I think he could screw it up, probably.
My understanding is that...
Is he already? Like, what is the talk that's coming from this? But
my understanding was that the president told Ted Sarandos in the Oval Office, look, I'm a free market guy. I want it to go to the highest bidder. literally talked about saying, I want to go to the highest bidder.
Yeah.
They went back and forth about what that really meant, that he wasn't necessarily in the Ellison's pocket, there was a conversation about that. And I think to some extent.
I don't think he thinks he's in anybody's pocket.
Well, but I think actually it was possible that was sort of used to suggest to him, oh, the Ellisons are going around the world saying that, they're in your pocket. And he wants to say, well, maybe, no, I'm not in anybody's pocket.
Trump, but also in anybody's pocket, and I think that plays out with Elon Musk and anybody else who's trying to cross that. Can I tell you guys about some breaking news?
Yeah.
There's some stuff that's coming out. You want to finish that thought?
No, I was just saying it's almost like the Ellisons are pretty nice people. We'll see how you.
Yeah. Okay. Makes sense. I'm trying to read through this. These are some releases that have just crossed the wires. Berkshire Hathaway is announcing some leadership changes and appointments. And this is happening less than a month from Greg Abel taking over the reins from Warren Buffett, who has been heading that company up for the last 60 years. In these changes that are coming, Adam Johnson, who is the CEO of NetJets, has been appointed to a new role. It's called President of Consumer Products, Service, and Retailing Businesses of Berkshire Hathaway. He's going to continue as the CEO of NetJets, but he'll be expanding his role by taking up some additional responsibilities. He's been there for 3 decades at NetJets, including 10 years as the CEO. And Greg Abel says that Adam is an accomplished leader with a proven ability to deliver long-term shareholder value. Also, Todd Combs is leaving Berkshire Hathaway. He, of course, has been running a big chunk of the money, something like $20 billion or more of the money at Berkshire Hathaway, and he's been the CEO of Geico for the last 6 years. Berkshire is saying that he's leaving and he's resigned to accept a new and important and interesting job at J.P. Morgan.
He was on the board of J.P. Morgan.
He was on the board of J.P. Morgan. He's going to be stepping down from the board of J.P. Morgan to pick up this new role that we'll talk about in just a second. It's the head of the strategic investment group at the Security and Resilience Initiative that Jamie's been talking about, Jamie Dimon, for some time. We'll talk more about that in just a moment, but just get through the rest of the Berkshire changes. Nancy Pierce has been appointed the CEO of Geico effective immediately. She's been serving as the Chief Operating Officer at Geico, and she joined the company back in 1986. So Ajit Jain has some very nice things to say about her being practical, decisive, and focused on results. Mark Hamburg, who is Berkshire's Chief Financial Officer, is going to be retiring from Berkshire Hathaway, but not for another year and a half. He'll be staying through June 1st of 2027. He's been with the company for 40 years, and Berkshire's saying they extend their gratitude to Mr. Hamburg for his exceptional leadership. Charles Chang is going to be succeeding him as Senior Vice President and Chief Financial Officer of Berkshire, and that's effective in June 1st, 2026. They'll work together for a transition period. There's a new general counsel who's coming in, Michael O'Sullivan, who is coming from Snap, but previously he had worked at Munger Tolles, which of course, Munger Tolles & Olson is Charlie Munger's old law firm and has been the legal firm for Berkshire for decades and decades. All of these changes are happening, and again, J.P. Morgan is just putting out this release on Todd Combs as well. He's going to be heading up the firm's efforts to make direct equity investments of an initial $10 billion as part of this $1.5 trillion initiative that J.P. Morgan has announced to address pressing needs in key sectors from critical minerals to frontier technologies. Jamie Dimon has talked an awful lot about how in this country we need to be more focused on things like the supply chain, things like defense, AI, critical minerals and mining issues, all of those things that we've heard an awful lot about from the Trump administration, just places that we found we no longer are able to kind of care for ourselves. Jamie Dimon has talked about, in the last 6 or 8 weeks, he's been talking about this. They put out a release, I think, in October, highlighting some of the things that they'd be doing here. The firm already has plans to loan $1 trillion over the next 10 years. They're hoping to bump that up by 50% to $1.5 trillion. And now Todd's going to be running this pretty key and critical
The frontier?
$10 billion.
What do you mean by frontier? I think they mean frontier in terms of new.
Frontier technologies.
Right, okay.
Like AI.
Not frontier, it's not going out of the country.
No, it's not like rolling out in the wagons, the
Frontier.
covered wagons.
No, but some of the frontier, like that's, there's top tier,
No, frontier technologies they're talking about, like AI.
developed countries, less developed companies, and you think of, you know,
Yeah. Now,
frontier
this is
countries.
news for in America, I think. And by the way, the council that's heading all of this is going to be chaired by Jamie Dimon. It's got a pretty impressive group of people on the board of this. Jeff Bezos is going to be joining it. Todd will be on the board. Todd Combs, Michael Dell, Jim Farley, Robert Gates, Alex Gorski, Condoleezza Rice, Paul Ryan, a lot of pretty important names of people you probably know too. But this has been a huge initiative for Jamie Dimon, and so Todd's going to be running that venture capital arm of what's happening there.
It sounds like kind of setting up to help make America great again in terms of bringing back a lot of things that we lost during globalization.
Very cool.
So all of these changes are taking place, of course, as Warren Buffett gets ready to hand over the CEO job to Greg Abel. That's the job he told us about back in May, where he surprised all of the shareholders who were there at the annual meeting. But this looks like a pretty set plan for an easy transition for how Greg's going to be taking over that company again starting January 1st. He's obviously been running things for a long time and helping along the way with all of these things, but this is the formal transition for that, and they're laying out their plans.
Okay, we got a lot more coming up. We'll dig into, well, just everything as we get ready for the Monday morning market open. Major averages just finishing their second straight positive week, and the S&P is up 9 of the past 10 sessions. Don't go anywhere. Squawk Box rolling on this Monday morning after this.
Investors gearing up for the Fed meeting this week. Joining us now, Sylvia Jablonski, Defiant ETF's co-founder and CEO, and we were talking about some of the positive action we've seen in the stock market in the last week and a half or so, which maybe calmed some of the fears that we did have earlier about whether we wouldn't have a Santa Claus rally. In fact, a lot of people said what we normally see in September and October, we were seeing in November. Some of the we see a lot of lows set in October. I want to start with you with something you said. I thought it was nice. But here's the Wall Street Journal: American consumer sour on the economy. You say for the first time in a while, consumer sentiment went up, and that's one of your positives. So I said, well, how can it be when this is in the okay? So University of Michigan has been doing this since the middle of the 20th century. The all-time low. And it's a number that can be anywhere from 50, 60, 70, something like that. The all-time low was 50 back in 2022. Last month it was 51. This month it's up to 53. So that's your better consumer sentiment, right off a historic low that happened. That was right after Ukraine was invaded by Russia. So it's sort of like bouncing around the bottom. There are problems with consumer sentiment, are there not?
It's bouncing around the bottom, but it did move a little bit. And
moved a little higher.
It moved a little bit higher.
Before Christmas.
It moved a little bit higher before Christmas. We saw the dip buyers come back in. You know, a lot of what I think about is gauging what happens in the market when we get these pullbacks. Is there utter panic, and do people kind of run for the hills and sell all of their positions? And is it prolonged? Or do we see a short-term pullback in broad-based indices, and do we see investors coming back in? And I think when we see investors coming back in and you start to see broad-based rallies in the S&P 500, which we did see during those bottoms over the last couple of weeks, I think that the investor is becoming a little bit more positive on the market. The broader-based surveys, yes, they are near historical lows. They bounced up a little bit, but I do think that there's a positive outlook for the future in terms of wage growth for middle and upper-class Americans. Inflation is softish, jobs are softish, earnings are good. I think that overall there's a stable view of the economy and where we're going.
The one caveat for the journal's piece was that but spending continues. So they point out all this, but people are doing things differently than what they're saying. The other thing in the article, it totally is split down party lines. Republicans feel much better about what's going on. Democrats think, it's the end of the world in terms of the economy right now. So that's probably not that surprising, but it's a K-shaped economy we keep talking about. So the high net worth, or not high net worth, but people that are doing a little bit better are spending more. People that aren't doing as well are not. But you see the dollar store ETFs. So they're finding a place to spend it. They're just very value conscious right now, but they're still spending.
Yeah, and they are spending, and I think that that's also a sign that we have a pretty decent and strong base within the economy here, right? And I think that the minute, and to your point, a lot of times what they say and what they do is completely different. So I also take those sentiments with a grain of salt, because you'll see that. You'll see, lower confidence numbers or like a slight pickup, but then you see a big change in spending. Holiday spending, seasonality is on our side right now. So I think that as long as we continue to see a strong consumer spending, and jobs don't fall off of a cliff, you have that stability there.
So everything sounds pretty sanguine with you. Some of your long-term concerns are that the Fed could be making a policy mistake in terms of inflation. You think there will be cuts? Is that the wrong thing to do, or you're not sure?
Well, I just think that they've made mistakes before. So we need to see. I think that there's a fine balance here, right? The market expects a cut. The market expects at least a couple of cuts next year. And I think that if there's any kind of divergence from that, or if they go too fast one way or not fast enough the other way, there's impacts to the economy there. So the market is very, very tied to what the Fed is doing again. We talked about this last time I was here. We talked so much about how everything in the markets is revolving around tariffs, and that's the obsession of people. We started almost talking about the Fed a little bit less, and now it's back to the Fed. So I just think that any policy misstep or shakeup from what the market expects leads to volatility.
And AI continues to lead.
Yeah, AI continues to lead.
That's good. That's okay.
I think that's okay. I think that's good. You're talking about a $300 billion market cap. It's projected by 2033 to be in the trillions, a 9x growth, 30% compounded annual growth rate.
the energy behind it is set to grow 8x from where it is now. Right now it's at about 60 billion. So once it starts getting integrated into the different sectors in the S&P 500, kind of beyond the ChatGPT story, I really think that this is a thematic play that investors
We'll hit new highs and even further new highs next year, in your view?
I think further new highs next year, barring any major geopolitical issue, tariff crisis, which we've seen these things happen, right? So they're not impossible, but I do think that the market is set up to continue.
Okay, thanks.
Thank you.
When we come back, Elon Musk blasting the European Union over a 9-figure fine for his social media platform X. We've got that story next when Squawk Box returns.
Welcome back to Squawk Box this morning. Elon Musk calling for the European Union to be abolished. This after the block fined the social media company X $140 million. That followed Friday's decision by the European Commission to hit X with the fine after a 2-year investigation into the company under the EU's Digital Services Act. Now, last week, the European Commission had said that infractions by X, which included what it called the deceptive design of X's blue check mark for verification, lack of advertising transparency, and they say the failure to provide access to public data for researchers. Secretary of State Marco Rubio calling the fine an attack by foreign governments on all American tech platforms. Let's see whether there is backlash from the U.S. government about that.
Coming up, they've seen this movie before. Saw on Twitter it said, ask a person if they know Europe's leading tech company. That's the first one. Some people, very small minority, can come up with ASML, and that's it.
ASML is the top.
Say
Spotify.
Spotify's number 2.
But you're a leading financial firm. You're able to come up with that
Loud and proud.
Yeah, you're able to say that. Most people would be like,
Arm holdings.
feel like cricket.
Arm holdings. Come on, that's pretty big.
It is, but think of, when they've got plenty of them. But I think Elon, never hyperbolic, is fine. We really should, the entire EU should be gone.
Yeah, when did SAP fall from the top spot? Is that one?
Oh, I would think of it. I mean, ASML, I do think is such an important sort of component part of the
I
whole.
wonder what they're talking about the blue check mark. I mean, you can go to jail for a meme in certain countries.
Germany.
Yeah, go to jail for a meme that they don't like. Coming up, more of today's top stories, including report. Yeah, I didn't think about that. I may go incognito. The White House is planning to unveil a multi-billion-dollar farm aid bill. Stay tuned, Smart Cross will be right back.
Ominous.
Welcome back, everybody. 5 things to know ahead of today's opening bell. First up, IBM is in talks to acquire data infrastructure company Confluent for $11 billion. That's according to a Wall Street Journal report. Some changes to the S&P 500. CRH, Carvana, and Comfort Systems USA are going to be joining the index before the open of trading on December 22nd. LKQ, Solstice Advanced Materials, and Mohawk Industries are being removed from the index. And we will watch to see what happens with this, but as you might expect, those that are being added are up this morning. The biggest gainer is Carvana, which is up by 9%. The Trump administration saying that it will forgive the remaining $11 million of the civil fine against Southwest Airlines stemming from its 2022 holiday meltdown. Nearly 17,000 flights were canceled during that disruption. And the Trump administration planning to unveil a long-awaited aid package for farmers, including $12 billion in assistance. That's according to a Bloomberg report. Also, a horror sequel, Five Nights at Freddy's 2, surpassing expectations and winning the domestic weekend box office with $63 million in ticket sales. That movie had the biggest opening ever for the weekend after Thanksgiving.
We come back, we're going to get you ready for the day ahead and get the latest on New York City's mayoral transition. A little more than 3 weeks till Zohran Mamdani takes over at City Hall. And remind you, get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app and listen anytime. We're coming right back. Back to Squawk Box. Our next guest is going to weigh in on the future of business in New York City following Zohran Mamdani's mayoral victory last month. He takes office on January 1st. Joining us right now is Partnership for New York City President and CEO Kathleen Wild. She is one of 400 appointees to Mamdani's transition team. Good morning to you.
Good morning.
So tell us, help us understand what you think is, what the transition looks like and what you think the business community needs to understand about it.
Well, the transition is kind of slammed because usually we know who's going to be mayor after the Democratic primary election. And this time we had to go through November 5th. So it's a very short transition period. The first two meetings that I've been involved with have gone very well, been well organized, and basically they're looking to the transition committee for suggestions, ideas on structure of government, how and appointments.
So here's the question. You've spent a lot of time, obviously, with the New York City Partnership all these years, and I think you understand what the business community thinks it wants. This was not the outcome, I think, that they all thought that they were hoping for. But given that this is the outcome, what do you think the prospect is for New York City over the next 4 years in terms of business in this city?
I think that the business community is willing and anxious, really, to help the new mayor. He got an overwhelming support in terms of bringing young people out. Kind of the cutoff for his support is 45 years of age. So under 45 is who elected him, and that's exciting for New York City as the destination of choice for college students and young college graduates. Employers like that. So that's the positive side. The negative side is the campaign rhetoric that talked about raising taxes in the highest tax city in America, one of the highest taxed in the world. I mean, we used to think of Europe, Paris, London having high taxes. We're higher. So that's basically where it's at.
And given your role in all of this, on this transition team, do you push back and say, guys, if you do raise taxes, that's a problem, or are you of the view that actually if you keep taxes, or you raise taxes rather, that's not a problem?
Oh, it's definitely a problem. So no, I'm very clear on that we have to keep New York competitive. We can't afford the premium cost of living. Raising taxes, more government spending, only makes the affordability crisis worse.
What flies right in the face of it? You said you didn't, this time you didn't have much time because after the primary you didn't know who was going to be mayor. Don't you have Kalshi? Didn't you know when Donnie was going to?
Yes, but they were busy campaigning up until, I'm just saying in terms of organizing your transition, usually it starts in June.
One of the things that I've heard a number of business leaders, by the way, not just big business leaders, small business leaders, super concerned about as of last week, was this comment that the mayor-elect made about homeless encampments and leaving them on the streets as opposed to quote-unquote sweeping them, which is something that Mayor Adams has done and actually a whole number of mayors have done over the years. There's not only a question about the humanity of it, there's a question about the safety, security of the city. And
Andrew, I figured you were going to ask me about that.
Please.
Because when I heard the statement too, I thought, oh no, and I got plenty of calls saying this is going to look like Los Angeles, Kathy. I clarified that with the mayor-elect's team, and in fact, what he was talking about was the new Department of Community Safety, that rather than sending police out to move somebody from one location to another location, or to tell them they have to get out and then they just go someplace else, there's really going to be an effort to try and find some rational permanent placement for people, or interim placement even for people who feel the need to encamp on the streets. We are not going to have homeless encampments in New York City. It would make no sense whatsoever.
okay, so that's off the table. That's new news, by the way, because you saw obviously Mayor Adams came out and put out a video online about it. I mean, there was a lot of
The language of the statement was unclear. And so the first thing we worry about is what's going to happen to the streets of New York. And so I took time to confirm that there is no intention to have homeless encampments overrunning New York City streets, and that's not going to happen.
Can you tell us, to the extent you can or know, what the relationship really is like between this mayor and the governor? Because a lot of time, the biggest discussion point, whether it's around taxes, whether it's around a whole number of priorities that the mayor has talked about, require, in large part, the cooperation and approval, in some ways, of the governor being on board. And what that really is like at this point, and where you think she is on some of these issues, whether it's free buses or other things like that, and just the budget-related issues versus some of the things that he may be thinking about?
Well, Governor Hochul is not shy, and she actually has made very clear that she does not support tax increases. She, on the other hand, does support childcare, expansion of childcare. And I think that's a common denominator with Mayor Mamdani that she's going to work together with him on. So I think it's all over the map. I mean, free buses, we don't have any way to pay for free buses. On the other hand, expanding support for people who, transit support for lower income people is something to look at.
What did you make of, Mamdani went online and posted something about how New Yorkers should handle ICE. Did you see this?
No.
If in fact ICE arrives on your doorstep, here are all the things you should do. Here's what's legal, here's what's not legal for what ICE is doing. I wasn't surprised that he did this. I was surprised only in the context that he had this meeting with President Trump 2 weeks ago where they acted or seemed sort of buddy-buddy, and then if you watch this video, you'd think, oh my goodness, they are obviously, and I think we all know this, on the opposite sides of so many issues, this being a particularly hot-button one.
Well, I mean, ICE is a scary proposition for New York City. We have 43% of our workforce in New York City are foreign-born. We have 500,000 undocumented immigrants who are longtime residents and workers in New York City, taxpayers sending their kids to public schools. So we have a long history, and we depend on foreign immigration. So the kind of threat that's in our community, I live in Bay Ridge, Brooklyn, we have a lot of immigrants there. They feel a real threat with ICE, and I think this is caring about our neighbors. We don't want to see, one thing, we totally agree with the president on getting the criminals out of here, the gang members, etc. But in terms of the threat to our long-term members, that's just a function of our failure to pass sensible immigration policy that provides a path to citizenship for those who are that want to be good citizens of this country.
Captain Wild, I want to thank you for coming in this morning. Appreciate it.
Well, I disagree with this check. There's a legal way to come into the country and there's not.
Very soon. Thank you.
All right, coming up, Apple potentially facing another key executive departure. We're going to tell you why this one could be.
I love immigration.
Maybe some of the others, but first,
as long as you're legally here.
We look forward to this. The AccuWeather forecast with meteorologist Bernie Rayno. Take it away.
It's cold Monday in the Northeast. Your AccuWeather exclusive forecast calling for gusty winds in Boston, New York City, Philadelphia, flurry in Washington, D.C. Watch out for some accumulating snow in southern Virginia. We'll have a thunderstorm in Miami. Much of the west is going to be dry today. Chicago, it's a cold day. No travel delays in your AccuWeather travel forecast, but the wind causing problems in Boston and New York City. To help you make the best decisions and be more in the know, make sure to download the AccuWeather app today.
I've got a possibility of a fallen wedge and a bull flag. It's just strange how they throw it under the rug, the truth. But oh well. Well, not really. I mean, I'm going to call it a bull flag.
Trump saying a key Apple hardware executive is considering leaving the company. Steve Kovac joins us now.
Yeah, it just keeps piling on, right? You have all these big shots out there in Cupertino. They're getting new careers for the holidays, and there have been several changes in the last 7 days, on top of several departures over the last few months. Now, the latest after last week's exodus is chip boss Johnny Srouji. He wants to leave, according to Bloomberg. He's been instrumental in ditching Intel chips at Apple. You can kind of think of him as the Johnny Ive of chip design. It would be a huge loss for the company. He's one of those sort of singular talents over there. And look, these shakeups that we keep hearing about, this drip, drip, drip of announcements of executives leaving, a lot of this is to meet this artificial intelligence moment. The world has been changing around Apple the last few years while it kept things mostly the same. And next year is actually going to be a monumental one for Apple after it failed to deliver on artificial intelligence this year. So that AI Siri update is coming in the spring, and they have to get that one right. That's part of the reason why AI boss John Giannandrea, he stepped down last week and was replaced by an executive at a lower level than he's been serving at. And now they need that system to work before they can launch other AI-powered products, such as glasses to compete with the ones Meta's making, and some smart home products that are expected next year as well. It's also Apple's 50th anniversary coming up in April. They've got a looming antitrust trial that its new attorney is going to have to deal with. And look, there's a lot of things going on here. Some of these departures are changes to meet that AI moment, but a lot of these recent departures, we have to talk about the context. They appear to be leaving voluntarily to work on projects at Meta and OpenAI. So we'll find out next year, though, guys, if this is the right team in place to bring Apple to that next leg.
It just keeps on keeping on.
It keeps going up, but I mean, they really, they missed the AI moment, and whether or not you think artificial intelligence is going to be the next big platform or something, it's being forced
How much, look, the memes online over the weekend are just about this sort of exodus.
Exactly.
You would think that you think the whole place is gone. I don't know if you saw there's one meme that shows the leadership board of Apple, and Tim Cook is on it.
Yeah.
The rest is white and blank.
And it's just missing. And by the way, Tim Cook now has 2 fewer direct reports than he did this time last week.
How much do you think the investor class should worry about that?
Well, here's the thing. I view it as when we talk about succession and whether or not Tim Cook's going to leave early in the year. If he was leaving, why would there be so much change, at least from that he's pushing for, before he leaves? Usually the new guy comes in and would clean house and change things up. I saw this kind of as a signal he's sticking around. By the way, the new attorney for them, they said in the press release she's going to report to Tim as of March 1st. So there's your little hint that, that Financial Times report that came out saying he's going to leave early next year. Perhaps, at least for right now, Apple suddenly, that's not going to happen.
But how deep do you think this bench is, and how critical are these individuals versus other individuals? In a world where everyone always thinks that everybody's dispensable or indispensable, how indispensable are these particular people?
It's a case-by-case thing. Srouji, the chip guy I was talking about, he's quite indispensable. In fact, that Bloomberg report saying they want to entice him to stay, so they're going to potentially give him a CTO role, more responsibility, and so forth. He did an extraordinary job with those Mac chips and divorcing them from Intel.
It's amazing.
The reason why you can open that more than one Chrome tab on that computer and it doesn't sound like it's going to explode, that's him. The battery life, all that kind of stuff. It led to a surge in Mac sales. Artificial intelligence. He created the hardware platform to make Apple Intelligence and all these AI stuff possible on these devices before we even talked about ChatGPT. It would be a huge loss. So that's the thing. We talk about these guys leaving voluntarily versus the ones like John Giannandrea, the AI guy, who were likely pushed out. What is going on here? It is just a lot of change for a company not known for changing. And you got to look at the board too. A lot of people are about to age out here as well.
A time where AI is more important than it is now for Apple. Only 10 points off an all-time high.
Right, and right now, all it is about selling phones. You got to keep in mind, they're going to give away their AI stuff, at least that's what we think, for free. So they have to use it. It either has to push people to buy more iPhones, maybe upgrade earlier than before, or go into these other products, or they find a way to charge for it. You're welcome.
All right, when we come back, much more on the Netflix Warner Brothers deal. We'll be joined by a top Bank of America analyst. Squawk Box. We'll be right back. Welcome back, everybody. Let's talk more about Netflix's proposed acquisition of Warner Brothers Discovery Studios and streaming platform. Joining us right now to do just that is Jessica Reif-Ehrlich. She is Bank of America Securities Senior U.S. Media and Entertainment Analyst, and she just published a new note and raised her Warner Brothers price target to a little less than $29 a share. Earlier, she had a $24 price target on it. Jessica, does that mean that you think this deal is going to go through, or that you think other bidders may come back in?
I mean, it's a fluid situation. We all know that. It's unclear what happens from here, but what is clear is that the value of these assets is the value of their IP is just unparalleled, and so it's an attractive asset. There are several bidders, and we do think that Warner Brothers is extremely attractive on its own or as part of another company, and of course there's also the piece of Discovery Global Networks.
It's kind of amazing to see the turn in the valuation being offered to this company at this point. You look at those assets and what they were worth 9 months ago. This is a shocking kind of, is it just because there are interested bidders all of a sudden?
I mean, look, we've had buying for a while. I admit we were wrong, or let's say we were too early. But these are great assets and unparalleled. And why is it so attractive to everybody? It just puts everyone at a different level. So for Netflix, they can really build a moat around their business. What they can do with this content is a little bit different than others can do. For the same piece of content that HBO Max would have on, whether it's Band of Brothers or I don't know, something on like Young Sheldon, like just pick any content, there's deeper engagement because of Netflix tech capabilities, because of their platform. So Netflix has 325 or 350 million subs. They don't disclose that number anymore. HBO Max has 128 million. So let's say 75 or 80% of HBO subs get Netflix. There are still 225 million or 250 million global Netflix subscribers who have never seen HBO content. So there's a real argument for Netflix, what this can do for Netflix. We'll see how they operate it. But you could do that with each of the bidders.
The idea of whether this will pass regulatory scrutiny, particularly with the comments that were made by President Trump over the weekend. If you look at the prediction markets, Polymarket had a contract that, as of December 7th, yesterday, was saying it was a 59% chance that Warner Brothers Netflix deal would close by the end of 2026. Today, the reflection in that contract is 19%.
Right. Well, it's a process. We'll see. We know that there have been parties who have influenced the press, but your parent company, Comcast, said on their last call that the regulatory fears were overblown. So it's a process. Nobody really knows. It comes down to what's the definition of the market, and we'll see where the government goes with that.
You don't think that the deal is going to be cut in any way, shape, or form, though? If there's another bidder that comes in, it's going to be $29, $30.
It's not going to be less than that. So it was what was clear from the beginning. This company, like Paramount Skydance, was not going to steal Warner Brothers.
Is there a cost of capital just for being locked up if this deal takes 18 months or longer to try and consummate?
Yeah, I mean, look, it could be range bound. We'll see. There's a constant news flow. You guys talk about it all the time, but there's a constant. It's not just you. It's everybody.
What are the plays for companies who were spurned by this situation? If this deal goes through and you're looking at either Paramount Skydance, or if you're looking at Comcast, what are their options?
It's a great question. I'm really surprised at your parent company. I mean, NBCU has some great assets. Obviously, a great film company. Universal's done a fabulous job, and theme parks have been really strong. But Peacock, is surprising. It's just surprising that Comcast introduced Peacock. I don't know, 6 years ago or so, and first to come out with an AVOD product. They zigged when everybody else zagged. It's a small domestic service that's, with it's really big expenses coming on with sports, NBA, Olympics, etc., Super Bowl. So they need scale, unquestionably. So where do they go from here? Paramount Skydance, unfortunately, Paramount's assets have been run into the ground. So there's heavy lifting.
There's still some good cable properties. I looked and I was saying, oh, what's Discovery got? And I was actually talking to my wife, I mean, HGTV, people still watch a lot of those.
Yeah.
And
How?
There's some other ones. I forget all the ones. I was like, oh yeah, that's still real. Oh yeah, that's still real. Oh yeah, that's still real. And then I think about Versant too. A lot of those are real. I mean, who gets with whom? What do all these stubs do? Is there going to be stub love?
Well, for Discovery Global Networks, I think they have a little bit of a different strategy. I'm a huge fan of Gunnar Wiedenfels, the CFO of Warner Brothers Discovery, soon to be CEO of Discovery Global. I think he has a real plan. I'm not 100% sure they haven't articulated, but it seems that their focus will be more as a roll-up vehicle for European assets, which are less secularly challenged, more free to air, more local content. They could sell assets. They have a lot of options. For Versant, I think they've been pretty clear that they do not want to be a roll-up vehicle, but ultimately, both companies, both Paramount, Skydance, and NBCU, are weakened if Netflix is the ultimate victor.
So here's my question. What do you think about the prospect of a Paramount Peacock transaction where you effectively spin off CBS and merge that with the Warner Brothers Discovery, or I'm sorry, the
Netflix.
No, the Warner Brothers Discovery,
Discovery Global.
linear business, because then CBS gets attached up to CNN, and then you might have solved some of your problems.
Yeah, no, it makes 100% sense. Two weaker players, we'll see if they combine, but that may be
enough to be able to come together and say, hey, we're all going to work this out.
I'm sorry?
You think of them as enemies, but are they frenemies
Well,
in reality?
at the end of the day, you have to be practical, and so they may be better combined. Paramount Plus would be at least a global platform for Peacock. So you can go through the assets, and that absolutely makes sense. CBS going to Discovery Global Networks also makes sense. I mean, broadcast has had a resurgence. There's a lot of value in a broadcast network, and there are only 4 of them.
It was just kind of funny that apparently the ranks at CNN were like, we dodged the bullet. Just the idea that someone who's thought of as sort of middle of the road that might put a kibosh on some of the just total left-wing, approach of CNN. We'll take Netflix. We have no idea what they're going to be like, but anything's better than actually being objective. I mean, it cracks me up. And they could end up with her anyway. Right? Could they end up with that anyway?
Well, under the scenario that I'm playing out,
Under Andrew's plan.
Yeah, I mean, look,
I hope she's taking names for the ones that said mean things about her.
this is just the beginning of media consolidation.
Hilarious.
A lot of M&A.
Okay, and you're sure that the Ellisons don't just throw caution? Larry's got how much money? 500?
I'm not sure. I didn't say that. I said,
Because, by the way, that's just 2.8. It costs 2.8 to break up the deal, not 5.8.
Yeah, right.
My understanding is, if the regulators block the deal, it's 5.8.
Right.
If you just want to jump the deal, you have to spend 2.8 to get over the line.
I think that most people think that Paramount Skydance will come back with a higher offer. We'll see. This is still playing out.
Okay, one last question. Do you think there's a value? So all these other players who are sitting around, whether it's Comcast or Paramount Now or whatever, do you think that they, if they are not going to get the deal, do you wait effectively for 18 months or however long you think it takes for this deal to get completed before you make your next move, or do you say, you know what, I'm going all in and I'll do my deal now and I'll try to draft off this deal? Meaning if there's 2 deals in front of the DOJ at the same time, it's actually more likely that they both go through than if you have one and then you wait. Do you see what I'm saying?
I do, but I'm not going to play the odds. I mean, it's unclear.
That's your business.
But it's unclear what everybody is thinking. It's unclear what their strategy is. It's surprising to me that Comcast waited this long to express interest. Brian Roberts and David Zaslav knew each other for a long time. I would have thought that they would have made a much earlier move. So it's hard to know what everybody's
Part of it was
thinking.
that there was a view that under the Biden administration there was no move to make, and that possibly under the Trump administration there was no move to make. Right? That.
So
and you made that point, I think, on Friday.
But you
That it was, well, just that the reason why these deals didn't happen earlier was because they felt that they couldn't.
There's been a freeze.
Even though we didn't find out till the day that Trump might actually exert some influence on the deal. We knew these couldn't happen, but today we actually found out Trump might get involved.
To wait for somebody else, so now they've waited, and it seems like it's too little, too late.
Thank you, guys.
It depressed me what you said about about Peacock too. Is Peacock not?
Are we still on it?
We're still on TV. We're still on TV. We haven't gone up yet.
Should they have kept CNBC and got rid of Comcast? Got rid of Peacock? That's what I think. I would. No.
It's just surprisingly small. Let's say that, and they need to scale up.
Those are terrible words. Yeah, I've never heard.
Wow, Jessica. Now we're still on TV.
We're still on.
Okay.
Hang tight. Don't go
And
anywhere.
we're not going away now. So sit tight. We're going to talk about the futures. Thank you.
Thank you. She's like, how quickly can I get off this?
This happened last time. This happened.
I know.
That's why I wanted
No, we were still on.
Okay, we're still on.
You didn't think we were still on. All right. We are.
Who would say things like this on live? Oh, listen to us.
Exactly. That's why we're doing an on the break podcast. Checking the futures this morning, a little bit higher, but solid week, and we're just off. Dom Chu, we're just off highs in most of the averages. If you don't look now.
No. And by the way, this is cable, right? So we get a little more latitude on that front. Anyway, from a mover standpoint, Joe, to your point here, let's check out Confluent right now. Those shares are surging this morning after a report from the Wall Street Journal last night that IBM is in, quote, advanced talks to acquire the data platform company for $11 billion. Citing people familiar with that matter. Now, the report said a deal could be announced as soon as today, but it also warned customarily that talks could still fall apart. Confluent's market cap, by the way, as of Friday's close, is roughly $8 billion. Now, if these pre-market moves were to hold into the bell, it would be Confluent's best day since February of 2024, so keep an eye on those. Then, meanwhile, you got shares of General Motors. Let's put those back up about 1.5%, after the stock was moved to an overweight or buy rating at Morgan Stanley with a $90 price target. Now, they say that GM has made the right moves in tempering their EV spending and then right-sizing their China business. They also see macro drivers for that stock in the months ahead in the form of reduced emission standards and also rate cuts on that Fed side of things, so keep an eye on those. And then KB Home also in the green after it was upgraded to an overweight from equal weight over at Barclays. Those analysts there say the potential margin improvements there are a focus as the home builder moves back towards its built-to-order products and say that the stock has been depressed and that share value will drive outsized returns from its recently increased share stock buyback authority. So keep an eye on KB Homes up 1.75%. Now, for more on those and other top analyst calls of the day, just head over to cnbc.com/pro. Subscribers get more of the context and detail around those notable upgrades and downgrades. Joe, back to you guys on cable television.
Yes.
There you go.
You're good. You're good with this, Dom. Thank you.
You got it.
All right, see you later.
All right, we've got some breaking news that came from Berkshire Hathaway and from JP Morgan in the last hour. Investment officer and Geico's CEO Todd Combs is departing Berkshire Hathaway. He's going to be joining JP Morgan, where he'll be heading up the bank's new Security and Resiliency Initiative to find direct equity investments in the defense, aerospace, healthcare, and energy industries. Combs is stepping down from JP Morgan's board to take that role. Berkshire announcing a slew of different leadership changes as a result of all of this. Geico's COO, Nancy Pierce, has been appointed to the CEO of Geico, effective immediately. Berkshire also saying that the CFO, Mark Hamburg, is going to be retiring in June of 2027 and will be replaced by the energy subsidiary CFO, Charles Chang. But Mark Hamburg's going to be sticking around again for a year to make sure, a year and a half from now, a year from when Chang comes in, to make sure that that transition makes sense. Adam Johnson, who's the CEO of NetJets, has been appointed president of consumer products, service, and retailing businesses of Berkshire Hathaway. He's going to continue as NetJets CEO, but picking up additional responsibilities, much like others have done that along the way. Greg Abel at one point picked up additional responsibilities. You've seen this over the years with Berkshire in terms of grooming new people coming in. Again, a lot of these changes, general counsel coming in, Michael O'Sullivan has been appointed to the senior vice president and general counsel. All of these changes taking place just weeks before Warren Buffett is going to be handing the reins over to Greg Abel after running the company for 60 years. And again, Greg Abel will be taking over as CEO on January 1st, as we learned at Berkshire's annual meeting back in May. When we come back this morning, Ed Yardeni making a call on the Mag 7 stocks in his latest research note. He's going to tell us why he says to lighten up on the mega cap names at this point. This is a huge difference for Ed. He's been saying to be overweight in these tech names for the last 15 years, so we'll get his thoughts on why now. he's making this change. As we head to a break, though, check out some of the mega cap names since the start of the year. Alphabet and NVIDIA both with very strong gains. Microsoft and Meta also up double digits. Squawk Box, we'll be right back. All right, welcome back to Squawk Box, everybody. Let's take a look at the futures this morning. Dow futures up by about 10 points. S&P futures up by 6. The NASDAQ indicated up by close to 60 points. And joining us right now is Ed Yardeni. He's president at Yardeni Research. And we could start by talking about how the markets continue to kind of melt back up. We're near all-time highs. But I think the most interesting thing, and what has kind of shocked and surprised me this morning, is your move away from the big tech names in terms of being an overweight statement. What happened? For 15 years, you've been overweight on that sector. What's changed?
Yeah, and it's worked. And so we've got to the point where information technology and communication services of the S&P 500 now account for 45% of the S&P 500. It's a very concentrated market capitalization. And I think, you know, if the Magnificent Seven are going to continue to succeed, then they're going to have to find sales among the S&P 493. I call them the impressive 493, in order to be used for increasing productivity. And I think that's what's...
Are those stocks overvalued, in your opinion?
Well, I think they are somewhat overvalued for sure. especially now that we're seeing that competition is coming in. And, you know, it's turning into sort of a Game of Thrones with the Magnificent Seven. You know, at the beginning of Game of Thrones, these things go up and down, and so the different thrones have various powers. And so I think that's what's happening with the Magnificent Seven. They used to just kind of operate in their own moats and kind of leave each other alone. But I think we're now having a competitive situation. And not only that, but I think we're going to find out that startups that come and challenge some of their technologies.
I'm racking my brain. I don't remember everything that happened in Game of Thrones. I do remember the Red Wedding, though. Is that what we're setting up for with the Magnificent? You know, everybody died. You remember?
Yeah. No, I don't think everybody's going to die. I just think I think it's a healthy development. We need to see a broadening of the market, and the impressive 493, I think, are going to benefit from all these technologies.
So instead of betting on these names and thinking that they will continue to perform as they have to this point, you're telling people to invest in what instead?
Financials, industrials, and what's new for me also is healthcare. Healthcare has been kind of left kind of behind, but actually everybody thinks that IT is the biggest contributor to economic growth. It's actually the healthcare industries, especially as the baby boomers get older and rely more on the healthcare industry. So I think healthcare is another way to do it. And then you can also go overseas, because the U.S. now accounts for 65% of the market cap of the global MSCI or all-country world. And it's hard to imagine it's going to be much bigger. I mean, it does account for 55% of the earnings share on a global basis. But I think I mean, even this year we found that other countries have done better.
Healthcare being new for you, I mean, that's a pretty big deal, especially when you look at how people are trying to change the inflationary curve of healthcare. In Washington, there's a lot of plans underway. You're confident that no matter what happens, these companies will be more profitable than they are right now?
Well, I'm kind of betting that in line with this impressive 493, that all companies are becoming technology companies. You either make it or you use it. And I think more and more companies are using technology to increase productivity. And you know, we've all had the experience of going to our healthcare providers or hospitals. We know how backwards they are with regards to productivity. So there's tremendous potential, and I think we're seeing it. There's something called Epic, which kind of now allows hospitals to share your records, so you don't have to manually send them. Yeah.
But those ideas will make these companies the beneficiaries. It's okay to just use this technology, not make it.
Correct.
Same story with industrials and with financials?
Absolutely. Absolutely.
What kind of pushback have you gotten to this point for shifting in this way? Because you don't do anything lightly, Ed.
It's a little early for the pushback on the call that it's time to reduce the overweight position that I've had on the technology and communication services. Again, it's been 15 years for me. The same thing with overweighting the U.S. I've been talking about that since 2010. And it's worked out, and at some point you have to kind of look and say, how concentrated are these markets going to be? Is, you know, the Magnificent Seven going to take everybody else out? There's going to be no market cap left for anybody else? I kind of doubt that.
What other things would you be telling people in more short term, as we've got the FOMC meeting coming up?
Well, the Fed is coming. It's you know, we've had the federal I call them the Federal Open Mouth Committee.
Yeah, I like that. I like that.
Well, they've been saying for a while here that we should expect a rate cut, and so they got to deliver it. So we're going to get a rate cut. The only question is it going to be a dovish or a hawkish rate cut? In other words, what will be the language around it? And I think it's going to be somewhat hawkish. You know, certainly Powell's going to say that they've already cut by 150 basis points. Now they've cut by 175 basis points over the past year. But I think what's important to realize here is the bond market isn't exactly going along with the program.
I was going to say, the yields have actually gone up. Yeah. You're looking at the 10-year at 4.
I was against the Fed lowering interest rates last year, and they didn't listen to me. They went ahead and did 100 basis points, and what did the bond yield do? It went up 100 basis points.
Why do you do that? Is that because you think the cuts have already been baked in, and you're now going to start looking at more hawkish commentary that comes around this, or is this something else, something more sinister?
Well, I think the bond market's not fully convinced that it's mission accomplished for the Fed.
In terms of inflation.
In terms of inflation. And then, of course, the bond market is a global entity, and global investors do look at yields in various parts of the world. And right now, we've got what looks like a pretty significant debt crisis developing in Japan, where their bond yields going up dramatically. Same thing in the United Kingdom. And I think basically the bond market is just trying to remind the government that, hey, you aren't doing anything about the deficit.
This is a really interesting moment, though, when you look at those yields climbing ahead of the FOMC potentially cutting rates, or at least the expectation that they'll cut rates. How does the Trump administration react to that? Because President Trump has said one thing he wants is the Fed to lower rates so that people can get lower mortgage rates and get lower, cheaper car loans on all of those things. And that's not going to happen if the market defies.
Because, you know, the Fed and the administration is focusing on the Fed funds rate. And they've even got this cockamamie idea that there's some sort of neutral Fed funds rate, and it's probably around 3%, and so we're still kind of restrictive. And so they've been lowering rates, and that's been offset by the increase in the bond yield. I think you have to look at the entire yield curve, and the yield curve is saying, you know, we still haven't gotten to 2% inflation, and oh, by the way, the deficit is humongous, and it's only going to get even bigger as we look.
And you've been very well behaved with all the negative things that you're saying, with the 38 trillion, and with inflation still 50% above where it should be. 415 is not. That's not a spike.
No, it's not. It's not. But I think
It's not the way they want.
It's 15 points away from 3.
But you think back to what.
That's a good point. I mean,
you think back to what James Carville said.
I just don't think you're seeing.
He wanted to come back and
don't forget
the bond market make it intimidating everybody.
Right. Well, yeah, the excrement has not hit the air.
Yeah, early on, the administration was saying that they were focusing on the bond market, and it's not working for them.
Ed, thanks for coming in. A lot to think about, and we appreciate your time this morning.
Thank you.
Coming up, the AI boom and fintech startup AirWallet's just completing another funding round. Its valuation now topping $8 billion. We're going to talk to the company's CEO about its new AI-powered financial operating system. It's an interesting business, and as we head to a break, check out some of the chip stocks over the last month. Squawk Box will be right back after this. Welcome back to Squawk FinTech AirWallex has announced its second fundraise in 6 months, bumping its valuation now to over $8 billion. Joining us is its founder and CEO, Jack Zhang. Good morning to you. This has been a super fast-growing business. I mean, we're talking about a private company that's jumped from $4 billion to $8 billion. What's happening here?
I mean, we spent the last decade to build the best global financial and banking infrastructure, and that takes a lot of effort. And now we hit the inflection point to really scale the business globally. And we launched in the US and Europe just 3.5 years ago, and that business is growing at a 250% CAGR.
Okay, so help Joe here and anybody else who doesn't know what AirWallex is. There's probably a lot of people who don't.
AirWallex is a global payments and banking platform to help modern businesses operate globally and grow beyond borders. So think of us like
who do you compete with?
Think of us like a modern HSBC or Citibank, but with all the technology.
Using stablecoins largely?
No, I mean we also kind of plan to support stablecoin, but right now we really focus on building the infrastructure into the existing payment rails around the world and getting the licenses in over 50+ countries around the world.
So you've been growing at this super fast rate, and the question that I always wonder is why one of the big banks either doesn't try to just buy you and take you out of this whole system, or whether ultimately you end up either going public or basically trying to roll up your other competitors. Meaning there's a lot of, it feels like a very fragmented business right now.
Well, I think
space, I should say.
We a company born out of Australia, so that we don't have a big market to tap to like the United States in the get-go. So we had to do all the hard work to connect to the regulator and the central bank around the world so that we can tap into the payment rails locally and integrate them into a global payment network. As we sort of building towards a global future global banking, we really leverage the network we built, and now we start applying AI and all the AI agents on top of that to creating like a full autonomous finance. And it's very hard for the global bank to kind of replicate in that, because you really need to build that
infrastructure. Why is that? Why do you think it's hard for the bank and not for you? That's the thing I never understood, why the legacy banks can't effectively just do this themselves.
I mean, if you think about it, if you, as a customer, you operating in 5 countries around the world, you wanted to onboard with Citi or HSBC, and you need to KYC multiple times in each of the countries. So they have been really build different systems around the world. It's not a coherent single platform that everywhere you go. And the onboarding, the kind of orchestrating, the actual data transformation is really, really complicated in the legacy system. And built in the 1970s, the SWIFT system. And we actually built a global network in parallel to the SWIFT system so that you can moving money real time. And with
you're not moving through SWIFT, so everyone else is moving through SWIFT, and yours is your own.
Yeah, we built a proprietary payment network in over 120 countries, and we processing close to $300 billion this year, and 90% is close real time, and is also a friction of the cost of SWIFT. And we're actually offering to the SMB customers for free when we're moving money around the world.
Help us understand the stablecoin piece of this. And the reason I mentioned stablecoins, are you bullish on stablecoins? You bearish on stablecoins? Because there's a view that the sort of stablecoin layer is what's going to transform banking, and it's going to take out all of the sort of big legacy players because it's going to shrink their margin.
I think there's a general view that stablecoin is cheaper, faster, and more efficient than the traditional fiat rails. I think that statement is kind of misleading a little bit. As you're kind of thinking about payments moving money end-to-end, the end-to-end processing of a stablecoin is actually including off-ramp and on-ramp, right? If you're just purely talking about moving money on-chain, it is real-time, it is kind of free. But when you're looking at the on-ramp or off-ramp, it's actually slower and more expensive than the traditional rails. Where AirWallex is using our own proprietary infrastructure that in this, over 120 countries, we already achieved a real-time money movement in the majority of the case, and we offer it for free to our customers. So you can't be cheaper than free, and you can't be faster than real-time. And I think stablecoin is just going to be an additional rail in the exotic currencies as sort of supplement to the current existing payment system.
It's an interesting and contrarian view. Jack, I want to thank you. Congratulations. We look forward to finding your progress. I kind of feel like an IPO or a big deal is in his future. Nice to see you. Thanks.
All right, coming up, one of the top candidates to replace Fed Chair Powell, maybe the top candidate to lead the betting market. National Economic Council Director Kevin Hassett will join us in the next hour. We'll get his thoughts on rates, affordability, and the state of the economy. That's at 8:10 a.m. Eastern Time. Stop us. coming up, President Trump saying that the Netflix Warner Brothers Discovery deal could be, in his words, a problem. We'll get into some of the potential issues facing this mega deal, next one, the biggest of the year. As we head to break, check out the performance of some of the media stocks. Those understate some of those. Oh, what is that? In 1 month? That doesn't help. Squawk Box returns in just a moment. Netflix's winning bid for Warner Brothers Discovery's film and streaming assets still has obviously a long way to go before it's finalized. Joining us now with his take on the deal, former MTV president and COO Michael Wolff. He's co-founder and CEO of Activate. What did you think when it happened and your overall impression?
It's a must-do for Netflix.
For Netflix.
And there are a couple of reasons. One, for anybody to succeed in streaming, they need two things. They would need, one, global franchises that really work everywhere. And they need large volumes of programming. And so if you look at it, Netflix really isn't competing just with HBO Max. They're competing, their biggest competitor is YouTube. And then you've got Amazon Prime, and then the other is Tubi TV. So people forget about both Amazon Prime and Tubi TV, which is owned by Fox. So it comes down to even the number of titles. So right now, if you look at the comparison, Netflix has 7,000 titles. HBO has 4,000 titles. Amazon Prime has 25,000, and Tubi has 70,000. So this market. They really, in a lot of ways, that they had to have this. And then, earlier you were talking about Peacock and about Paramount Plus. They both have something that Netflix doesn't have. They have live sports, and that's the other place where this game is going to be played. And they don't get live sports with the HBO Max deal.
because it just when you started, it's like they had to have this. Netflix is the the elephant in the room right now in terms of having succeeded in media at the expense of everybody else, all the legacy players. So I would have thought you would have said, if Netflix has to have it, how much did Comcast have to have it? How much did the other suitors need? They needed it even more than Netflix.
Well, they needed it, but the Netflix is the default. Where most people start when they're looking at streaming, they start with Netflix.
Right.
When they look at where they're actually watching, they start with YouTube. In a lot of ways, YouTube is TV for a number of people.
Some people said that this does nothing to help Netflix compete against YouTube, just buying a library of old boomer films.
It does, because there are two different modalities in terms of viewing. If on YouTube what you're watching is short, you're watching, in a lot of cases, under 3 to 4 minutes, and especially even less so now with YouTube Shorts. When you look at Netflix and HBO Max and Amazon Prime and Tubi, you're watching much longer form. You're watching hours, you're watching 2-hour movies. There's different
Are they
viewing.
going to continue to put out the theatrical releases at the same pace that Warner Brothers has to this point? Because there's some people concerned about whether they'll really stick to that or not.
It's not clear, but I can tell you one thing, which is all of the studios, the things that they're going out with big releases are really the top franchise films. And that's going to continue because they need that audience build, and they need the huge amount of advertising and promotion that comes around that. Otherwise, those films aren't as valuable when they're on a streaming service.
What do you make of, we were talking earlier about this, if you are Paramount right now, or you're Comcast, or you're, name the other, Sony even, I mean there's a couple players around. Do you try to do a deal quickly, maybe among yourselves, to try to draft off of this deal, meaning from a regulatory perspective? If there's 2 deals in front of the DOJ, and you're starting to think about competition in that way, that's different than 1 deal and waiting effectively 18 months, 24 months, or whatever, however long you think it's going to take to then figure out how to pick apart the pieces later if you think that deal gets blocked. Do you see what I'm saying?
Yeah, I think that the rationale will be less about getting approval, and it'll be much more about figuring out how they're going to put together a service that really can rival the new Netflix service, especially because it's going to take a while for this deal to clear.
Right, no, but what I'm saying is either you sit around and you say to yourself, this deal is not going to make it, and we're going to spend all of our firepower, all of our energy to try to upend this transaction in Washington and pray that in 18 months this deal doesn't happen, in which case then you're Paramount, you go back at it in some other way, or then Comcast has an opportunity, whatever, or you say to yourself, the train has left the station, I'm letting the train go, and I'm going to actually just now deal with it, and I'm going to try to make my own deal.
I think it's the latter. I think it's really around figuring out. You're not going to wait. I mean, there's the rationale for the deal. I mean, regardless of whether or not it's the whims of the president, you put that aside. The rationale for the deal from a market share perspective, it really is great. I brought the numbers. Here's the percentage of TV viewing. So you've got 46% of TV viewing is streaming. 12.9% is YouTube, 8% is Netflix, 4.8% Disney. Warner Brothers Discovery is 1.3%.
But how are you? But this is a question about definition. When you say TV market share,
right?
Some people say it should be eyeball market share in terms of time spent. In which case, YouTube would be. What number would that really be?
YouTube is 12.9%.
12.9%.
Of YouTube is of eyeballs.
So where in the eyeball is that? You're looking as an eyeball
because
game.
that's really we have to look at.
But then would you put video games in that marketplace?
Well, that's not TV.
Well, but this is why. But what I'm saying is, by the way, some people are going to say it's the theater business, and because that's a specific business, and this can have an impact on the theater business.
You can keep adding it up, but still, this deal gets smaller.
Okay, here's one simple thing. Is President Trump right that Netflix has way too much power already, and that this could be too big? It reminds me of Kroger trying to merge with some other supermarket chain when you got Amazon and Walmart. You're not even defining what the current market or the future market is. You're saying Netflix is not a monopoly right now.
No, it's not.
So do you think this passes regulatory muster when it comes down?
On the merits of it, absolutely, it should pass.
So then when the president says there's problems, way too big, they got way too much control of streaming, he's missing all the other things.
I think he's missing out on the facts. I mean, the facts here are that the company that is quickly becoming the monopoly is YouTube.
Okay, so there's a cynical take. The most cynical take that you could have on this transaction is that Netflix says to themselves, it'll cost, for $5.8 billion, potentially, I can slow everybody else's train down. Meaning, I'm just effectively paying for 2 years of regulatory mishigas. During that 2-year period, I'm going to be able to make all sorts of new shows. People are going to come to us. They're not going to go to HBO or any of these other services because no one's going to know what's going on, and I'm going to win. And that's if that's what it costs, that's what it costs. What do you make of that?
I don't agree with this.
In a sort of defensive posture.
I don't agree with the cynical point of view, and there are a couple of reasons. One of them is the overlap among these services is pretty low. The overlap with HBO Max and Netflix, roughly about 30%. The overlap with Netflix and Amazon is about 60%. So it's not as if they're going to crowd somebody else in at this point.
No, but look, I'm in the creative business. I like to try to make shows and do things. If you were going to sell a show today, who would you sell your show to? In this, right this minute, how much more complicated does it get to sell a show to an HBO, for example, right now, when you don't know what its future is going to be, or maybe even a Paramount or whomever, than it would be to Netflix, because Netflix now looks like they're clear.
The cynical point of view is that you'll sell, if you're a producer of television or films, you're going to sell your show to the people who are going to pay you the most. I mean, right now, this is a buyer's market. It's not a seller's market in terms of shows. A couple of years ago, it was
a seller's market. That, by the way, boy, is that true.
Yeah. So that's not where this comes down to. This comes down to really the bigger issue here is sports. You've got Amazon going very deep on sports. You've got YouTube going deep on sports, and at the same time, both Peacock and Paramount Plus have a lot of sports. And you know who doesn't is Warner. Is Warner Brothers Discovery doesn't have any sports.
Michael, thank you. Look at this. Squawk Box will be right back. Thank you.
Welcome back to Squawk Box, everybody. Ahead of this week's Fed meeting, here's what prediction market Kelsey stands on all of these things. The odds there showing a 93% chance of a 25 basis point cut. When we come back, the state of trade, tariffs, and the supply chain. Port of Los Angeles Executive Director Gene Soroka will tell us what he's seeing in the shipping lanes right now, and the professor Jeremy Siegel on what he's expecting from the Fed and the markets going into the new year. Squawk Box will be back in just a moment. All right, welcome back, everybody. Our next guest is going to share his view on tariffs, supply chain, small business, and much more. I want to welcome Port of Los Angeles Executive Director Gene Soroka. Gene, thanks for being here this morning. I know it's been a bit of a crazy year. I think you yourself have called this a roller coaster year because of the tariffs and other impacts. What's that meant in terms of shipping coming into this country?
Good morning, Becky. It's been unbelievable, and a roller coaster is probably the right description. Ups and downs when hard policy came out, freight really plummeted. When those deadlines were extended on trade discussions, cargo picked up very fast. It's been a story of the workforce and all the people in the supply chain leaning on each other. We'll wind up 2025 with our third best year ever.
In terms of volume coming in?
Correct.
And what is that? What is total volume?
About 10.25 million 20-foot equivalent units, or container units as we call them. Third best year ever, and no other port in the nation has ever crossed that 10 million mark. We've done it now 3 times.
What were the other 2 years? Was it the 2 years prior to
Just
this?
last year being our second place, and in 2022, following all the COVID surge and us buying online, that was our high water mark at 10.7 million container units.
You know, Gene, part of what the president is trying to do is get more things manufactured in the United States. If that's the case, do you expect volume to eventually go down at the ports?
Well, it could be just a flip of the script. And that's the kind of conversations we're having today. If there's more manufacturing and more tiered supply chain activity in the United States, that can be more opportunities for export sales within those companies' supply chains, and we want to be ready at the nation's largest port.
You don't think that globally there could be a movement afoot to try and make more locally, produce more locally by lots of different nations?
Can be, but it really depends on what products, and that's why we need a sector-specific review. We still have 400,000 plus manufacturing jobs open in the country, so it's going to be really important. What type of products do we want to make? How are those ecosystems put together with parts suppliers, as an example? And what geographies, what labor force training do we need? So it's a lot of work ahead, but admirable.
What's happening right now with China and our relationship there, and how has that impacted the volumes of goods coming in from China?
I've been in China twice over the last 6 weeks and probably 4 times this year. The business people just want to know the rules so they can navigate the supply chains, their customers, etc. That became a little bit more clear last month with the year-long pause in these negotiations, reducing the ship fees to 0 and tariffs now having some semblance of permanency, at least over that 12 months. But for us, back in 2018, China was about 60% of our business. Today it's 40 and still dropping.
Yeah, I was going to say, I know of a lot of companies that immediately tried to source from other countries, and that's been a trend that you've seen over several years. So 40% dropping right now?
Yes, that's right. So we're seeing more pickup in Southeast Asia, Vietnam, which you all talk about a lot, Indonesia, Malaysia, Thailand. But what we're also seeing, and was announced in the 15th five-year plan of China, they're not only exporting goods, they're now exporting their manufacturing expertise to these other countries.
The top 5 containerized imports in 2024, furniture, auto parts, apparel, plastic products, and electronics. Is that, you think, going to be the leadership for years to come at this point?
Well, we'll see. We'll see how that policy melds. And, you know, it's interesting because we do discuss often the finished goods that come in through our port that go to major retailers across the nation. But also an equal amount of cargo comes in for American factories, the parts and components, whether it's the automotive sector, appliances, electronics, etc. So that's going to take shape in a different way as well. We'll see what this plays out like.
How have things been going at the post-port infrastructure points? You know, there had been some movements afoot, particularly when there were stoppages with trucks or other issues, or with strikes that had gone on at the port. Where do things stand with that infrastructure surrounding the ports in terms of how you can get things offloaded quickly and sent easily around the country?
Yeah, a lot of progress has been made over the last 4 or 5 years on infrastructure investment. There's still more to come. New terminals, rail and road connectors, as well as inland facilities to help ease that pressure when the volume surges.
Yeah, I remember some of the retailers set up their own, some of the major retailers set up their own places to store some of these things right off the ports, right off site from the port.
That's right. During the peak season just this past summer, Becky, we moved more cargo than we did at the peak of the peak during COVID, and not one ship was backed up. So we've leaned on each other, we've learned a lot, but there's still more investment. We've got a bridge that needs to be raised. We've got more terminal capacity to bring online and more rail product to bring into the port itself to evacuate those containers much more quickly.
Well, Gene, thank you, and thank you for coming on to set today. All right, folks, it is 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin, and among our top stories this morning, Berkshire Hathaway investment officer and Geico CEO Todd Combs is departing Berkshire Hathaway to join J.P. Morgan. He's going to be heading up the bank's new Security and Resiliency Initiative to find direct equity investments in the defense, aerospace, healthcare, and energy industries. Combs is stepping down from J.P. Morgan's board to take that role. It's a part of a series of changes that are taking place at Berkshire Hathaway, with new changes getting set up ahead of Greg Abel taking over the reins of that company in January. The Trump administration plans to unveil an aid package for farmers that includes $12 billion in assistance. Some farmers have seen their financial situations hurt recently by U.S. trade tensions with other countries. And the Trump administration said that it will forgive the remaining $11 million of a civil fine against Southwest Airlines, stemming from its 2022 holiday meltdown.
Meantime, the reported deal that we told you about earlier, it is now official. IBM is buying a Confluent for $31 per share in cash. Confluent is an open source enterprise data streaming platform. Now, IBM says that combination is going to allow it to deploy AI better and faster. The transaction expected to close by the middle of 2026, and IBM CEO Arvind Krishnan is going to be on Squawk on the Street. That's going to happen in the 10 a.m. hour. Conversation you do not want to miss.
Let's look at the futures, which have been marginally better, and it's really just marginally at this point. Dow's only up a point, but the NASDAQ looks pretty strong. Check out Treasuries. 10-year was 415 earlier, 414 right now. For more on this morning's movers, let's get to Dom Chu. Hey, Dom.
Good morning, Joe. Good morning, Becky. Good morning, Andrew. We're going to start things off with shares of Tesla, which are right now lower to the tune of maybe 1.5%. It was not helped by the EV giant being downgraded to an equal weight from an overweight rating over at Morgan Stanley. They say despite its solid positioning in both autos and robotics, its non-auto businesses have been largely priced into its valuation. Morgan Stanley's also being a little bit more cautious on the near-term state of the EV market overall, so Tesla down 1.5%. Another car manufacturer being downgraded by Morgan Stanley, Ferrari shares also skidding this morning to the tune of 1.25%. It was moved to an equal weight from an overweight. They see Ferrari's decision to limit its volume growth as a long-term positive, but one that could pressure growth in the short to medium term. So Ferrari shares not racing, but moving to the downside, 1.25. And then we'll round things out with Five Below. Those shares right now rising by about 2% after it was upgraded to buy from hold over at Truist following its strong earnings beat last week. The analysts there believe they're bullish on Five Below's sales composition and breadth across different segments. They say it will make sales growth more sustainable than they previously thought. Their new target price, by the way, is $216. It's among one of the highest on the street right now. So keep an eye on Five Below. For more on those and other top analyst calls of the day, just head over to cnbc.com/pro, where subscribers get all the context and detail around those notable analyst upgrades and downgrades. Joe, I'll send things back over to you guys.
Okay, thanks, Dom. A little, maybe we won't see, but we'll see you soon.
I'll see you soon. You got it.
I want to get right into the broader markets ahead of this week's Fed meeting. Joining us right now is Jeremy Siegel, Professor Emeritus of Finance at the University of Pennsylvania's Wharton School of Business, also, of course, Chief Economist at Wisdom Tree. Good morning to you. What do you think we are going to hear from the Fed this week? And what do you think we should hear from them?
I think we're going to hear what I call a hawkish cut. I think they are cutting 25 basis points. I think there's going to be dissents on both sides. I think Marin is going to go again for 50, but I think there could be two and maybe even three that want to keep it unchanged. So I think this would be, if that would be the case, the most dissents under the entire Powell nearly 8 years that he has been chairman. Of course, as we note, in a few minutes you're going to have Kevin Hassett. I think in the 70s now as the probability of the next Fed chair, which Trump says he will announce at the beginning of the new year. So I feel I'm sort of a straw man here for maybe what Kevin is going to say, but he won't spill the beans. He won't tell you that he's the man or not. But he certainly has gained in prominence, and what he says is going to start moving the market much more than in the past.
Do you believe ultimately that there's already a shadow Fed, even without a maybe a name only, or without even having a name, that we just know that come this May, interest rates are going lower?
Yeah, I mean, well, you have Marin already there. And actually, I've been relatively impressed with him. He's put out some good papers. I don't agree with everything on him. I actually wish he would stay maybe after January. Maybe he will instead of going back. I think the Fed needs a lot of different voices, and he's certainly one of them. So already he is in the Fed. And yeah, I mean, an announcement of a new Fed official, if it is in January, I think would be perhaps, one of the earliest before the actual change takes place. So, how important will Jay Powell's statements be after that? It's going to be a new Fed. If it is Hassett, it's really going to be a new Fed from what we've had in the past.
What do you think the bond market is going to do if interest rates come down? I mean, this is the one interesting component. I know we spent a lot of time talking about equities, but I've been curious about how the bond market has reacted.
You know what? I don't think the bond market's going to move that much down. I mean, my feeling is, and I've stated this for many months, Fed funds rate, if you go back through the last 75 years, has been about 100 basis points below the 10-year. So the 10-year is what, 4.15 now, approximately? So that would be the low threes. It would not necessarily lower that long rate. Now, what does that mean? That means 30-year mortgages are not going to go down very much. But to say that that's not going to have any effect on the economy is wrong, because there's over $15 trillion worth of loans that are tied to the Fed funds rate. All the short-term borrowing, auto loans, inventory loans, the prime rate, credit card rates, all those short-term rates are one-to-one linked to what the Fed is going to do. So even though it might not affect the long rate, which does affect, is important for mortgages to be sure, it definitely will stimulate the economy for the short end.
So, Jeremy, the bond market is dealing with a lot. Maybe we're cutting into a 3% inflation rate, and maybe, I guess, critics of Kevin Hassett would say that he's not independent enough or more likely to be more dovish than the market really calls for. But you expect those things to come home to roost,
I think
or because that hasn't really happened yet? Do you think the vigilantes will this raise the ire of people that watch it close? I mean, we're at 38 trillion in debt. There's a lot of reasons.
That's for sure. But, when the hints came that Kevin was the front runner, we did not see the long-term bond rate go up. I think the long-term bond rate is going up now because of what is going on, two the factors. I think one is going on in Japan. Certainly, I mean, they're, I think, at a 20 or 30-year new high on their rate, and that's important. And secondly, the fact that the economy is holding out well. The fear that this quarter might be the quarter where those tariffs are going to bite the economy, at least from the early news that we're getting, we're not getting any really significant dampening of sales. So that has been positive. So I don't think it's Kevin. I worked with Kevin. Kevin called me in 2000 and said, Jeremy, you want to work on the John McCain campaign? He was the lead economic advisor, and I was second. He's a wonderful person, a wonderful economist. But I don't think the market should have anything to worry about him.
Okay, Professor Siegel, we're going to leave it there, and we're going to get to talk to Kevin Hassett very, very soon. So thank you.
All right, coming up, he's ready. National Economic Council Director Kevin Hassett's going to join us on everything we were just talking about: future of rates, the affordability battle, and the build-up to the president's pick to replace Fed Chair Jay Powell, plus Apple's leadership, shake-up continuing, what it could mean for the stock. Spark Box returns in just a moment.
Welcome back to Squawk Box. Take a look at futures right now. The Dow up about 6 points. The S&P 500 looking to open about 10 points higher. And the NASDAQ looking to open about 80 points higher, Joe.
And the Fed's set to meet this week. And the White House National Economic Council Director is calling for a 25 basis point cut. Joining us now, the aforementioned White House National Economic Council Director, Kevin Hassett, who's, I don't know, it's growing. He's growing in size. And I think I need to call you Mr. Director now, just the anticipation of maybe even greater things for you in the future. You're at 78% now on some of the things. So we're going to have a wide-ranging talk, Kevin, because it all. Oh, I just said I was going to call you Mr. Director, and then I called you Kevin. But you think about 3% inflation, affordability. Should the Fed be cutting? I think Myron would like even more than 25 basis points. We might have dissension on both sides. What do you think the Fed should be doing right now? Doing more than 25, or should it be a dovish cut instead of what people are predicting? People are predicting a hawkish cut, where they jawbone that maybe this is it.
Well, it looks to me like Chairman Powell has done a good job of herding the cats at the committee. That if you look at the comments that different committee members were making just a few weeks ago, that it looked like they were very evenly split about whether they should cut or not. And I think that Chairman Powell agrees with me on this one, that we should probably continue to get the rate down some, do so prudently with an eye on the data. And so I think that it's an example of, you're managing a committee. The committee was really in diverse opinions before, and it looks like Chairman Powell has done a good job of getting people to circle around the futures markets the right answer.
Well, how restrictive do you think the Fed is right now in terms of away from where it should be? How much would you, let's say you were in the job, what would you be looking forward to in addition to this cut, and then next year? How many more?
I hate to disappoint with the sort of counting of cuts, but I can say that what you need to do is watch the data. We've got a lot of missing data because of the government shutdowns. We're going to get really back-to-back jobs numbers pretty soon. And so, I think that the Fed Chair's job is to watch the data and to adjust and to explain, why they're doing what they're doing. And so to say I'm going to do this over the next 6 months would be irresponsible, really. And I know you don't want me to be irresponsible. I mean, you do sometimes, but not.
No, I do. I do it, and I'm not expecting a lot of answers about whether you are the president's pick or not. But when the president the betting markets went up to 80% after that meeting where you were standing there, I was watching, and you were standing there, and he said, "Yeah, we've got one in the room, a potential Fed." And I've done your face, because it was kind of like. And I was just wondering, what were you thinking at the time? Wow, I got it, or wow, I'm embarrassed, or wow, I wish you wouldn't do this, or I'll just whatever the president wants to do, I'm okay with. What were you thinking when he said that?
First, I support the president 100%, and he's very, very good at playing the drama of things. The thing I got to say though is people are talking about it. I think the markets kind of have it wrong about how the president has a tough choice. If you look at it, Chris Waller is one of the best monetary theorists of the last generation. He's got papers in places like the Journal of Economic Theory that were really the path-breaking papers that showed us how to model monetary policy. Mickey Bowman's the best regulator on earth. I talk to her all the time when I'm trying to think about what about this, what about that, what happened to SVB. And Kevin Warsh is about the most experienced Fed person that there is. He was there during the financial crisis before. So the point is that the president doesn't have a tough choice. He's got a guaranteed good choice. And if I happen to be that choice, I'll be pleased to help him serve.
I want to get into the affordability thing eventually, but I want to get into it this way. We've had a couple of people defend you recently. Brad Gerstner, we just had Jeremy Siegel say you're not going to be a rubber stamp in terms of easy monetary policy, that you're an established economist that would make the right decisions, I guess, to raise. But it does, at 3% inflation, it is on everyone's mind right now, because that's above target. It's much higher than what the Fed would like. And I want to talk about affordability, because suddenly it's a buzzword. Look, 23% of these price increases happened under the Biden administration. Now, the president's been in for not even a year, but inflation is still too hot, and it's above where it was when he came in. So
you would need to think about, as a Fed chief, whether cutting is the right move right now. There's an article in the Journal today, advisors are urging the president to start acknowledging that people are hurting or that there's an affordability problem. He's been saying it's kind of like a Democratic talking point that doesn't exist. How should you be handling this? Because you know the mainstream media is going to play it up. The buck stops with who's in the White House. And even if it was Biden's problem, the president's getting blamed.
Right. Well, the way that in the end, you know, with an eye on the horizon, that this problem gets fixed is that real wage growth goes up enough so that that huge 23% hole that was done by Joe Biden is a thing of the past, because people have money in their pockets, enough money in their pockets to bring their real standard of living back up. The real standard of living in the U.S., the purchasing power of ordinary Americans has gone up by about $1,200 so far this year. If you look at the great data on Friday that said that real wages were up 2.5% over the last few months, you know, that happens when you get positive supply in the economy, and that's what drives growth up and prices down. And so what you want to do is lock that kind of gain in, where you're seeing real wages coming from positive supply shocks. And if you do that, then just as in the 90s when we had positive supply shocks from the computer, and Alan Greenspan was willing to sort of let the economy run a little bit hotter, we have an opportunity with AI and all the productivity that we're seeing to do so again, but to do so with a great deal of caution as you watch the inflation numbers go by. Because the one thing we know is that inflation hurts everybody in the economy, and you saw that in the last election. I'm sure the last election was very much an inflation election.
Yeah, but nobody likes inflation, and I think part of this administration's plan to try and get affordability really within more affordability, I should say, out there, is to lower mortgage rates, right? And have car loans come down. Part of that is the Fed lowering those interest rates. We have seen the 10-year Treasury jump up. It's not a spike, but 4.14 versus 4. On the expectation even that when the Fed is going to cut rates again, we think, to see the 10-year move higher just as it did when the Fed originally cut 100 basis points, it does raise questions about how much control the Fed has over the longer end of the bond market, what that means for things like mortgage rates that are set off of the 10-year. We had Ed Yardeni on this morning, and he said he thinks it may be that the bond market is concerned that inflation is not under control at this point. What do you think?
Well, I think the bond market is still much improved from the beginning of the year. It's fluctuating around a little bit now. I think in part that could be related to the uncertainty over what the Fed was going to do and signal in this meeting. The bottom line is that if we get inflation down with positive growth, like happened in the 90s because of the positive supply shocks, that there's plenty of room for the 10-year to go down. But that's going to require discipline and keeping a close eye on things. But absolutely, when you see real wage growth over the last 3 months of about 2.5%, that's a sign that we're in the midst of a positive supply shock, and that's really good news both for equity markets and for bond markets.
Yeah. I just wondered, is this article accurate? Has some advisors been saying to the president, you got to recalibrate your response to before? And I can remember during the Biden administration, when the Biden administration would blame the feeling that the economy wasn't going well on the media. I used to say that's just patently absurd. But that's kind of what we're hearing now, that, there's, almost, ignore the public's feelings about how, they feel about the economy at your own peril. And I'm just wondering, did that ring true to the president, that maybe he needs to he's in the White House. He may not have caused it, but the buck stops with whoever's in the White House right now.
There's a huge amount feeling. There's a huge amount of positive news that the president is going to be breaking this week about the economy. We've got a person who actually approached the studio with me, walked with me, who's tracking the openings, the groundbreakings for the new factories that are, in the trillions of dollars of announcements that the president's been making. And we're up to almost 30 of those that actually the groundbreakings have happened. And so there's a lot of positive news that's positive for people's jobs, for people's incomes, and for inflation. And President Trump is just going to go out there and remind people of that. But in the end, again, going back to the eye on the horizon, that President Trump's economic policies were profoundly popular just before COVID in his first term because he had $6,500 of income growth after the big tax cuts. And so right now we're going into next year where the typical person who's got no tax on tips, no tax on overtime is probably going to see an extra $1,600 to $2,000. A lot of that'll come as tax refunds in the beginning of the year. That kind of stuff is going to make it so that people are going to look at their wallets and say, oh boy, this guy's really making me better off. And in the end, that's more important than any poll. The final thing I got to say is that we did look at a lot of the sentiment, the softer indicators over the last few weeks, and we found a pattern that I'm sure you guys could find a chart that would show, which is that consumer sentiment it tends to crater when there's a government shutdown. And so we have sort of back-to-back 4% quarters coming in, and then we got the government shutdown and all the chaos related to that. And the sentiment indicators went down, but the hard indicators really didn't. And that's a pattern that we've seen over and over again.
Kevin, the Democrats would say the shutdown was entirely about these subsidies, even though that's what they picked to shut down the government over, obviously. But you can't talk about inflation if you don't talk about health care and rising costs that are across the board in health care. What do you think, not just Republicans, I don't know if it could ever be bipartisan, but what should the government be doing about these subsidies right now? Should there be, in good faith, bipartisan talks about extending these subsidies or not without guardrails? How do you think that's going to go? Because it all comes into the affordability discussion.
Well, the president and Republicans, brought forward two big policies in the Big Beautiful Bill. One, about $50 billion to rural hospitals, and then about $30 billion for cost sharing to help the people who might be affected by these increases that were really a Democratic policy because of the expiration of the extra COVID subsidies. And so the cost sharing stuff was thrown out by the parliamentarian, but it shows that there's room for negotiation about something that could be good for people. I mean, we obviously want lower health care costs, but also we got to get the fundamentals down. And don't forget that for 2 years in a row under President Trump, we were able to get the consumer price index for drug prices to go negative for the first time since World War II because of all of the hard work we did working with drug companies to make drugs cheaper for Americans. And you've seen how much hard work we're doing again on that, and I would expect that we're going to see another third year of a negative CPI because of that. And so we got to get the fundamentals right. And I'm going to see Senator Thune in the White House today. I'm sure there'll be some discussion about how we go forward with the healthcare debate up there on the Hill between now and Christmas.
Some other things are on President Trump's mind this morning. Kevin, just posting on Truth Social, there must be only one rule book if we're going to continue to lead in AI. We're beating all countries at this point in the race, but that won't last long. If we're going to have 50 states, many of them bad actors involved in rules and the approval process, there can be no doubt about this. AI will be destroyed in its infancy. I will be doing a one-rule executive order this week, and you can't expect a company to get 50 approvals every time they want to do something. That will never work. Any comments on that, Mr. Director?
I've seen a draft of what the president's talking about. It's been a top priority for him to make sure that we win the AI race, and I think that the order that he's promising to sign this week, I guess he's reviewed something close to a final over the weekend, is something that's going to really help the AI companies understand what the rules of the game are. As you know, that there are some states that want to regulate these companies within an inch of their lives, and then when they make a misstep, fine the heck out of them, just so that the states that are going bankrupt because of their profligate governments can take some money from the AI companies and so on. And so that's a game that President Trump isn't going to allow people to play. And this executive order that he's promised to come out is going to make it clear that there's one set of rules for American companies in the U.S.
Hey Kevin, one other question we've been batting around the table this morning was the president said just yesterday that he was going to be part of making the decision about this Netflix transaction with Warner Brothers, and at least the comment that we were making in the past is that the president, this president and presidents prior, I believe have never at least publicly declared their involvement in these decisions. They've historically been left to the antitrust department with inside of the Department of Justice. So how different is this, and how should we think about that?
Well, I don't think it's just rare for presidents to have opinions about big society-changing mergers, but in the end, the Justice Department is going to study things like the Herfindahl Index, the concentration in this industry, the amount of competition that is reduced because of this big merger, and what the responses of all the other companies that are playing in this space might be. That's going to be something that goes on for quite a while, and I think the president is just very interested in making sure that there's a lot of analysis to make sure that we make the right choice.
Do you think that there's more to it now, though, the relationship that a company can have with the president than in past administrations? Is it? I think that's what Andrew's alluded to. Is it different than it's been in the past? Do you think the influence that President Trump?
I haven't been inside any other administration than the Trump administration, but I can say something about the Trump administration is that it's about the most transparent administration I've seen in my lifetime. And so what the other guys were doing probably, is they weren't telling you. And so it's harder to sell. But Mr. Trump lets you know how he feels. And that really, really makes him a wonderful person to work for. I can remember when I came in to work for him the first day in 2017, he sort of patted me on the back and said, "Don't worry, a lot of people are going to be grumbling at you because you're coming out to the White House, and I got your back." And he's had my back the whole time, and I really respect him for that.
Yeah. I think it's sometimes so transparent, people are like, oh, I can't believe what they're, no, I'm just kidding. Thanks for all your time today, Mr. Director. I don't know what we're going to be calling you in the near future. As long as we call you to dinner, we don't care what we call you. But, all right, see you later. Thanks a lot, Joe. Great to see you.
All right, when we come back, news of a historic dividend from a big insurance player. We've got the details on that story right after a break. Plus, we will speak with the top Apple analyst on the latest possible executive departure from the tech giant. Squawk Box, we'll be right back.
some news from the insurance industry. Contessa Brewer joins us at the table this morning with more. What's going on?
Good morning, guys. Well, we can exclusively report this morning, USAA is set to return $3.7 billion to its policyholders. 14.2 million of them, mostly service members, veterans, and their families. USAA is an association, and so its customers are also its shareholders. This is the largest payback in the company's 103-year history, and that's in spite of the considerable exposure USAA had to the California wildfires. CEO Juan Andrade talked with us exclusively about the historic reward to customers.
Some of it is the way we are doing our risk management within the company, the way we are handling our claims, the way that our members are participating in loss mitigation programs with us, whether it's on water flow, leakage valves, or electronic device that we can put in your house to detect surges, those kinds of things. All of that helps at the end of the day.
Dividends are common in life insurance, and this year has been a doozy. Northwestern Mutual issued a record dividend to its policyholders of $8.2 billion, and it says it's the largest ever across the industry. It announced an even bigger payout for next year, $9.2 billion. And this year, Mass Mutual and New York Life also issued the largest dividends in their company's histories, $2.5 billion each. But look, the rebates and the refunds are less common and they're more modest in property and auto because there's a lot of volatility and risk. We did see major rebates, of course, during COVID when people stopped driving, but last month, Progressive announced $1 billion in refund credits to its Florida customers for the last 3 years. That was mandated as part of the state's insurance reforms that reduced litigation costs and stabilized that insurance market here. But this is really notable to see it going back, this big of a dividend in property and auto.
So one of the questions I think is, what does it mean for the broader property insurance industry at this point?
I think you're going to see efficiencies in operating costs driven in large part because of technology and AI is coming into play. It's helping with claims processing and things like that. But Juan Andrade told me that the big 3 things keeping him up at night are still the costs of lawsuits. They're rampant across the United States. The severity and the frequency of storms. You get hailstorms that produce an amazing amount of damage. Those are hard to predict. And that's where mitigation comes into play here. And also he's looking at inflation and the cost of tariffs and what that does to the parts, labor, materials that you need to repair and replace damaged goods. All stuff that is really important. But home insurance rates have gone up 70% on average over the last 5 years. Still predicted another 8% for next year by totality and 8% the year after that. It is becoming a very big cost consideration when you're buying a home.
Yeah, the inflation that kind of worked its way through the pipe has not completely made its way through the pig in terms of the insurance companies trying to recoup some of the losses that they had because they couldn't raise rates immediately when insurance put auto parts and lumber and labor and all of those things that we saw much higher prices. They had to go to each individual state regulator and ask to raise rates. That's part of what we're still playing catch up on.
That's exactly right.
Does it have anything to do with not a single hurricane made landfall on this year? It's the first time since 2015, but there was a 12-year period prior to that where we saw
that is such an interesting point because if you don't get a major landfall from a hurricane, that saves a lot of money.
Yeah.
Verisk just pointed out this really interesting paradox in the third quarter, which is claims had plummeted, the volume of claims, down almost 30%. I think it was 28.5%. But the costs of those claims skyrocketed. It might be one of the most expensive third quarters that they've seen in a very long time. Okay, so when you look at that, why is that? It's because people have moved to places where there is a lot of severe weather. Think about the coasts or California.
People like water.
They do. They like to live in nice places, and that's expensive.
I remember Warren, the year that we went through the alphabet storms. We started another alphabet, and there were some bad ones. He was like, watch what happens to the profitability of insurance companies because they all are able to raise rates after something. President Trump was kidding the other day with Kristi Noem and said, you cured climate change. We had no hurricanes this year. And I've actually seen guys that do an imitation of President Trump saying, got together with Mother Nature. She's a terrific person. I've known her for a long time. we were able to arrive at it's just really funny. Weird. I guess that's why it's called insurance. You just never know. It's called risk.
It is about, it's a lot about risk.
All right, coming up, former New York Fed President William Dudley joins us on this week's rate decision. Stay tuned, Squawk Box will be right back.
All right, welcome back, everybody. Markets are gearing up for the Fed's final policy meeting of the year. It's set to kick off tomorrow, and joining us ahead of that is Bill Dudley. He, of course, is the former New York Fed president. Bill, welcome. It's great to see you this morning. The market is betting that we are going to see another 25 basis point rate cut. You think that that's the case?
I think it's almost certainly the case. When John Williams went out and basically made the case for 25 basis points, and no one else at the Board of Governors, including the chairman, contradicted him, it's pretty obvious that that's what they want to do at this point.
There does look like there could be more dissension than we've seen at any meeting to date, at least in this part of the Fed rate cutting cycle. As many as 5 different members have sounded pretty hawkish. What's the debate between the hawks and the doves at this point?
The debate is basically about 2 things. Number one, what's the greatest risk to the economy? Upside pressure on inflation or downside risk to the labor market? So which risk should we be most focused on? And 2, what's the current stance of monetary policy? Is it restrictive? If you start with the presumption that monetary policy is restrictive and that the risk to the downside on the labor market dominate, then of course you want to cut rates. You want to make policy less restrictive. But if you think that the risks are maybe more evenly balanced between inflation and the labor market, and you think that monetary policy is not restrictive, then you obviously want to opt for keeping rates unchanged at this meeting. That's really what the debate's about.
We know that that debate is there. How vitriolic of a debate is it? Or do you think that these are people who see things fairly evenly? They just maybe find the balance weighing one side over the other. I'm trying to get at how much of a common ground do you have on the Fed, and how difficult or easy it might be for a new Fed chair to try and sway some of those members?
I think that it's not vitriolic at all, because I think the arguments are pretty reasonable on either side. I think you can make a strong case for either side. We'll find out in the fullness of time whether monetary policy today is actually restrictive, and we'll find out whether the risks of the labor market exceed the risks of inflation. So I think the arguments on both sides are reasonable. So I don't think there's going to be a tremendous amount of discords. There will be some dissents. Stephen Moran will probably push for a 50 basis point rate cut. And I would imagine Jeffrey Schmidt of the Kansas City Fed will opt for no interest rate reductions, and maybe another one or two Federal Reserve Bank presidents could join Schmidt. But this idea that Powell is losing control of the Federal Reserve, I think that's just totally misplaced. This is a very difficult environment where the Fed is missing on both sides of its dual mandate, and the outlook is very uncertain, especially given the fact that we haven't had much in the way of official government economic information. So I think in that environment, it's reasonable for people to disagree.
I wasn't suggesting Powell's losing control of the Fed. I'm trying to get a handle on what you think a new Fed chairman next year might be able to do in terms of influence.
Well, I think at the end of the day, the Fed chairman obviously does have a lot of influence. It basically controls the staff, controls the agenda of the Federal Open Market Committee meetings. But in terms of the actual votes, they only have 1 out of the 12 votes. And so that can influence the committee. Maybe you could get an additional rate cut. But if the committee thinks that the economic information implies that the federal funds rate should say at 3.5%, 3.75%, and the chairman wants to go to 3%, it's just not going to happen. So at the margin, maybe you can get an additional rate cut, but you're not going to be able to get a lot more rate cuts if the committee thinks that's not appropriate given the economic situation.
We just had Kevin Hassett on from the White House. Obviously, he's seen as the front runner right now. What do you think of Kevin Hassett in that position?
Well, I think it's, I certainly wouldn't disagree with the notion that he is the most likely candidate. And, I think at the end of the day, once you're in the seat, you're going to want to do what you think is best to achieve the Fed's mission. So while today he might think that the significant rate cuts are appropriate, I think once he's actually at the Fed and working with the staff and the other members on the Federal Open Market Committee, I think he'll probably be, maybe a little bit less enthusiastic than he is today when he's sort of campaigning for the position.
The FOMC earlier this morning, Ed Yardeni called them the Federal Open Mouth Committee. We know that the Secretary of Treasury, Scott Bessent, has said that he would like to remake the Fed, the Federal Reserve in some ways. As a former Federal Reserve member, what do you think of that?
I think there is a lot of chatter, and it gets a lot of attention. So I certainly think that the critique is valid, but I guess the question I have is sort of what harm is caused by this information. I think people who are focused on the Federal Reserve understand that the people you really want to pay attention to are Chair Powell, John Williams, Phil Jefferson, the two vice chairmen, the vice chairman of the board and the vice chairman of the Federal Open Market Committee, and follow what they're saying. And yes, other people are going to have their opinions, but just don't overweight them. And so I think that I think the Treasury Secretary's critique is accurate, but I think the consequences of this chatter are pretty small.
Okay. Bill Dudley, Bill, thank you for joining us this morning.
Thank you.
Okay. Coming up, a lot more on Squawk Box. Details on the latest executive to consider leaving Apple. We're going to talk about what that departure could mean for the company's products and ultimately its investors. Stay tuned. You're watching Squawk Box, and this is CNBC.
Apple experiencing a significant wave of executive departures. The latest news, Bloomberg reports that the company's senior vice president of hardware technologies recently told CEO Tim Cook that he's thinking about leaving. And joining us now, Amit Daryanani, Evercore IT hardware networking equipment senior analyst, who just raised his price target to 325 from 300. So at this point, you're like most of the people we've talked to. This is not, at least near term, a reason to become more negative on the stock, these departures.
Yeah, listen, I would say if you break out the exits, and I will concede, it creates uncertainty, it creates headline risk. I get that, right? But again, half of the folks that have left really have been because they're retiring. Probably a good thing that you're getting some new blood into the company. The other half has been Meta and OpenAI and other companies poaching talent. So there's been a bit of a shift. And I think part of that is driven by just retirements that are happening. There's also a strategic reset, I would argue, Apple is doing on Apple Intelligence. That's potentially driving some changes. And then I think Jeff Williams, the COO, retiring last year, did have a bit of a cascade impact. So I think there's a couple of things happening, but we think it's a good sign that there's some new blood, new thought process coming into the company.
That's an interesting take. The point we made earlier was maybe near term, Apple continues to do what it does. That phone cycles and the 17, the iPhone 17 was a great upgrade cycle. And how many times in the past have people said, well, Apple needs something new, it can't just keep doing this, and the ecosystem got bigger, and they just minded their P's and Q's, and the stock, you can see the return that it's had, and it's right near a high, and you think it's even going higher. Does AI ever matter? And you point out that in March or spring of 2026, we get Siri 2.0. At that point, does it matter?
Listen, I think if we can get AI or Apple Intelligence, as they would call it, correct, Siri 2.0 finally does what it was supposed to do, then I think it starts to matter. Because what all of that could do eventually with Apple Intelligence is it helps you increase this monetization of your iOS space. And to your point, everyone that wants to own an iPhone at this point in the world probably has an iPhone. The question for Apple is how do I get monetization per iOS user? We think Apple Intelligence, Siri 2.0 could help you get there. And I'm not sure what this application will be, but at some point, if AI works, you will have an application like FaceTime when it came out back in the day, and everyone had to get a new iPhone because we needed a front-facing camera. I think you'll have a moment like that with Apple Intelligence at some point on the road that can not only trigger services monetization, but also a hardware cycle.
You said new blood is always good. Look back at the departures we've seen in the last, 3 months. What was the most significant one where it actually made you think that's a big loss at this point? And which ones were sort of, we can easily replace this person? Was there one in particular that was a real issue for Apple?
Yeah, I mean, listen, I would say the head of AI, John G. leaving or retiring, they're hitting a reset. That sort of makes sense along with some other stuff that happened here, right? Alan Dye, who's the head of human interface design, the industrial design team at Apple, him leaving probably a bit of a negative for Apple right now. So that one I would say was a bit of a negative to Alan Dye leaving. If the rumors, which I think there are rumors right now, of Johnny Stroji, the head of semiconductor, the chip design at Apple leaving, that would be a very material dynamic as well. So I'd say that's worth monitoring as well as well.
What's the? I'm not. I didn't see those rumors. So when were those out? And you put credence in those rumors? Who was this? And when did you see something that indicated that he might leave?
There was stuff over the weekend that said he's potentially considering to leave. He's the head of hardware design, so he's going to design that Apple.
Okay, and that would be concerning, but you don't know at this point whether that's true or not.
It's way above my pay grade to figure out if it's true or not.
Okay. Very good. All right, Amit, we appreciate it. Thank you. See you later.
Thank you.
Next on Squawk Box. The story's breaking on Squawk Box that we need to fix. Oh, no, that you need to know about, including President Trump's big moves on AI and breaking funding for American farmers. We'll have that one. Probably you.
Breaking on Squawk Box this morning, President Trump posting on social media that he's going to issue an executive order this week to have one federal set of rules for AI rather than state regulation. He said AI will be killed in its infancy if there are 50 different sets of laws. Meanwhile, IBM buying open source enterprise data streaming platform Confluent for $31 a share. CEO Arvind Krishna is going to be on CNBC in the 10 a.m. hour. You don't want to miss it. And the White House saying that President Trump will release a $12 billion aid package for American farmers impacted by trade policies. That announcement expected this afternoon.
Right, the White House looking now for ways to bring down the high beef prices. Wall Street Journal reports the administration officials have gathered several times to talk about the topic and are considering reopening the southern U.S. border to imported Mexican cattle after it was closed because of parasite concerns. The Journal also says President Trump told Nebraska's governor he wanted to import more beef from Argentina in order to lower prices. We've heard about that, not popular with ranchers. In an executive order published over the weekend, the president created food supply chain security task forces to address risks from price fixing and anti-competitive behavior.
And Treasury Secretary Scott Bessent telling CBS that he recently sold his interest in a soybean farm to comply with the ethics committee, the agreement that he signed back in January when he joined the Trump administration. That move comes months after the U.S. Office of Government Ethics told the Senate Finance Committee that Bessent had failed to adhere to certain terms of that agreement aimed at avoiding potential conflicts of interest. According to financial disclosure forms, Bessent's land generated annual income of up to $1 million, but he does say that he very recently sold that position.
Quick final check on the markets this morning. We've got the Dow up about 11 points, the NASDAQ up about 78 points, and you're looking at the S&P 500 up about 10 points. Right now, the Treasuries, will show you the 10-year real quick, just at about 4.1, 2-year at 3.5. And let's take a quick look at oil, and I want to show you crypto if we could, if we've got a moment here. You're looking at WTI crude at 59.46. And then Bitcoin sitting just at $91,000. Make sure you join us tomorrow, folks. We got a big show tomorrow. Squawk on the Street begins right now.
Good Monday morning. Welcome to Squawk on the Street. I'm David Faber, along with Sarah Eisen and Mike Santoli. We are live from Post 9 at the New York Stock Exchange. Jim and Carl taking the morning off. Let's give you a quick look at the futures to get ready to set you up for the trading day ahead. Not to mention, of course, the week ahead. You can see looking slightly higher as we get to a half hour from now, trading for the morning. Of course, so much going on in terms of the markets. Not to mention, of course, M&A as well, which.
It's a good thing you're back.
We've been focused on. Yes. Thursday and Friday were busy days from the beach, so to speak, of course. Meanwhile, the markets as well.
Drifting up toward the old highs, that's been the rule. And, obviously also Fed meeting anticipating the market playbook that's being executed right now is buy banks and cyclical stocks because it seems like you're going to get a Fed rate cut into a potential reacceleration of the economy. Whether the market has that right or not, that's the clear message being sent. We are also seeing longer-term yields leak a little bit higher, about 4.15 or so on the 10-year, but it's happening with credit markets pretty calm. So I think all in all, it's a pretty comfortable setup, and people think they have a little bit of an upside bias into year-end. Didn't work last year. The same set of things. We actually had a sloppy close to the year for the S&P, and of course the first quarter gut check and a recession scare. But obviously, with some basis on the policy front, people are a little more comfortable.
I just note that there's a little bit of a backup in Treasury yields. We saw that last week as well into this Fed meeting. There's some expectation that we'll get a so-called hawkish cut from the Fed, which is almost 100% chance now in the market that the Fed cuts, but will they raise the bar for cutting again in January? At this point where it stands, penciled in cuts, we only have really one as far as the median dots go. We'll get a new dot plot, so-called projections from the other Fed members this week. And let's see what they say and what they pencil in as far as more potential cuts. As the unemployment rate rises, not to alarming levels, but that trend is part of their mandate, but also inflation stays stubbornly high.
I mean, the last Fed meeting, or when Powell came out and said the next cut is not a foregone conclusion, the market was already pricing very high odds of getting that additional cut. Right now, we're not really doing that. Yeah, so he felt like he had to drag the market away from the wrong spot. That's not really the case right now. I also don't think it's really going to be hawkish. It might just be non-committal. It's going to be data dependent.
It shouldn't be
it's going to be
committal,
that
but
kind
they're
of.
going to get a lot of data.
Exactly. Yeah.
And including tomorrow, we're going to get October JOLTS report, job openings. Not necessarily going to be super definitive for the Fed, but it will be another input that they have, given that they don't have the October jobs report. The last jobs report we have is from September.
Yeah.
So what do we want to be focused on here in these last couple of trading weeks of the year, Mike?
I mean,
other than the Fed. You know what, guys, I want to stop you there because I do want to update our viewers on breaking news we have this morning involving, of course, that enormous deal that was announced on Friday in which Warner Brothers agreed to sell itself to Netflix. Obviously, a lot of reporting throughout from me on Paramount and their frustration with, in fact, the process itself. And we can now, according to the wires and a press release, tell you that Paramount is now launching a tender offer to acquire Warner Brothers Discovery, $30 a share, all cash. Now, what this will have the effect of doing essentially is making the shareholder vote on the Netflix transaction the key, where shareholders will be making their voices heard conceivably. We don't even have a date for that shareholder vote. Typically, it can be 3 to 4 months after the announcement. Obviously, we've got to wait for the merger proxy and get the background, at least the background according to Warner Brothers. But what we do have now is the background essentially according to Paramount, and the fact that throughout in this press release they feel as though they were not given the attention they deserved and were not treated on equal footing to Netflix. And hence, in bringing a tender offer of this type to shareholders, they are going to share everything with those shareholders of Warner Brothers in the hopes, of course, that they will put pressure on the company in some way and or at least indicate that they're unwilling to vote in favor of the current transaction with Netflix. I should point out as well that as these things go, when you file a tender offer, you are then put the company you filed against in the position of having to file a D9, just looking for some of my notes here, which requires them to come out with all the reasons why they decided what they did. And so we're going to get a lot more explication, let's say, around the process itself and see whether, in fact, it's supportive when Warner Brothers responds as well of the idea that they were disadvantaged, Sarah. I want to also say that David Ellison, the CEO of Paramount, who obviously has spearheaded this deal, will be joining me for an interview momentarily, right here from the New York Stock
Well,
Exchange.
that'll be good to hear from him.
It certainly will. So we're going to be speaking with him in a few minutes to obviously get a lot more from their side of the story. But, I mean, stepping back, we're talking about an almost $100 billion fight now over this company, being that the Paramount bid, remember, and I've made this distinction all along, but it's worth doing over and over again, is for the entire company. And so it's worth some $96 billion, $41 billion backed by Larry Ellison, the remaining $54 billion or so from B of A, Citi, and as well Apollo playing a lesser role in terms of the dollar amount. So they say their financing, Sarah, is completely and totally secure. And again, they feel as though they've been completely disadvantaged in this process, perhaps not getting enough attention from the board that they felt that, or at least the board being fully informed in a way to make a decision. Because so much of this comes back to the antitrust that we've talked about, and the fact that conceivably Netflix is going to face a very significant battle on its hands that could stretch out over a long period of time to get this approved, if they are able to, from the DOJ, versus what Paramount says is a much simpler regulatory process for it, in which it believes it can get a deal done in as little as 10 months. And so they've been arguing $30 of cash for the entire company versus the $27.75, 85% of which is cash, the remainder in Netflix stock. And then this stub, as we call it, of global networks, does not equal, given, of course, as well, the uncertainty introduced by the antitrust review, $30.
Yeah, I mean, they're not still going down quietly. They think that they have a better bid and they have a better chance of it happening. Last night, President Trump commented on this at the Kennedy Center, where he said, there's no question about it, this could be a problem because of the size of the combined market share. So we kind of knew that Trump might be skeptical of this deal, and we had some indications and some reports that the administration would look at it with a lot of scrutiny. But I don't know, from an antitrust perspective, I haven't heard anybody come out in favor of this deal or argue on the merits of this deal.
No, not to mention what has been sort of, I think, the growing concern in Hollywood itself for the deal, whether it be some of the bigger names along the likes of Spielberg and so many others.
The movie theaters
are very much concerned about really what this would mean for the industry itself.
I don't think they'd be overjoyed about Paramount and Warner either, if they're in the industry.
All roads lead to a consolidation, and obviously one of the key reasons that Paramount is pursuing this is the $6 billion in cost synergies that they believe that they can wring out of a combination with Warner Brothers. So you're right, Mike. Either road is not necessarily a positive, but there does seem to be a belief that perhaps what it would mean in terms of the structure of the industry overall, and just how many movies would Netflix really fully introduce at the box office for the typical period of time that movies run, I think are some of the questions that we'll be able to entertain with Mr. Ellison.
I mean, interesting to see the stock reaction. So not surprising to see Warner Brothers higher again, right? It just keeps going up as the bidding war heats up here. Paramount higher, so maybe the market thinks there's a chance here that they, can pull this off, right? Because we saw that Paramount was lower when Netflix won the deal on this concern that they don't have the scale, and then Netflix getting downgraded over the weekend. Rosenblatt Securities was one. I think others have looked skeptically on just what it appeared to be a prolonged period of uncertainty and pressure on the multiple.
Without a doubt, and that was one of the key things we discussed at Mike on Friday as well. What would happen to Netflix's multiple over time? What does this signal about their view of their business longer term? Not to mention, where does this put them? Now, that said, if it's a 2-year process and they still don't succeed, have they in some way frustrated a competitor in a successful way for them? Despite what it might be costing them $5.8 billion, that's a reverse termination fee that Netflix is obligated to pay should this not receive antitrust approval. By the way, Paramount, in its deal, has offered $5 billion reverse termination fee as well. And there's a couple of other key things as well in terms of what Netflix did or didn't do when it comes to antitrust that we can get to. But let's leave it there for now because, of course, coming up, we do have Paramount Skydance Chairman and CEO David Ellison, who will join us for an exclusive interview right after this. Squawk on the Street. I'm David Faber, and I am here now with David Ellison, the Chairman and CEO of Paramount, which this morning has launched a $30 all-cash tender offer to acquire Warner Brothers Discovery, a company that I believe you bid at the last count 6 times for.
Correct.
But did not come up with the prize that you sought, hence this morning's news. David, why are you doing this?
So look, we're really here to finish what we started. Like, just to kind of take you through the road in terms of how we got here. On December 1st, we made an offer to acquire Warner Brothers Discovery to their board. Had a conversation with David Zaslav. He came back with a bunch of issues. We then on December 4th sent in a bid that addressed every single one of them that is superior to the bid that they signed up. Our offer is $30 a share, all cash, $41 billion in equity that's backstopped by the Ellison family and Redbird, $54 billion in debt with commitments from Citi, Bank of America, and Apollo. We have faster regulatory certainty to close, and our deal is pro-consumer, it's pro-creative talent, it's pro-competition, and we believe that when you actually, to further contextualize, our $30 in cash, or sorry, $30 a share, is basically $17.6 billion in cash more than the $23 in share that they signed up.
Right. Well, you're not obviously paying. You're paying for global networks. Their deal doesn't involve paying for global networks, which are traded as its public company. Which, by the way, also figures very prominently here in trying to determine what the overall value of the respective deals are. Because there are $27.75, including obviously the stock portion of their deal, but it also includes, well, what's global networks? Is it a $2 stock? Is it a $4 stock? What do you see? Because that can go a long way in terms of at least determining why the board may have said, no, we think Netflix is superior.
So respectfully, we think that basically that's valued at $1 a share. I think if you
Why $1?
So if you look at Versant and where the median of all of this is, it's about 4.5 times. You have to get to 5 times equity value or more to basically get to the kind of $3 plus that you're claiming. But again, I think the most important thing to go back here is, look, we're sitting on Wall Street where cash is still king. We are offering shareholders $17.6 billion more cash than the deal that they currently have signed up with Netflix. And we believe when they see what is currently in our offer, that that's what they'll vote for.
Were you told during the process that cash is king?
Yes, absolutely. What we were told repeatedly was that they wanted all cash. We delivered all cash. We were asked that they wanted it to be fully backstopped by the Ellison family and Redbird. We delivered it fully backstopped by the Ellison family and Redbird. And when you look at the scale of the companies, right, look at the scale of Netflix. 310 million global subscribers. When you combine the #1 streamer with the #3 streamer, that creates a company that has unprecedented market power, north of 400 million subscribers. The next largest competitor is Disney, with just under 200 million. That's bad for Hollywood, that's bad for the creative community, that's bad for consumers, and look at how the market is reacting to this deal. We are literally seeing talent talking about the death of movie theaters. We've all heard Ted Sarandis' comments about how he feels about the theatrical experience, and you've also seen, in our deal is also offering more cash for shareholders.
So you made that point, and obviously it is offering more cash. So if they said cash is king and then they were willing to take stock, obviously only 14 or 15% of the overall consideration that Netflix is offering. Nonetheless, do you feel as though you were disadvantaged in this process? And if you were, what can you cite to prove, in fact, that somehow you were not on a level playing field in having your offer considered with their offer?
So I do think that there was an inherent bias towards us. If you look at it, we
an inherent bias towards them.
Correct. We put the company in play.
Yes.
Which again we don't think was particularly taken well.
No, I think that actually starts you off on a potentially bad foot when you're making an unsolicited bid for a company.
But look at what we did with our last offer. We literally submitted $30 a share in cash. Never got a phone call. Never got a single markup of basically our merger agreement. Never got a response. And that's why we're here today. We're here to finish, to make sure that we can take directly to shareholders the offer that we sent to the board.
So you never got a response from that last
Not one time.
And did you indicate that that was best and final at the time, or perhaps say that it wasn't?
No, so actually the last communication I had with David Zaslav is I made it incredibly clear in text message, this is all going to be public for everybody to see, that we addressed all of the issues that they asked for, and very specifically that our offer was not best and final. And so when we literally delivered a $30 per share all-cash offer, we never heard back.
You never heard back from them at all. You know, a lot of this goes back, of course, and you mentioned it already, to the perceived risks of antitrust rejection, certainly on the Netflix side. it's still an issue as well for every deal, including your own, perhaps, state AGs and the like. It comes back to Donald Trump oftentimes because of sort of his unique place in this administration, and he even indicated yesterday at the Kennedy Center he would be involved in this decision. Have you got any assurances from him in the sense of your own deal would pass any trust muster, and or that Netflix's transaction would not?
So, look, David, I think you have to look at this basically on the merits, right? We are trying to combine the number 4 streamer with the number 5 streamer. When you put Paramount and HBO Max together, you get round numbers 200 million subscribers. That creates a streaming service that is competitive with Disney. When you put number 1 and number 3 together, you are handing Netflix unprecedented market power, which is anti-competitive in every single measure, every single metric you can measure. And we think that is bad. Again, it's bad for the consumer. It's bad for the creative community. This deal, if it is allowed to move forward, will actually be the death of the theatrical movie business in Hollywood. We're sitting here today trying to save it.
Understood. It's going to be a little while. This is going to be a fight that stretches perhaps until the shareholder vote, until shareholders are heard from, unless their voices are heard prior and Warner Brothers makes a different decision. I am curious, though, you're going to war here, so to speak, with Netflix, an incredibly well-endowed company that has the ability, it would seem, to choose to raise its offer even more. Why bother when they conceivably could simply come back and raise their offer if they need to?
So again, I think when you actually look at what the highest offer that is currently on the table, $30 in cash, the last time I checked, beats $23 in cash. And that's $17.6 billion in cash more so, as we've said. We believe we have the superior offer. We're taking that directly to shareholders, and we think that's what they're going to vote for.
I know, but that's not a fair comparison. I mean, there is stock. Netflix stock is worth, it's within the collar. It's worth at least $3.50 a share to the deal. I mean, saying our cash versus theirs doesn't seem a fair comparison, David.
So probably respectfully, I disagree. I mean, look, those shareholders can basically go buy Netflix Netflix stock in the open market if they want to. And they're going to be sitting there with a linear stub that's valued at $1 a share, which is a business that's in secular decline, that without the synergies that's basically created by our deal, they will ultimately be holding something that is not worth anything. By every metric you can look at, we believe that our offer is superior to shareholders.
Right, and again, we're going to get a lot of debate around the value of that stub, because even though it's an incremental, let's call it, difference of $2, it can go to the value judgment. Let me ask you about Paramount, though. If in fact you are successful here, you're taking on a lot of debt, right? I mean, and you're diluting your own shareholders significantly through an inclusion of what, $41 billion in equity. Isn't that correct?
Yeah, but look, we're the largest shareholder of basically the Paramount Class B common stock.
We being
the Ellison family. We will also be the largest investor in this deal. We're literally sitting here today because we are fighting for our shareholders, and we're also fighting for the shareholders of Warner Brothers Discovery. And from that standpoint, this deal is accretive to our shareholders. You know, when you look at what the combined business would be with the synergies that you put through it, round numbers, $70 billion in top line revenue. We get to $16 billion in EBITDA very quickly, and it generates $10 billion in cash flow. What we're creating by putting these two companies together is a real competitor to Netflix, a real competitor to Amazon, a real competitor to Disney. Not something that is so anti-competitive, there will be no more competition in Hollywood if this deal is allowed in the past.
Is it an existential issue for you, though, if you don't succeed here, David?
Look, as we've said on our earnings call, we believe in our standalone business. We have a great plan, but very simply, we made the highest offer for the company. $30 in cash is more than 23.
Right, but when it comes to Paramount itself, if you aren't successful here, you have confidence that you still have the scale? I mean, we've had this conversation before. I would assume that you're going to try and figure something else out because there is a sense that you don't have the scale to compete in this world.
As we've said, we can absolutely, this is a buy versus build. We absolutely have a path to be able to build.
I'm here.
But again, when we actually sit here today having put forth the most value for shareholders for Warner Brothers Discovery, we believe that they need to be able to evaluate that offer, and that's why we're taking it directly to the shareholders.
I asked you about the president, but I'd love to come back to that. I mean, do you sense that he is in your corner here?
What I would say is I'm incredibly grateful for the relationship that I have with the president, and I also believe he believes in competition. And when you fundamentally look at the marketplace, allowing the #1 streaming service to combine with the #3 streaming service is anti-competitive. And this whole notion of category ambiguity, forgive me, David, you've been doing this a long time.
Yes, I have.
Like, I don't buy it.
You don't buy it. In other words, their argument, John Malone made this argument with me, it's not about streamers, it's about TikTok and Instagram and YouTube.
I'm sorry, let's follow that analogy for a second, right? Okay? That's like saying Coke can buy Pepsi, that they're both beverages because Budweiser is a substitute for Coke. That's not a realistic argument. Now let's actually look at it from the talent community. The greatest showrunners in the world, David Benioff is not going to take the next Game of Thrones to basically TikTok or to Instagram. They're going to take it to Netflix. They're going to take it to Amazon. They're going to take it to Apple. They're going to take it to HBO Max. They're going to take it to Paramount Plus. That's not actually how the ecosystem works. If this deal is allowed to come to pass, it is anti-competitive, and it is a horrible deal for Hollywood. And as someone who spent the last 15 years of my life producing movies and television shows, this is an industry that I love. This is an existential moment for our business, and we believe that what we are offering is better for Hollywood, it's better for the customers, and it's pro-competitive.
I wonder, we're having this conversation.
Yeah, Faber, stick it up your ass.
For Hollywood than Netflix owning it, but will it be better in and of itself? I mean, you're talking about huge cost synergies, for example. It's not clear, or can you make it clear that in fact Hollywood will actually benefit and there won't be reductions overall still in the amount of productions and jobs?
But absolutely it would be beneficial for Hollywood. I mean, one, everyone loves to contextualize the 6 legacy studios, right? But I think when you have to look at the new entries that have come into the place, Apple is now in the business, Netflix is now in the business, Amazon is now in the business. What we are buying by our basically acquisition of Warner Brothers Discovery is we are accelerating our path to scale. What Netflix is buying is unprecedented market power that will kill competition in the industry. What we are doing will create another scaled, healthy buyer for the creative community and for talent. We'll put 30 movies a year in theaters exclusively.
30 movies.
Oh my.
Paramount.
I'm here.
But look at what we're doing at Paramount.
It's Paramount.
We're 8 movies a year. Right? We're going to release 15 movies a year next year.
Oh, we are.
We're going to grow that. We've said it publicly that we want to grow it to 20. We believe that the #1 way in the movie business to create valuable intellectual property is to release movies in theaters, not at home. We deeply believe in that experience. And when you think about the generational heirlooms that have been passed down from generation to generation, that's filmed entertainment, those are movies that you saw in the theater.
The news business comes up for a moment here. I mean, you're going to own linear cable assets, obviously CNN amongst them, if you are successful here. Thank you for the mention of Versant, by the way, and in a favorable light. But the business is in...
Oh, wow, we only got 4 minutes to go. And I haven't even got my shoes off yet. Okay, well, everybody knows who I am. I'm Washboardjim with a sneaky snake trading strategy where I talk about chart patterns, moving averages, and being in the now. Faber's a big time liberal, so you gotta take him with a grain of salt. Oh God, what she look like, a nun? I'm gonna let it go by. I think it looks good on her. I think it does. The market's flat, but in the green side. We have less than 3 minutes, and I have enough time to take off my shoes. Oh, hope everybody had a blessed weekend. You know, we're at the orb. We're at the orb. Prepare ye in the name of the orb. All that hard work of bringing that thing back up, and we're at the orb. Oh. Man, my legs are sore. God, they're sore. I had a real rough weekend. Feel like I traded Today's the 8th. Let's see which one, 687 or the 688. Start off with 5. We've got a spinning top. Nvidia, what's the deal with everybody wearing? Well, having a white party? What is going on? Do I need to...
The fact that when you combine these two streamers, what it means for the likes of Hollywood, what it means for the likes of consumers.
Oh, shut up about this. Oh, look at here. Let it open. The 687s at 97 cents.
Talking about how cash is king here, and they do want to get this across the line with the offer that they initially took to the board. Nicole.
I mean, it's unbelievable.
Unbelievable.
I sort of thought maybe it wasn't over, right?
That's what you are.
It just doesn't surprise me. Does it surprise you?
Well, not exactly, because you've also had the Trump administration sort of weighing in as well. I mean, raising some of the antitrust concerns too, which has been an interesting take as well.
Yeah, we were talking about that, and that nearly $6 billion breakup fee. What's the cost if they stay with Netflix and they don't go through the regulatory environment?
Yes.
So we'll continue to cover it. Sam Bonner,
Nvidia. Nvidia.
And we are off right now. Our up arrows and down arrows are mixed because the S&P is up 5.
That's what you are.
And the Dow is down 9 points, 47,945. The Nasdaq is right now up 1/3 of 1%, 82.57. And some of the names that are winners here: Nvidia, Boeing, Microsoft, Cisco, Goldman Sachs. You have tech as only a bright spot here on Wall Street. That's pretty much, folks, the only sector in the green. 10 of 11 sectors lower today. Energy, materials, industrials, the worst of the bunch, none of which are down more than 1%. Very interesting. A lot around the unchanged line, but definitely more right now down arrows when it comes to the sectors. Joining me now for some of the big movers, we are joined by Diane King-Hall, who's the Morning Movers, taking a look at, first up, we're looking at the IBM Confluent deal.
Yeah, this deal has shares of Confluent rallying more than 20% off the back of the news. So IBM is going to buy Confluent for $9.3 billion. It's a big bet.
Can you afford it?
Its footprint in AI, but we're talking about AI services here. They agreed to buy this. What Confluent does is a real-time data streaming company. Again, a $9.3 billion deal. It marks one of IBM's biggest bets on artificial intelligence. IBM is going to pay $31 a share. The deal is expected to close by mid-2026. In terms of what Confluent does, the software helps businesses feed live data, real-time data into AI systems. It powers tasks like fraud detection, for instance, for Instacart, dynamic inventory tracking for Michelin. It underscores IBM's shift.
I think we're at my first support. Nope, not yet.
This is its biggest acquisition since red hot.
Well, we hit the first one, but I mean, the support channel.
Again,
And I got in SPY.
especially when you see like the price tag.
It's a bull flag, breakout, pullback.
Today it's a move, but
Another 92 cents.
IBM fluctuating around this news. Initially in the pre-market it was under pressure, which is typical with the acquirer, but it seems like the streets read through all this. It's not a bad move for IBM, given that the shares are a little changed right now, Nicole.
I mean, it really is amazing to have an $11 billion deal, and so big move there for Confluent. Let's see right now, it's up 29 days. It's really a huge move. And IBM gets the 1.2% up. I mean, sometimes, as you know, like
exactly.
Okay, let's get to your next one. You're looking at that Tesla.
We're back at 81 here.
So Tesla getting dinged this morning. We got analysts moving to the sidelines on this. This is Morgan Stanley. They had been constructive on Tesla, but now they've moved to equal weight on it from overweight on it. It's not completely throwing out the baby with the bathwater because they've raised the price target to 425.
Come on, baby. Shit.
410. So Morgan Stanley, the new analyst covering this. You guys remember Adam Jonas, but it's a new analyst covering this now, and so that is the shift that they're shifting how they do the rating of the stock. They do still expect Tesla to lead in autonomous driving, clean energy, and robotics, but really the new analyst is Andrew Percoco, who says that this is already priced in. So again, he is still, he's still constructive on these. Its positioning in SSD calls it a real game changer, a significant competitive advantage over rivals. But just because it has that advantage does not mean that he's bullish on the stock given where it is. He thinks, again, this is full valuation here, and you want to wait for a better entry point on this one. Nicole?
Yeah, I saw a few downgrades today. Tesla, Netflix, 3M, Marvell, Rivian, Lennar, Carvana. So there are some names to watch. There's a lot of, check them out, folks. And I'm only naming some. Lucid's in there. It's interesting how you have a few of these car-related names. Last but not least, Five Below. We were walking together, we saw one.
Yes.
Let's talk about Five Below.
Yeah, so Five Below getting some love from the street today. Shares moving more than 1.5% higher off the back of this move. This is from Truist. They've raised their rating on Five Below to a buy from a hold. So they are moving off the sidelines on this one. They call the retailers, this is a discount retailer, it's a third quarter performance, a quote, game changer. They moved their price target to 260 from 179 from Friday's closing levels. That implies more than 20% upside. So even with the momentum that we've seen in Five Below year to date, I mean, that stock has been a huge outperformer. For today's move, it was up more than 65%. They say that this is still trading below historical valuation levels, and they think that the company has, quote, unicorn-like growth, and they think it could justify a much higher multiple from here.
75 cents on them now.
They think it's sustainable, whether we're talking about earnings upgrades, stronger comps, improved merchandise value, and then just the credibility of the turnaround there. They've had last year some merchandise missteps. It's been a different situation this year. They've leaned into trends, and the trends have worked. So like, for instance, the K-pop Demon Hunters, merchandise like that, just trending things that the Gen Z, Gen Alpha, and even millennials like there. They've had big gains in traffic and the average ticket size and overall comps. So they like it. The windows at the back, Five Below once again, Nicole.
All right, Diane King Hall, great to see you all.
Tesla 444.
10 of the 11 sectors have down arrows. Only tech is winning here today. But what's interesting, when you look at the heat map or you look at the up and down volume, they really look 50-50. So it must be one word
NVIDIA.
in a sector puts it into the red. There is green today. But, with the drugs, you'll find like it's mostly red, but Humana's higher. I'm just giving
Meta's really moving.
Financials, you're seeing down arrows, but Goldman Sachs is higher. There is a bright spot in each sector. It's very
I gotta get this SPY to moving up.
We'll look at the charts and
We could hit my support channel.
AI. And whether or not we're going to see a pullback.
We got a head and shoulders right here.
Winning weeks on Wall Street. Opening bell, we'll be right back.
I ain't gonna add, unless we hit that support, I'll add. I go in a lot. I go in 10. Double it. Right now I got 10. Should have went probably 15, but
with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet
Nvidia.
Weekdays at 10 a.m. Eastern on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders.
What the fuck?
And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back. I want to talk more on tech. I mean, that's the one area that we are seeing some bright spots today. It has been a leader, right? Over 3 years, you've seen so many incredible growth stories. And such Abby's with me, hedge fund manager at Papyrus Capital. Thank you so much for being with us. Even today, we're talking about the AI revolution and Apple being upgraded. And you have deals happening in the space. What do you think about tech right now?
I think it's still interesting. I think we're a bit of a ways before we see any sort of kind of bubble-related issues. But the one thing I do think is interesting, and I think you highlighted it earlier when you said there are sort of winners and losers today in different sectors, and I think we're starting to see sort of not all tech going.
Netflix is under $100. Someone asked me about Netflix, and I said, it's going to be a tug of war. Kind of like what Oracle got themselves into. But we'll definitely get, this is really looking sexy. God darn, man. I think my alert just triggered on SPY. Here it is, right there. Might double down right here. On SPX. $0.59. SPY more at 59. /ES. We've got a long knife here. Netflix is on watch. We got Head and Shoulders. We broke out of the channel on /ES. So we got to hold this support right here. Right here. I mean, right here. If we can hold this, we'll go ahead and break out to the VWAP. We're in my support channel, so my alert went off on my SPY also. This is what I called this morning. Should be up here somewhere. Oh, we had a knife on Meta here. 66666. God. It's not a good way to start my day off. Double bottom on the SPY. Jeez. Now we've hit the bottom of my support channel. We have to hold here for sure. We've definitely hit the bottom of my support channel right here that I called out this morning. Come on, bitch. We hit the perfect bottom right there. $685.02. Oh, I gotta put my food in the fridge. But I'm gonna wait till I get out of this trade. We almost hit the VWAP, and then it pulled back. I don't like this lower low, but we did hold my support. And we did break out of the channel. We're still bearish because we're under the 9. We haven't had a full candle above the 9 yet. Lulu's down $5. Home Depot's down almost 6. Google's down 427. Meta down 850. Oh darn. 674. It just bounced up. What? Walmart down $1. Costs down 523. This Boeing. Boeing was one of my winners last week. It's up to 205. Mr. and Coin are up. AVGO's up $11. Regetta. still in the SPY. IBIO is up. No news. Syntax is up. Oh God, Syntax. That's a huge run this morning. IRBT is up 18 cents. You having a hard time being bullish this week? Nvidia is at the 63. Morgan Stanley downgrades Tesla. They probably missed the run, but they say it's still a trade. So I don't get that. I'm thinking about doubling down here on my SPY. We have $1,480 in it right now. Nvidia. Okay. $49. Come on, baby. Let's go. It's weird how everything changes once that bell rings. I'll be right back. Go get my water started. See what Kevin's got to say.
FOMC decision, as you say, the market's currently pricing in pretty much a done deal here, but many have been saying that we're likely to get a hawkish cut, certainly moving into 2026. Let's just break down some of the other moving parts we're seeing. I'm seeing some nicer gains in Broadcom, and Microsoft is also up. Obviously, we are seeing this news this morning of Marvell, which is moving lower because of the fact that Microsoft is looking to switch as far as buying its chips to Broadcom from that company. What are you seeing there? What do you make of that?
Yeah, interesting report that we're seeing. We're seeing Marvell down about 9% in the session so far here, and rightfully so. Marvell only has a select number of customers, and they're very large customers. So if you lose one of them, like a Microsoft, then obviously it's going to have a massive impact when it comes to top line revenue. If there's something that's materially going to affect that company, though, then you probably would see potentially a pre-announcement when it comes to guidance moving forward. So that has not happened yet, but the report now is that Microsoft
this ain't working out.
Be able to build out some customized chips here over the next couple of years, and that could actually take away from Marvell here. Now, this is something that has been in the background over the last couple of weeks, especially after Google launched Gemini, and the fact that TPUs are now kind of taking the market by storm when it comes to enthusiasm. And this might be another shift away from maybe some of the traditional chips here. We are seeing actually a downgrade from benchmark around this news here.
So this could get to 685, drop another 36 cents.
There could be some near-term risk if this news report is actually going to come to fruition here, and that actually could drop the XPU growth sales growth down to around 20% in 2026. So some potential impacts here, and unfortunately, once again, a name like Marvell, a lot smaller when you're looking at the semiconductor space as a whole, and those that can provide customized chips, and then also their concentration of customers, they really cannot afford to lose a lot of the bigger ones.
Okay, and just sticking with the whole micro theme, obviously we've got a few earnings and notable names out this week, being of course Oracle, we've got the likes of Lululemon, we've also got Costco, so quite a wide variety, but some key companies here to track. I'm just seeing as far as Oracle is concerned, which is going to be...
Marvell's dropped 12 points since Friday. Marvell drops on downgrade. Marvell drops on downgrade. Netflix analyst is no longer bullish.
Yeah, I would say
Here's the top 5 downgrades.
one that has the risk that's being priced into the market. When you're
We
looking
got
at the credit default
Netflix,
swaps, they continue to rise to the upside, just meaning that the
NVO,
large institutional traders are
Oxy,
buying those CDS
MMM.
maybe their core position. So the conference call is definitely going to get pretty aggressive, I would say, from analysts really trying to pick apart that company, trying to see not
I don't know about that.
their forward guidance.
They're coming in near negative, you're right.
The forward guidance when it comes to
Randy.
their cash flow moving forward, and then also their financing activities.
All of a sudden Monday they come out with a bunch of downgrades.
The setup actually
But they're not happy that oil's down.
From a technical standpoint, that's really hard to say, given the fact that
Wall Street loves that high dollar oil.
it's a lot more stretched.
I don't know why.
Other companies, but it has been able to reclaim.
Don't seem, you know, you have to kind of play devil's advocate sometimes.
Also breaking a downward trend as well.
It's probably good for cruise lines.
Into this name, not sure how much you could go to the upside before the earnings announcement.
And I'm still in SPY. I'm holding on here.
The next major area of resistance, which is the 50-day moving average. So flush through the 200, able to recapture the 20-day moving average. Buyers are starting to step
Carnival Corporation. Man, that Carnival's kind of gone to hell.
just given the fact that we have seen a lot of chatter.
Seaborn announces the Explore More event.
Potential risk moving forward over the next couple of years when it comes to Oracle.
All eyes on Oracle later this week as far as their earnings report. Just looking across
Carnival Holland America Lines reports Black Friday weekend sales record in U.S.
Interestingly, that their trade surplus hit over $1 trillion for the first time. That's a new record. But I'm just looking as far as we've got gold on the back foot, precious metals.
I'll go make me some coffee.
Also, when you look at oil, Brent, gas.
I tried.
What are you seeing there? What stands
Here's
out today?
SPX at the orb.
Yeah, so the China export data.
We got a double bottom. Ooh, it didn't hold
has
it.
normalized here between the United States and China. Now, the reason why we are seeing that deficit kind of adjustment is because we are not exporting as much going out to China. So we did see some positive data there, and you are seeing a mixed reaction.
SPY's at the bottom of the channel here.
Looking at copper.
So it did pull back to my 685.02 area. This is the final support, or we just go to hell.
The COMEX is not doing that yet. There's still a
Right here.
significant discount to those two contracts here, so there's probably a little bit more of an arbitrage trade that is taking place within the copper space. Also, if you're looking at natural gas, I think that's the biggest one that I'm looking at for today.
It's a 1, 2, 3 at the bottom.
Saw that Friday candle.
That's a bear flag now.
Candle that did take place. A significant amount of volume in the market as well. Looks like a potentially a little
Did
bit
show a
more
little bit of
up,
life
we're
until we
seeing
saw
pullback
this
today.
candle right
Some
here.
other reports reports over the next 14 days, getting a little bit more favorable for the market. But we actually did see a short squeeze taking place within the natural gas space, and I just wanted to kind of highlight that
symmetrical flag
moving forward here, where you actually had individuals going out to the December monthly contracts or the January contracts and buying $11 calls on natural gas, a significant amount of buyers, and that really kind of fueled this reaction to the upside. It is overvalued from a fundamental standpoint. Let's see if it's going to be able to hold these levels, but I would not be surprised if we do kind of turn around, try to retest that 20-day moving average, and back out some of this weather premium that's been built in over the last 2 weeks.
Yeah, I mean, nat gas down almost at 6% in trade this morning, but I mean, it is still up considerably throughout the course of year-to-date terms as well. So interesting moves there. We'll be watching. Thanks so much for getting us across those key stories this morning, KG. Coming up, we will dive into the growing need
turn on my
for
heat.
AI boom and how that factors into
68
investing.
here.
Morning Trade Line is back after this.
Make a cup of coffee and I'll be right back.
I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
I used to make cannabis butter and put it in my coffee on the weekends.
Specialists for taxes, insurance, and estate planning, all with low fees.
We got a tweezer bottom with 3 black crows and a spinning top. At my final and last support level. If this doesn't hold, I might just get out of the trade.
Just the market, from open to close and beyond.
Have to make it up.
24/7, any screen, anywhere at schwabnetwork.com.
We're back on Morning Trade Live. Morgan Stanley has downgraded Tesla to equal weight while raising its price target on shares to $425. The firm sees Tesla becoming a market leader in autonomous driving, renewable energy and robotics, but prefers to wait for a better entry point. Shares are up more than 105% from those April lows. We are sitting down about 2.4% right now for Tesla shares off the back of that. Let's take a look at the winners on the session, and perhaps no surprises there given the breaking news we've heard this morning. Warner Brothers Discovery taking the cake there, up at 7% off the back of this now bid coming from Paramount Skydance in what is being called a hostile bid, $30 per share, entire of the company they're looking at with an all-cash offer here to compete with the Netflix offer here. We've got Wynn Resorts up at 4.5% as well. Micron is also among the winners. Here are the losers on the session. The laggards do include the likes of Dollar General and Dollar Tree. Interesting off the back of some of their key earnings reports, which looked pretty good as far as some of the consumption trends they've been showing us. They've got Dollar General down at 4.4% right now. Dollar Tree is trailing by 2.9%. So that's a quick snapshot of who's winning and losing on the session so far, and what's going to be a pretty busy week. So joining us now is Jay Pawlowski, who's the
Toll Brothers is in focus.
Advisory. Very good morning to you, Jay. It's always nice to see you. What are your expectations now? We've got the FOMC, but once we get over that, what takes us into year end?
Thanks, Sam, and great to be with you as always. You know, the Fed is going to cut rates. That's a given. I think it's already priced in.
Toll Brothers announces new Rivercrest townhome community coming soon to Reno, Nevada.
And I think that suggests that Investors are concerned about politicalization of the Fed, about potential inflationary pressures, and about the need to continue to entice foreign investors to invest in the U.S. Treasury market. So to us, it's really quite simple. We're in the early stages of a significant global growth spend on AI, on defense, on climate. That means fiscal spending. That means long duration bonds, not attractive. It means commodities.
Mr. pulled back, coin pulled back, and they were up earlier.
Complex. And we think the opportunities are really in those countries that are recognizing that we're in a changing environment, particularly for power. And the countries that are focused on electricity and electrification and leveraging cheap renewable
good way to start a
power
Monday.
to competitive advantage. That's the area of focus for us at TPW Advisory.
I mean, you've talked about the commodity bull market many times before, even on this program. So I'm just wondering, where exactly you see the opportunities moving into 2026 in order to
687
power all these needs that we have and this insatiable demand for AI and things like EVs.
There ain't no 687 now.
That's the area of focus, we believe, for investors. So it's not so much AI in the Mag 7. It's the whole complex.
685.83.
It's what we called in our Friday
685.60.
the connectivity issue. And so we're focused from the beginning, from the commodity side and things like copper, et cetera, which have been big winners. And now we're focusing on the energy side. We think the next kind of opportunity set in commodities is in energy. And that's not, you can have both oil do well and renewable power do well, right? I think the oil story is more cyclical. The renewable power story is more secular. And so we're actually playing both. I think the biggest opportunity in 2026 in the commodity space is in the energy space, particularly in the oil side, where the market expects to have tremendous surpluses. And so you have Brent forecasted in the mid-50s, whereas today it trades in the mid-60s. And I think we're going to find out that surplus is way less than we believe it to be. And we may even be thinking about shortages in 27, 28. And so oil
we need
is
really attractive from a risk-reward perspective.
Right in here. 685.74 is what we need.
Harmoniously alongside renewables as well. What do you look at? Do you look at solar? Do you look at wind? Do you look at energy storage, nuclear?
All of it. But especially the electricity side. So solar plus storage. What's happening is that the battery capacity is expanding dramatically, which allows people to kind of package the two, solar plus storage, as a single kind of industrial facility. And that's where we see China leading the way. You talked earlier about China exports. One of the things that China is exporting a lot of is renewable power capacity.
You got a tweezer bottom on the 5-minute on the SPY.
Whether it's a solar field, whether it's help along the grid, etc. China's doing a lot.
I had first support channel was 685.02. That's where we are right now. To 685.65.
On cheap renewable power, leading to a
what I had this morning.
Advantage in the manufacturing side, in the AI side. China's using cheap
SPX had a double bottom.
versus U.S. higher quality chips. So you have that.
Let me look at SPX. I got to make up some money.
Forces, and that is what we call the new growth model. And countries like Spain, Brazil, etc., are examples of this.
Yeah, and look, Jensen Huang has spoken about that as well, as far as China being ahead in the energy game as well.
SPX had a double bottom.
Across what's happening over in China, I think this $1 trillion surplus as far as the trading partnerships are concerned, hitting a new record right now, speaks volumes. Just talk us through just how significant that is. I mean, as we look at the Chinese economy, I mean, those exports are leaping out of contraction overnight, surprising the markets to the upside. I mean, it just goes to show that, this has really been the last leg that China has left standing on, and it doesn't look like it's going to be sort of kicked out from under it anytime soon. What do you think, Jay?
Yeah, we would disagree with the idea that China's export dependent. I mean, very simple.
Actually, it's a triple
China
bottom.
Exports roughly close 18 to 20% of GDP. So it's not anywhere near, or its trade business is at roughly 20% of GDP. So it's not at all dependent in that sense. What we've noticed is that China's been able to switch away from the U.S.
See if we hold this support. This could be good.
Market to China exports.
SPX.
To redirect those exports to the fastest growing parts of the world, which are namely Southeast Asia and Africa. That's where the biggest gains are. In
December
China's
8th.
exports
Oh
over the
man,
last couple of
oh,
years.
that's the
So
spy.
They are basically sewing up the future growth areas of the world. And so strategically, that's really quite impressive. As is the fact,
6880s. I'm gonna get one, maybe two of them.
Our EVs, our solar panels, our things of that nature, and so they're also tying.
Fallen wedge. Well, no, could be a fallen wedge.
While the U.S. and Europe, to a lesser extent, are doubling down on traditional fossil fuels, which we think at TPW Advisory is a major strategic mistake that's going to really limit the ability of the U.S. and other developed markets to compete with the emerging markets going forward. And that's why we think we're early in a secular bull market for emerging market equities.
Emerging market equity, something to look at in 2026. I mean, look, they have outperformed this year as well, so something to look at to come into next year. Jay, always a pleasure. Thank you so much.
Not much of a fallen wedge.
Who's the founder and chief strategist at TPW Advisory. Always appreciate your time. Coming up, we will get a closer look at the big picture with the team from Charles Schwab. Morning Trade Live. We'll be right back.
I'll give it a shot. This is risky also.
I'm Diane King Hall on the floor
The
of the New
6880s
York
at
Stock
380.
Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
How's it going? First day, so.
Sometimes,
Next. Try it again.
you could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
Well, I got a new
Whether you're a bull
love for
or
people
bear,
that have to
you'll
work
want
on their
the latest
knees.
market action on Morning Movers.
And I'm not
with
talking
Diane
about
King Hall,
prostitution.
live from the floor of the New York Stock Exchange, only on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalyst.
Oh, here we go, back to 680.
Here on the floor, I bring
I mean,
you
380.
real-time sentiment from traders driving the action.
Hold.
In Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage
Go
of the
get my
close
coffee.
every single day. This is Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network. We're back on Morning Trade Live. IBM has struck a deal to buy data streaming platform Confluent for $11 billion. The deal is to deliver end-to-end data platform for businesses to connect, process, and govern data for applications and AI agents. The transaction is expected to add adjusted EBITDA with the first full year and free cash flow in year 2. Confluent shares rallying hard on the news today. We're up 28%. Look at that. All right. Welcome back to Morning Trade Live. It's time for the big picture. So let's welcome in Cooper Howard, Director of Fixed Income Research and Strategy, Schwab's Head of Financial Research. Very good morning to you, Coop. So we know that come Wednesday, it's pretty much a done deal as far as the markets think, 25 bips. But what's likely going to be the reaction when it comes to that decision, and then what Powell and Co. are likely to say?
Yeah, I think that the actual rate cut isn't going to be what's going to be important. I think what's going to be important is what the dispersion of views are. Now, our expectation,
What is it with
like
me?
you mentioned, Sam, and pretty much everybody on the street's expectation is that they are going to cut by 25 basis points. But the dispersion of views is going to be what's very interesting. This is a meeting where we're going to get the dots plot as well as the summary of economic projections. So I think that's where a lot of the information is going to come from, as well as the press conference. So I think that that can be a catalyst for a little bit of a surprise. But I would not be surprised if we see a few dissents at this meeting in the way of both further rate cut, more than 25 basis
Well, I hate to stop out of it.
as well as no rate cut. And then if we look at the dots plot, I wouldn't
Right
be
when I
surprised
get
if
in
we
it.
see further dispersion there. If we look back to the last dots plot, Sam, there was actually 2 members who put their dots at higher interest rates. So an additional hike in 2026. I wouldn't be too surprised if the median dot stays the same, but we again see that dispersion of dots going forward.
Google has a double bottom.
It's no surprise that we have got a divided Fed, but it would be good to get some more evidence of that.
Jesus.
So we'll be looking at the dot plot, looking at the SEP. What then is the market impact of, you know, this dispersion that you speak of, and the
Randy.
what should we be watching out for?
Yeah, so I think actually the market impact of it, our expectation is that we should continue to see a steeper yield curve. We are seeing the steepest 2-10s yield curve in the past few years, and we would expect that trend should continue. So as the Fed begins to cut interest rates, and yes, we can debate how many times are they going
This
to
is
cut interest rates
embarrassing.
next year, but it's likely that they're going to continue to cut rates, and that should pull the short end of the yield curve down. Whereas if you look at the long end of the yield curve, we do expect that that's relatively going to stay, it should stay relatively elevated. So we have been hovering right around that 4% region. We've obviously moved up off of it over the past few days. So we do expect that the likelihood of moving lower on the longer term portion of the yield curve is likely pretty muted going forward.
Okay. What's your read on what's behind the move in Treasury this morning? We're seeing a bit of a sell-off in bonds. We've got the 10-year that's at 418 right now.
Yeah, so we have seen a little bit of a sell-off in terms of the bond market. And what I look at it as is that it's somewhat of a move higher overall if we see it. It's also kind of a carry forward of what we have been moving recently. So the way I'm looking at it is a lot of expectations of Fed expectations beginning to shift a little bit, so maybe they won't cut as aggressively.
Right when I get in that trade.
Continue to hold things more there. The other piece that could be impacting it is concerns over the next Fed chair. So there are some concerns that maybe we would get a Fed chair who might be viewed as doing the administration's bidding and cutting interest rates, even though the data is not projecting that. So
I got 3 of them.
that's what's being viewed as by the market. That would likely be a negative thing, and the expectation would be that could cause a little bit of an increase in the term premium and a little bit of increase in longer term yield. So that could be another piece that's moving longer term yields higher.
Okay, and if we do continue to see that steepening of the yield curve moving into 2026, what's key to watch out for? I mean, obviously we're not going to be getting more data until after the FOMC, but what are you keeping tabs on?
Yeah, so I think that there's obviously going to be a lot of things to keep tabs on. But if we look at it through the eyes of what the FOMC is watching, I think that the labor market's going to be one of the very important things. And yes, we can look at what's happening.
I'm turn this around.
Even fast forward to just what's happening tomorrow. We're going to get the JOLTS report. So I do think that that's going to be an interesting report. Now, in the camp of further rate cuts is those who argue that the labor market is slowing. So if we continue to see that through the JOLTS report, we continue to see that through the unemployment claims report, or just the non-farm payroll data, that's going to be something that's worthwhile.
You can get my coffee here in a second.
If it does show that the labor market is further
Right now I'm
softening,
at 30
I do
bucks.
think that would tip the Fed more into the additional rate cuts camp.
Okay, watching that jobs data. Thank you so much for that, as always, Cooper Howard. Really appreciate your time. Director of Fixed Income Research and Strategy, Schwab Center for Financial Research, joining me. Coming up, it's time for the morning trade, and we'll take a closer look at Apple after Wedbush raises its price target on shares. Morning Trade Live will be right back after this.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library, filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the CBOE, and beyond. From earnings to economic data, we
Heard the
cover
Green-
what matters as it
Green
happens.
River Killer's
Streaming
about ready to
24/7,
die.
Anytime, anywhere,
Gary
free
Ridgway.
on SchwabNetwork.com.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
All right, back. I'm gonna hold on to these SPXs. I gotta dig my way out.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides. Live on the floor of the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute by minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
Might take a couple aspirin. My legs are killing me today.
Let's focus on Apple. The stock hitting an all-time high last Wednesday, and it's up more than 10% this year. Both Evercore,
We're at 330.
ISI and Wedbush have raised their price targets on shares today. That's not helping the stock, though. Still underwater by about 0.5%. But let's focus on this for the morning trade. Joining us now for a closer look, as always, is Schwab Network host Marley Caden. Very good morning to you, Marley. Happy Monday. So Apple getting a bit of love from Dan Ives. Talk us through what the analysts are saying here as to the price target boost.
Yes, like you mentioned, a little bit of love across the board here. We did get two big moves to the upside for their price target adjustments from Wedbush and from Evercore ISI. Let's talk about Wedbush first. Dan Ives, when he speaks, the street listens. He did put out his top 10 tech stocks to watch through the end of the year. Apple number 6 on that list. But today, upgrading the price target to $350, up from $320, maintaining that outperform rating, saying that 2026 is finally going to be the year that Apple really enters the AI race, that this will be the time that we start to see them participate in this AI conversation, where they finally enter the game. Also talking about iPhone sales as well being really important. They said the iPhone 17 sales have been trending well into the year end, including in the China region.
Right now I'm up 90 on these. I need at least $2
for the December quarter with this healthy holiday
get
season.
back to
I think
5.
it's important to note back in October, they also did a
Break
price
even
target
for the
increase
day.
up to 320 from 310 because of how well those iPhone sales were going. Now, as far as this AI piece, the firm thinks at Wedbush that the monetization piece could add $75 to $100 per share to Apple over the coming years as it finally enters this AI revolution. And for a while now, they've been talking about that Siri is going to come to fruition since 2024, this context-aware
Right
Siri.
now they're at 350.
Now Wedbush is saying they think it's going to come out sometime this year. So this coming year, 2026, will be when they finally come. They also addressed another topic that's been in part of the discussion as Apple appears to be doing some
370.
restructuring with some of its management, saying that Tim Cook, they think, isn't going anywhere. They said they believe Tim Cook will stay in his position as Apple CEO until at least 2027, with some saying that their sources saying that Cook is insisting on seeing Apple through this AI transition. Now, as for Evercore, they raised their price target up to $325, so not quite as high as Wedbush's. They're $25 below. But saying the upcoming AI strategy, which is centered on this Siri 2.0 relaunch in early 2026, could be also a significant catalyst for growth. So similar sentiment here, but they're saying that they think they're going to announce this new Siri 2.0 in March of 2026 at a standalone event. They're going to make a whole Apple spectacle of it, and they think that will happen in March, and that they think that it will be powered by Google's Gemini. So this is an important part of the note. It will enable multimodal interaction, stronger on-device AI, and also have Apple's privacy-focused architecture. They think it will give users access to larger models like ChatGPT and Gemini, which Evercore sees as a long-term monetization opportunity. They also cite potential revenue from AI as a service, faster device upgrades as well. But a positive day for Apple. But as you mentioned, Sam, Apple shares still under a little bit of pressure today, down about 1/3% right now.
I'm so fascinated by that Gemini because Wedbush is talking about sales in China. We know that they've been holding up well, but Google doesn't work in China. So let's see what happens there. Maybe they'll have to partner up with someone else. I think that will be obviously a story to watch, but it's just amazing how much these investors have been patient with this whole AI story. As Dan Ives pointed out, it's been really the elephant in the room with an invisible strategy. So thanks for breaking down all the details of these notes and these price target boosts, Marley. I'll catch you later on. Let's trade it now with Stephen Sarge Guilfoyle, president of Sarge 986. How are you approaching your example trade now for Apple?
Hey, how you doing, Sam? Okay. Now, a lot of traders miss this stock, right? Myself included. I've been talking about Amazon.
Break this here trend line.
I've been trading Google, but I haven't been trading Apple. I got scared of Apple earlier in the year, and I missed this August through end of the year move. So what do? How do you try to catch up on this? I overlaid an Andrews pitchfork model over the chart from the April low right up to the present. For you younger traders, a RAF regression model would probably work just as well. And what you find is that the stock is pretty much traded precisely between the central trend line of the model and the lower trend line of the model. And that lower trend line of the model runs almost congruently with the 50-day SMA, simple moving average. So you do have a trading range that you can work with.
This is Tesla's support off this here triple top breakout, quad top.
$7 a share at the top of the chart. Maybe you don't want to go that
right
far,
above the 200.
So you can put on a simple bull call spread.
So I'm going to put an alert right around 440.
Let's say purchase. We'll do it in minimal lots so we don't get anybody into too much trouble. You purchase one January 9th, $280 call, which is a little out of the money for a rough $6.
Gum fuckers are back down to $3.
Against that, you're going to write one January 9th, $300 call, which is around the central trend line of my model, which is rising resistance for about $1. All right. In order to tamp down this net debit, you were going to sell one January 9th, $265 put, which is close to the 50-day SMA, for maybe $2.20. Now, yes, that does open you up to some equity risk, but it is discounted about $10 more it's trading right now. The net debit of that trade is $3.25. The idea is to bet $3.25 to try to win back $20, right? That's about a $515 percentage move if it works. Worst case scenario, you end up wearing 100 shares at $200 and $268.25, including the net debit, and with the stock trading below 265 at expiration.
All right, good stuff. An example trade for us for Apple this morning. Shares under pressure despite these price target boosts. So what are your overall thoughts on the markets today with the FOMC, of course, very much laser focus for these traders here?
I think we know what they're going to do. I think the press conference may have less importance than it has had in the past. This is Jerome Powell's fourth to last FOMC press conference. So I think we'll start to see his words mean less and less as we go forward. I think the market will start to price in Kevin Hassett, who is the favorite to take on the role come May. It will matter whether Powell steps down from the board or not, because if he steps down from the board, then Trump really has a little more leeway in how he can maybe influence who's on the board and who isn't. If board remains on the board, then he has to remove Stephen Myron in order to put Hassett in
back
the spot.
to 330.
So it gets a little tricky there. But going forward, I think
Tesla got this support area right in here off the 200. So I'd set an alert. I set an alert right at 440.20 just to kind of let me look at it again. Should raise it up just a little bit to the body of that candle, which I think I'll do.
This is the dominant theme for the week this week. There's not a lot of macroeconomic data out there. Earnings were really between earnings season, although we do have a couple of
can't do that to that.
reporting this week. How we come out of this with the dot plot, which is really ridiculous if you ask me, but algorithms do react to it, and algorithms control the market.
Right in there.
So how the dot plot looks, how the wording in the statement sounds, and how Trump comes off, how Powell comes off in the press conference are the things that will move markets.
Yeah, we'll be watching that.
435 for a strong buy.
A lot of things to factor in. See what the market does as far as some of the reactions. Really appreciate the insights. Stephen Sarge Guilfoyle, President at Sarge at 986, joining us there. Coming up, we will take a closer look at the sectors on the move this morning and the data moving markets overseas. Morning Trade Live. We'll be right back.
Back to $3. I got my Death Wish coffee out.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Yeah.
Live from Chicago, this is Trading 360. I'm Marla
Jeez.
Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy. It's a
Look at my
comprehensive
gainers
look at the market
today.
Every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
CETX.
I'm Sam Vardas, coming to you live from the New York Stock Exchange today. It's time now to take a look at the sectors that are moving markets this morning. Alex Coffey is joining me to do just that. Very good morning to you, Alex. Happy Monday. Look, we look like we're off the unchanged line, but still a little bit quiet out there if you take a look at the major indices this morning. But what's happening beneath the surface? What stands out to you?
Yeah, another tug-of-war-like day, Sam. Only 2 of 11 sectors higher, though, in industrials and information technologies. And industrials wobbly here, up about 16 basis points. Could very easily, in a little bit of a downdraft here, cross below that unchanged line. IT, though, up 0.75%, is certainly offsetting a lot of the weakness today. Interestingly enough, about 45 minutes ago or so, I was on with Nicole on opening bell. We were talking about market performance, and at that time, only about a third of the S&P 500 components were higher. That has actually improved to about 40% now in real time. However, the market was a little bit closer to unchanged. So the market's gotten a little bit weaker, despite the fact that more names are actually higher on the day, which I do think goes to show that it's a bit of a tug-of-war under the surface. All things considered, though,
Playboy's up today.
Here. We're basically 1% or so.
That was on my penny list.
1% or so from all-time highs. A lot on the calendar this week. I wouldn't be surprised if this is what it looks like until we get more of that data, the Fed meeting, and some of these earnings.
Yeah, absolutely. It does look like markets are looking for a little bit of direction, certainly from the names that we've got left that are going to be reporting, and also the FOMC decision, not to mention the dot plot and the S&P, namely. But, we've got a couple of stories that are moving markets today. Confluent and IBM reports from the Wall Street Journal. Obviously, what's happening with Broadcom, Microsoft, Marvell, etc. We've obviously had some price target boosts. We've been talking about
RBT that had that good week last week is down to 340.
The Mag 7 this morning.
Yeah, if you look at the Mag 7, only 2 of the 7 are higher. Those would be Microsoft and NVIDIA. So probably 2 of the most important, if not the 2 most important names when it comes
B
to
is down today.
B and sentiment. But when you look at the performance, you mentioned Broadcom. Broadcom's actually contributing almost 6 points to the S&P 500 today in its rally. You combine NVIDIA and Microsoft, that's about another 9, almost 10. So basically,
I just can't figure it out.
The down day would be twice as bad today. About 0.25% worth of upside is contributed just from those 3 names, NVIDIA, Microsoft, and Broadcom.
Yeah, certainly doing the heavy lifting this morning. Thanks so much for that, Alex Coffey. Appreciate it. Let's widen our scope and take a look at global markets, where things stand, because we saw a bit of a mixed picture out in Asia overnight. We had shares over in Hong Kong, which were lower, but we had mainland Chinese shares over in Shanghai, which were actually higher overnight. Now, it coming off the back of Chinese exports rebounding in November. Outbound shipments are growing 5.9% year on year, better than expected, and recovering from a surprise contraction in October. Exports to the US here continuing to decline in double digits for an 8th month. But those shrinking exports managing to be offset by more shipments to other markets last month. Chinese imports, a key indicator of how things are holding up domestically, growing 1.9%. The number missing forecast for a 3% rise amid continued weakness in China's housing market and worries about the economy weighing on consumption. Inbound shipments from here in the US falling 19% year on year. Now, the Nikkei 225 gaining after perhaps a case of bad news for the economy, good news for the markets. Revised data showing Japan's economy shrank 2.3% in the 3rd quarter, which was more than the 1.8% drop initially estimated. There's an expectation that the lackluster data builds a case for Prime Minister Takaichi's stimulus package, which includes the most spending since the pandemic. Shares in PopMart, the maker of Labubu, plummeting in Hong Kong trade, dropping the most in nearly 2 months. We are seeing shares right now.
PopMart, never heard of it.
Dropping. The stock has fallen about 40% from
PopMart continues recent.
There are
What
now
is
worries
this?
that the company may not be seeing as strong sales
PopMart?
momentum here in the US. The stock has been attracting short interest also from traders, so under pressure today. Coming up, it's time for Inside Out, and we'll take a closer look at Toll Brothers ahead of earnings and bring you an example trade for that name when Morning Trade Live comes back.
Hey, investors, you know the market moves. Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Yeah, it might just be a total loss for me today.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
We're back on Morning Trade Live. The home building segment will be in focus after the close when Toll Brothers reports earnings. That stock is up right around 10% this year. And here's a look at some of the other major players in that space. D.R. Horton is also up just over 10% in 2025, while Lennar and KB Home are modestly lower this year. So it's a bit of a mixed picture across the space, as we have, of course, been tracking what has been happening in the housing market. Let's go inside out on Toll Brothers and home builders generally as well. Joining us now is James Demmett, founder, Chief Investment Officer at Main Street Research. It's always lovely to see you, James. So what are your expectations when we hear from Toll Brothers later this afternoon?
Good to see you, Sam. I think Toll's probably the best of the group.
Okay.
It's, that group's had headwinds for now a couple of years because of mortgage rates. But I think, at Main Street, we like companies with great management, strong balance sheet. Toll has that great luxury market, which can really go on fire when housing demand eventually comes back. So we expect them to probably meet expectations tonight at the close. I think they report after the close. We think they'll meet, maybe beat, because they manage those earnings so well in a slow environment.
Well, they have actually
the expectations for earnings the last 2 quarters, so let's see if they can keep it up. You mentioned that they were sort of the best of the bunch. I mean, we can see that reflected in the share performance as well, as I just mentioned, alongside DR. The others have been struggling, but what has the luxury housing market been looking like? I mean, amid the whole sector performance as a whole. I mean, we've been seeing people who've been waiting on the sidelines, people who've been trying to sell their homes, actually pulling their houses off the markets as well. Are we seeing that in that sort of a top tier echelon?
You're still seeing it there. It's a binary trade with these housing stocks. You really need mortgage rates to come down. Like over 6%? It's kind of made the cost of housing double since mortgage rates.
TSM's had a heck of a run.
For these stocks to really gain traction, and I think that Toll would lead that traction, we've got to get those mortgage rates down. So, without that...
That's right. We got to get the mortgage rates down. This economy would be a lot better shape.
Crazy about the group. But it is an industrial stock, so there's other alternatives for investors. I do think
I don't think Powell cares much.
Ahead for Toll and the group. One of them is what the Fed talks about. If they're really talking about lowering rates more in 26, and of course the next Fed chairman might have something to do with that.
Yeah, no, it's been interesting actually because I've been speaking to some of the fixed income guys over at Charles Schwab, and they've been talking about that steepening yield curve, and we keep talking about the hope that these mortgage rates will come down, based on the benchmark. But I mean, we still haven't really seen that as far as a material impact here. Is Toll insulated from that? You say that they're more of an industrial stock in that sense. I mean, do they have other ways that they can sort of pull their revenue now?
They're probably the best managed as far as managing their earnings, and they are a one-stop shop. So you can get your mortgage through them, you can pick your home, lots of options, higher margins than their competitors. So I think that's why this stock's doing better than the others. But again, unless we can unleash lower mortgage rates, which really means the Fed's got to lower a lot more, I don't think you're going to see these stocks really catch fire.
Okay. What metrics should we be looking out for? Because something that I've been looking at throughout the course of the year as well is some of the incentives as far as trying to attract home buyers to the market in what has been a tough year for some of these home builders, and there has been a concern of margins with respect to that story. Is this an issue for Toll?
Well, I think that's the issue with these companies. They have big headwinds because mortgage rates are just not where it's appetizing for someone to switch a home. So I think as an investor, you want to focus on those companies like Toll, best balance sheet, been around since 1967, so they really know how to manage through these slow periods. And I think that's why the stock's performing better than the others. But again, I think the binary reason, the way these stocks go higher, and it could be in 2026, is rates really come down, mortgage rates follow, economy is strong, and maybe Kevin Hassett, our new Fed chairman, evidently, can bring that momentum. So I think this stock's a value trade. It's 9 times earnings. Right? I mean, it's super cheap. So for someone who has a little bit more patience, I think you're going to be very well rewarded over the next maybe year or two.
Market for patience. So it is a long time, but I think patience is the key here, as you say, perhaps. So thank you so much for that, James Demmett there, founder, chief investment officer at Main Street Research, I should say. Let's trade now with Tom White, host of Fast Market, an example trade for us for Toll Brothers.
Yeah, stock is cheap on a valuation level, but maybe it's cheap for a reason, because you're seeing the 10-year yield, which is, what the mortgage rates are kind of
cheap
based off of more than those short-term interest rates that the Fed's kind of controlling at this point. So you've got to take that into consideration with this one. And you've got the 10-year at 2.5-month highs today, nearly 4.2%. So those 30-year fixed rates aren't coming down anytime soon. So I looked at a strategy in here. They don't have weekly options in total. They've only got monthly options. Not a lot of depth or liquidity in there. Only about 96 million.
Well, we're at another support level again, double bottom, SPX.
Need a move type strategy using the option market, but I don't care which direction it goes, whether it's higher or lower. Option market's pricing in about a plus or minus 6% move either way, in the shares just over $8 in either direction. So look at buying an iron condor in here, going out to that December monthly cycle, so 11 days to expiration. We're going to buy the 130 put, sell the 125 put, so you're buying a put vertical that's out of the money for the downside. Then on the call side, going to buy the 145 call, sell the 150 call, so buying the $5 wide out of the money call vertical. So in each side you're buying an out of the money vertical. You're paying roughly about a $2 debit for it. That's $200 per spread, but you can see here
this is a really rough day.
Moves below the break even of 128 to the downside or above the break even of 147.
Supports are not holding, Randy. I'd be careful.
Typically going into earnings pretty elevated. This one not so much. So buying this iron.
You might be one of them end of the day flushes where I got to wait all day to make good money.
More than that one standard deviation on this trade. And the idea here is
Day like today when I'm not hitting it and I'm not nailing it right.
Up to 10% with that small share flow.
Sometimes it's best just to wait until the end of the day for the big bounce.
But yeah, you just don't have to pick a
direction. Right now, I mean, this is my last support on the SPY. 683.60.
But we won't talk about that. All right, thanks so much for that. Tom White, I'll check in with you a little bit later. Let's just check in with these markets very, very briefly. As
the last support
this morning, because we have seen a little bit of a split picture today. A bit quiet as far as the major averages are concerned as we look ahead to this all-important FOMC decision. The S&P 500 just down about 0.3%. The Nasdaq also under some pressure, and the Dow Jones too. But we have got an outperformance there for the Russell.
This was Friday's support, 683.60.
I'm Sam Bardas. Download the Schwab.
That was Friday morning.
App Store and tune in at 24/7 on SchwabNetwork.com. Trading 360 is coming up next with Marley Caden.
We could start to reverse here.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December 11th for 2026 Market Outlook, your guide to the forces shaping stocks, global markets, inflation rates, and more. Hear from experts on where the markets may be headed, spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m. Eastern on Schwab Network.
I'm Sam Bardas, live from the New York Stock Exchange. When the market moves, we're on it.
684s.
The strategy and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
me see how much this will cost me here.
Good morning. Happy Monday.
I think about cooking me a hamburger.
Welcome to Trading 360. I'm Marley Caden coming to you live from our Chicago
Just let this
headquarters.
play out.
What we have coming up for you in today's show in our 360 Spotlight, we'll be breaking down the latest in the bidding war for Warner Brothers Discovery as Paramount Skydance announces plans for a hostile bid. Our disruptor today is Marvell following a downgrade to hold and reports of a potential loss of a major customer. And then for our 360 round, we'll bring in our panel to discuss large language models and compare ChatGPT to Gemini. Before we get to all of that and some of the top stories, so let's take a look at how the markets are shaping up as we are into the trading day. We are down across most of our major indices. The S&P trading down about 1/3% right now at 6847.91. The Nasdaq down about 1/4%, 25,624.98. For the Dow, we're down 0.4%, 47,752.92. But the Russell 2000 is up on the day about 0.1% at 25.24.
What to do, Jimmy? Are you going to play him or are you going to wait?
The 10-year doing this morning in some of our futures products. The 10-year high
That didn't hold up very well.
at 4.19. The dollar is at 99.15. Gold
So I'm going to clean this chart up, start fresh.
90. Crude oil also down about 1.33%
Some
right
way
now
below.
at 59.29 a barrel, and Bitcoin above that 90,000 threshold, that mentally important round
So we
number
got the 9.
90 right now. That is up 0.5%. I do want to get to one of
We
our
got the
top
9
stories
on the
today. Our
daily,
first guest, of course, Alex Coffey, our senior equities
which
contributor here on
coincides with that
Morning.
candle right
Talk
there.
about Tesla.
That's a pretty
Tesla
good
getting
spot.
downgraded to equal weight at Morgan Stanley. This is a big deal because longtime bulls
We got
at
some
Morgan Stanley
gaps.
for Tesla.
Yeah, new analyst,
Got it.
though, sort of this is a nuanced report.
So this is that
I'll say
last gap
So
right here.
analyst, now Andrew Percoco replaces longtime analyst Adam Jonas for Morgan Stanley, initiating this assumed coverage with an equal weight rating. But the price target is adjusted higher from $410 a share, Marley, to $425. Which goes to show it's probably been a little bit since
680.50.
adjusted, so this is sort of a catch-up as well. The new analyst does
It'll be off the 9 on the daily.
Manufacturing, renewable energy, and real-world
And on the 1 hour,
acknowledges the merit for a premium valuation, but does feel that these high expectations
It'd be
are brought
above.
closer to fair value, expecting a choppy trading environment
And a
for
buck
Tesla
above
over the
it.
next 12 months, citing downside risk to estimates, and that non-auto business catalysts are
Right
already
there.
priced in. For the base case,
681.84.
CEO Elon Musk will achieve 7 of
Just
the
like
12
guessing game
operational
now.
milestones
I don't like
in
that.
$1 trillion pay package by 2035. And they say if all the market cap hurdles are achieved, potential dilution from these milestones would reduce the price target by 7%. Bull case, $860 a share. Bear case, $145 a share. And I thought this was interesting. The Optimus humanoid robot seen as valued at $60 per share for Tesla, and that FSD is what they call the crown jewel.
And sell-ups are strong.
So a lot of tidbits there. Report worth checking out.
Yeah, certainly interesting, you know, with the previous analysts being very auto-focused and now pivoting to some of these things that Tesla has been focusing on as well.
Yeah,
Alex,
be
appreciate
careful,
you
Randy.
walking us across that one. That's Alex Coffey, our senior equities contributor and the co-host of Next Gen Investing.
It's a
here on
Monday
the network.
flush for
I do
sure.
welcome in our next guest, though, joining
We
us
got a
now,
new
Jim
low on
Uriel,
AMD.
Managing Director at TJM Institutional Services. Jim, great to have you
Nvidia's
with us
about to
on
the
this Monday
200.
morning. As I look at the board, you know,
And that had the big
trying to hold
breakout this
on to
morning.
green shoot in the Russell, but
Meta's
seeing
under the
across our major
200.
indices to start this Monday. You know, what are your thoughts on the market action
And
we're kicking off the
Apple.
week with?
So think about what happened back on October 29th at the last FOMC meeting. The
Yeah,
chairman
I'm
came
gonna go
out
put a
and
hamburger on and come back and think this over.
future eases. I read that differently than the market did back on October 29th. I thought he was just saying data dependent, blah, 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 like he always says. Well, anyway, we're 2 days away from the next Fed meeting. So what's the risk? The risk is I believe he's going to ease, but then in the comments, he may then throw a wet blanket on future eases and say data dependent. So I think, you know, people are just kind of adjusting adjusting for those risks today. At the end of the day, I think the market is still fine. And here's what I base that on, is that the Fed is easing. The Fed is in an easing cycle. The Fed believes that the labor market is deteriorating, and I agree with them. The labor market might be deteriorating from an exogenous force that's not just about an aggregate demand story. It might be that AI is replacing these jobs already. I kind of tend to think it is. So the Fed is going to ease to address the labor market. At the same time, equities near all-time highs, real estate near all-time highs. The market is flush with money and liquidity. So I think they think they're caught in a weird spot. And at the end of the day, I think it could be good for risk assets.
All right, Jim, a lot to unpack there, but I want to start with the Fed before we get to some others. And we've had some guests on who have said that they think we might see a different Jerome Powell in the press conference this time because he is nearing his end in his term as Fed chair. Do you have any expectations that we might see a less controlled Powell than we usually have seen?
Well, I definitely think that the whole Fed knows that his days are numbered and he will be soon gone. And probably going to be Kevin Hassett. Kevin Warsh will be replacing him, who the market will view as more dovish. I'm not convinced of that. But to your
They had
point,
a lot of
yes,
volatility last
there will be
week.
more dissension in the Fed. But I don't believe Jay Powell's changing his stance. I don't ever think he cared about anything other than his legacy and doing a good job.
I'm really not seeing any news that could cause
I don't
this.
think he's politically motivated at all. I think
Homeland Republicans warn of rising threats to law enforcement driven by dangerous rhetoric.
when you know that your leader's days are numbered.
All right, and
Well,
Jim,
that's a
listen, if
fact.
Powell does continue to ease in support of workers and the labor market, do you have any concerns that we might reignite this debasement trade?
Yeah, I definitely do, and I'm
Inflation expectations for November is 3.2 versus 3.2 prior.
going to be run away again. I think that the productivity gains we're making with AI and this hugely disruptive technology will kind of be a headwind to runaway inflation. That being said, I think that they will stay easy, and I think he would prefer inflation to stay around 2.5 to 2.8% for a lot of different reasons that we probably don't have time to get into. But that, yes, that will fuel the debasement trade. Silver's up 100% year to date. Platinum, copper, palladium, all up an average of about 50% year to date, and that's not even mentioning gold. These are markets that are flashing concern about debasement. Our deficits have exploded, our debt has exploded, and there are many of the opinion that in 2026 things could get better from a tax standpoint when deregulation and different tax policy starts to kick in more. But I think there's considerable worry about that, and I'm not getting out of the debasement trade yet.
All right, and you mentioned the data and inflation. We did finally get the PCE report, albeit a delayed PCE report, so late information, but at least some information because of the government shutdown. We saw an interesting reaction to it, though. We saw stocks rally, but rates didn't. What does that divergence signal to you?
So I think what it says is that the stock market was just saying, is there anything that's coming out in this that's going to change the bull thesis that we have? And the answer to that is probably no. Now, the rate market's probably looked at it at a more granular level because they have to adjust more in real time where the stocks are looking out. So the stocks looked at it and said, yeah, inflation is probably a little higher than the
Three black crows with a tweezer bottom on the 5 minute.
Probably a little higher than the Fed wants it, but not enough to change our thesis that liquidity is going to keep coming into the market to address the labor market. And that's why stocks, in my opinion,
684 strikes.
It used to be all we were talking about is AI. Now we're talking about that trade broadening out a little bit. You mentioned the debasement, and within the debasement trade, the industrial metals like silver, copper, platinum, palladium, they are part of the next-gen AI, where we talk about data centers and power needs, and those things then come into play, which I find very interesting. I think it's an example of the trade broadening.
And Jim, a question for you here about just the general economy. We got so many retail earnings last week. They continue to reinforce this idea of a K-shaped economy, of a bifurcated economy, that we're having the upper 10% continue spending and spending freely, but also seeing struggling with the lower income struggling to spend, stretching dollars as far as they can. As far as how that affects the Fed, what side are they prioritizing, or did they look at the K on the whole, or is there one part that needs more focus than the other?
So this makes their job absolutely impossible. I think they are focusing on the 60 or 70%, the non-asset holders that feel like they've been left out of this move.
They are not. If they were, they'd be cutting rates.
For the first time in history, we've seen a divergence between sentiment numbers and equity.
I disagree with you big time.
I don't think it's in spite of higher equity prices. I think it's because of. I think there's a lot of people who are very upset that asset prices are going higher and they have been left out. I think the Fed has changed their focus to the 60 to 70% of the people who may already be in a recession. I'll couple that with, I don't know if you saw the Dollar Tree, Dollar Store earnings from last week, and they came out on their calls saying that their new users are people making over $100,000. To me, means that's a lot of people who are making different decisions about how they're going to spend their money because they're not as confident as where things are going. I think it's a really, really impossible situation for the Fed. And that's why the basement trade is going to be fueled, because they have to address the people that are suffering, despite the fact that, as you said, the 10% highest asset holders are driving 50% of the consumption. Another record and not a very good signal as well.
Yeah, and I covered all of the dollar earning, Dollar Store, Dollar General, Dollar Tree, and we had Five Below, and you know, all kind of echoing the same thing. And at the same time, we get the University of Michigan Sentiment Survey, and that divergence, what that's signaling. Do you think that any of that is amplified by social media and all the commentary around how well the asset holders are doing versus the non-asset holders? Because it's one of the first times in history we've actually seen a divergence of the two, where equities are moving higher, sentiment seems to be moving lower. And you know, while it came in where it's expected, it's still deeply below where we were at the same point last year.
There is no question about that. It is the information age, and everyone has access to it. And there's a lot of people whose clickbait is to convince people how bad they have it to keep them reading the article. That being said, I think that the messages they're getting are the correct messages. I really do think things have been slanted against.
This is a tight stop on this one.
But I do think, to your point, we're in a situation now where you can, if you have a bias, if you think the world is slanted against you, you can so easily find confirmation on that on social media, and it reinforces that loop. And I think it's a very big deal. It's huge.
So if we're in this K-shaped economy and the Fed's focus is on the lower half, on that lower 60 to 70%, what does that mean for portfolios heading into 2026? How should people be positioned?
See, I think it's ultimately good for investors, and I think it's good. I think the AI trade is stretched, and I think that's scary to me, because if it corrects to the tune of 25%, remember just how much passive money has gone into those big 7 companies just based on how much they occupy all the broader indexes. So I think those could correct easily. I'm slanting more towards a hedged position in technology, and then second derivative plays like energy, particularly as it relates to metals and conductivity, and companies that are going to be using AI, not necessarily be on the cutting edge of creating AI, but companies like Walmart and John Deere and agriculture companies that will be using that to make their systems more productive. So I think there's a lot left in it, but I think you have to be prepared for a quick 20-25% drawdown in the AI names, the big ones, the top 7, just because of how stretched they are. And I think that's coming within the next year. And again, that opinion is relatively worthless, because you can say that things are in a bubble, which I am, but that doesn't mean I know exactly when it's going to come crashing down. But I do know how I'm hedged, and that's what those positions are hedged with more emphasis put on the secondary
bubble.
Jim, always a pleasure speaking with you. Thanks for taking the time to be with us this morning on Trading 360. That's Jim Uriel, Managing Director at TJM Institutional Services. And we've got plenty more to come, of course, on Trading 360. Next, we've got 3 stocks, 3 charts, 3 trades. Rick Ducat will be here to take us through the technical.
Come on, let's go.
Take us through the trades for Alphabet, Critical Metals, and SoFi. That's next on Trading 360 on Schwab Network.
God, come on.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute by minute breakdown of the biggest headlines, earnings, global movers, just the trades that matter.
Down 15 cents on that right there.
Markets react in real time. Opening Bell, live at the NYSE, right when it counts.
Believe me, when it comes to investing, you'll love Carl's way. Take a left here, please. But there's a Carl's way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No
can do.
I'll get out there.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex.
I'll be right back. I'm gonna go put my burger on.
And access support by phone, email, and in-platform chat.
Seems like it's the worst trading day of my year.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest, trade, and around.
And if you want, they can even manage for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all of its own fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the CBOE, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
Believe me, when it comes to investing, you'll love Carl's way. Take a left here, please. But there's a Carl's way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No
can do.
I'll get out there.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Back trading 360, I'm Marley Kate. It's time for the big three. We've got three stops and three charts for you. Rick Dukan, of course, here to take us through the charts. Here to take us through the trades today. Achilles Lorraine, Jr., the founder and CEO of Lorraine Wealth Management. Great to have you both with us. Achilles, I'd love to start with a big picture thought on market action that we're seeing as we are now kicking off the all-important Fed week.
Yeah, there's a lot of interesting things coming up before the Fed meeting. A lot of what I would call snoozing things first. But let's talk about where we think the market's going. First off, we're seeing inflation start to creep up, and hence the Fed action or inaction coming up on Wednesday. Second thing, we're also seeing an increase as far as corporate earnings are concerned. And we're seeing anywhere between 5 to 9%, which could raise the S&P easily into the 7,400 range for Q1 26. So that's another thing we're seeing. Another thing we're seeing in the technology, I mean, not everybody is going into the AI space at this particular point, and there are a lot of opportunities in aerospace, a lot of opportunities in infrastructure. So this is another area that we're looking at very closely at this point. We think overall the positive sentiment is the market is moving in the right direction, although we are starting to lose a little steam at this particular point, but full steam ahead easily when Q1 comes out.
Yeah, we could use a little steam this morning right now. I was just checking the board while we were talking. The Russell's still holding on, but the rest under pressure. And so are your choices today, too. I was across the board, all three under pressure. Let's talk about the first one. You've got Alphabet as your first one. Walk us through this first pick for the big three.
Yeah, I'm not a big believer in only owning the biggest in the sector. When we're talking about chips, they came out with a chip that was exciting because it's competition for NVIDIA. Why not own both of them? High quality in the portfolio, and what better time to own it than when people think that increased competition is going to drive prices down. If you learn anything about this particular sector, prices aren't going down anytime soon. We're still, as far as
got to break the 9 on the 5 minute.
The infrastructure in its infancy, although it is right now
The SPY, I'm up a whopping $40.
It's a very tough thing to put at this point. We're looking at a double-digit growth in this sector. For Google, we're looking.
That's on the 5 minute.
Anywhere between
We haven't been able to break the 9 at all on the 5 minute.
That's on the conservative side at this particular point. It's important.
But if we can, that could be a good catalyst.
Both of these type stocks. If you want
to get back up to the 5 minute orb
in your portfolio, this could be a great addition. Or if you're accumulating, you own it already, not a bad price point to get in, and for long-term hold, could be high quality. Then another thing that I would say, as far as this particular stock is concerned, it's not all about the chips. There's plenty of room for growth at this company, and as we say here with the lottery, you got to be in it to win it.
I absolutely got to be in it to win it. And this is a conversation we've had a lot when we talk about Alphabet and Google when they entered the potential chip trade here, is that they have so much diversification and so many different growth drivers here. But you mentioned maybe a good point to get in. Right now trading at 316.25, down about 1.75%, Rick. When we look at the chart, I can see this steeply upward moving channel, but what are the technicals telling us?
Yes, and if you were to look at it a little bit more from a granular perspective, you can see that it has this stair-step type of price activity of rapid surges to the upside, followed by horizontal consolidation. So right now it seems like we are within another of these more horizontal phases here. You could say very short term, between about 315 to 325 or so. But really, if you were to expand out a little bit, around 307 or so is where we had our highs roughly before we had our gap to the upside here. So perhaps 306, 307 to the downside. Then our intraday highs 328.67. So that gives us some points to consider here going forward.
But we're still, and we got the 50 here. We almost got a crossover.
21-day EMA comes in at about 304. So around that where that gap would be filled, there would be an additional source of support here. Below that, 291. Series of old highs as well. In terms of our moving averages, though, not really
9's crossing the 21 on the 1 minute.
More attention than that here. When you have these fast movements to the upside, the moving averages get left behind. They're a lagging indicator by nature. Our RSI giving us kind of an interesting situation here to consider here. Triangular trend lines converging toward each other, rapid and repeated crossovers into the overbought territory, but now we have given that up for now. It'll be interesting to see what happens if we break below that green trend line as well. So finally, when we look at our volume profile study, you can easily see the trading nodes here, these heavy trading activities, kind of lining up with these horizontal ranges. So
we're at 112.
in the node here about 320 or so, and the next node to the downside is around 385. So those are the points to consider from that line of thinking.
Yeah, and right now 316.31. We're up about 80% over the last 6 months when it comes to Alphabet. Very different story, though, with this next pick. Critical metals, heavily under pressure the last month. They've been down, close to 12%. Walk through your thesis on this one.
Yeah, it's funny. This is the type we're value buyers, so we're always looking for undervalued securities. We're also seeing the relationship between China and the U.S. affecting it at this particular point. Have to remember we had a trade war. Haven't resolved that at this particular point, but the stock is what I would call risk capital. So if you're going to take 1 to 3% of your portfolio and put it into a name like this, you should be well rewarded going forward. Yeah, it's been under pressure to the tune of double digits, but when is the best time to buy something that everybody needs? The U.S. needs these rare metals, and China is the biggest supplier of this. We do not really have a supplier here in the United States. So this company, Critical, is what I feel the best value in the sector right now, and could be easily double-digit, working its way back on a double-digit positive side. We think that it's undervalued at this particular point. Could go up about 10% in the next 18 months, but it is, I repeat, risk capital. What we see going forward with a stock like this is that there was potential, there was it was necessary, but now it should be part of the risk capital part of our portfolios, and give things a little bit of high octane too. Could go down further, we accumulate more. Right now we're quietly accumulating. Could get a little more aggressive if it should go down another point, but I don't see that at this particular point. I see Washington and China and Beijing actually working on solutions for the betterment of trades, and this stock is going to be a beneficiary of that long term.
And Achilles, you mentioned high octane. Now, I said they've been under pressure the last month, but when I look at the last 6 months, they're up almost 600%, which you can clearly see that spike popping there on the technicals here. So, Rick, walk us through the action that we've seen, where we clearly had a peak, but we've since, fallen way off of that.
That spike represents many different things to me here, because if you were bullish in this name and you made a good trade, that's great, but it also represents legislative risk here. You can see that this is kind of the area when the government started taking a stake in lithium companies and everything. So just something to consider, that the landscape could change very quickly in this particular region here. But $7, our green line here, stands out because it was old resistance and then it was support once again, and then we can see it came back into prominence here as a ceiling. Then we had our explosive push to the upside. We retreated back to that $7 level, and we held firm though. So this was a notable test of potential support here that did hold on. Now we have re-entered above our white upward sloping trend line there that was just very briefly broken. So that could be an area to watch going forward. Now that comes in maybe around 9 right now. Some other high points to consider here. Our next set of relative highs around 1166, and another here around 1388 or so. Those could be some upside levels to watch. When we look at our moving averages here, price has held on above all 3 of our moving averages. We crossed above, and we are on our 63-day EMA of orange there. That comes in right around the 950 level or so, so a short-term point to consider. RSI improving, green trend line in play. We are above the 50 midline, suggesting greater bullishness. Finally, when we look at our volume profile study, point of control all the way down
still
to
in
the
it
trading area
from 95 cents.
Where we're at right now.
Now we got to break to 63.
Near the $6 level. To the upside, things really start to thin out once we get above 16, so that could be the point where we start seeing some very fast-moving prices. Still a ways to go, though, from where we are now.
All right, and right now trading at 966 for critical metals. This last one, an interesting one that we've talked about a bit over the last week. They had their earnings. We've seen a bit of tug of war between the bulls and the bears about their thoughts. Then they announced this $1.5 billion stock offering. That was not met with a lot of positivity from the street. We're talking about SoFi here. Why is this your third pick, Achilles?
Yeah, we think in the financial sector has been beaten down quite a bit. We've seen a lot of near-term resistance. I'm sure Rick will agree with me. It's just the whole sector as a whole has been beaten down. We think that in terms of valuation, the
We're at
stock is still
110.
undervalued.
I'm up
We think that it's
150.
going to be heading up 10 to
170.
14%
I'd like to get this
in an
like 150.
18-month period. And we base that based on what we've seen in the past with this stock. If you just look at what we're seeing here, this has been beaten back, the whole sector as a whole. We want to make sure that we're owning in the financial sector.
If we break to 63, I might add another
we
10.
That this is one of them, but we also see this as a turnaround target to make even more money at this particular point. Well, SoFi is one of these technology companies. You know, it could be $20, and then the next thing you know, it could be 40. You know, it's one of those stocks where it hasn't really found its footing right now. So there's a lot more potential in this stock that we see going forward, and the whole sector is starting to turn around. Right
Tesla's now 337. We're at support on Tesla then.
All right, Rick, as we take a look
Or
at SoFi
to
and
go.
FinTech, and Achilles highlighted potentially some of the areas of resistance.
Oh, yeah.
You know, where are we seeing those in terms of on the technicals?
Well, resistance in the short term could be found.
Tesla's, it triggered my support.
Current prices 28.48. That's the low point before we had our gap down. So that's one very short-term resistance point to consider. See if that gap gets filled, and then see what happens. Beyond that, we have our next set of relative highs near.
But I don't know. It's still got that downgrade. Might take a couple days.
We had our blue trend line sloping upward, and then things have gotten a little bit more choppy here. You can see our notable low points. One right here, 24.84 was a intraday low. We had another here, 23.70. In terms of closing prices, we managed to hang on above that same level. Our intraday low held on around that same point as well. So some encouraging signs for the bulls despite a bit of chop here. Notice as well, until we had this point, we also were seeing gradually grinding upward price activity in terms of our highs here. So now, if we do manage to reassert ourselves in terms of a bullish trend line, we could see this white trend line being broken, and we could see these resistance levels become the next tests. So now we can see our moving averages here. We are between our yellow 21-day and orange 63-day. Some very short-term boundaries, 27.35 and 28.33 could be some points to watch. Momentum slowing down somewhat here. Still trending downward here and across below that 50 midline. However, what you would want to see would be RSI making some kind of breakout in tandem with price activity. So if we do start to see momentum rise again, look for price and RSI to break out together. Our volume profile shows much of the trading activity is in this large kind of lump here between about 25 to 29. So if we start getting above 29, that's the thin trading areas. That could be the fast-moving breakout activity that you might want to be on the lookout for. And if you do start to move below that,
Almost an ascending triangle.
Here, it's our supportive zone once again between about 24 to 25 or so.
Yeah, that's just below where we're trading right now, 27.25 for SoFi. Down close to 2% today, but year-to-date trading up 76% higher. Want to thank you both for being with us today, of course, for the big three. Achilles Larea from Larea Wealth Management and Rick Ducat, our chart master here on Schwab Network, for always being with us. And coming up next, we're going to spotlight the latest in the Warner Brothers Discovery saga as Paramount Skydance announces plans to launch a hostile bid for the streaming company. That's next on Trading 360.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart.
Okay, we're at number 4. If you can count to 4, we might make a little more.
Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Stay connected to what moves the market. Download the Schwab Network app and stream anytime wherever you are.
It's a bummer. I was up 180. Now I'm only up 10.
Welcome back to Trading 360. I'm Marley Caden, live in our Chicago headquarters. It's time to spotlight the
Just
latest
in that little
Netflix
bit.
takeover bid for Warner Brothers Discovery. Joining us now is Dan Rayburn, streaming media analyst, to discuss all of these updates that we're getting on this story. Dan, thanks for taking the time to talk to us. You know, this has been a major
Today might be a
focus.
day
We
to take
finally got
off.
the announcement that Netflix is the winning suitor, had the best
If
bid.
you're a rookie.
Now we're getting reports that Paramount Skydance is going to try to launch a hostile takeover bid. First, let's talk about Netflix and your initial reaction to Netflix being the choice from Warner Brothers Discovery.
Thanks for having me. Yeah, this is getting really interesting and not surprising. When we first saw Netflix offer for WBD, obviously not the whole company like Paramount's offering, we knew this wasn't the end of it. So it's not surprising that Paramount's coming in. In Netflix offer, it really depends on how people are looking at the overall business. Keep in mind that Netflix is not looking to take on the legacy side of the business and the linear TV channels, which is really completely separate. The other thing on the timing here is Netflix is saying 12 to 18 months they think for the deal to close, but the deal can't even close or really start to close until WBD does its split, which originally
We're at the 200 on the 1 hour on Tesla. On a normal day, I'd probably take this trade.
So there are so many unknowns in this deal, and everybody is looking at this differently depending on how they're tied into it, whether they're a shareholder or they're a member of the media or whatnot. But I think the most important thing to remember here is this is a long way from being done. There's a lot of regulatory approval that needs to happen as well. And we also don't know what the current administration is going to do with regards to the deal.
Yeah, we certainly don't. We are getting a little bit of commentary. We heard from a White House official.
Tesla faces challenging EV outlook, Morgan Stanley says.
About some more potential scrutiny. As far as the regulatory risk here,
I disagree.
what do you think the odds are that this will actually go through? Let's just focus here on America first, because when we're talking about this deal, this is not just a domestic story. We have an international component here as well.
Correct, yes, that's absolutely right. The EU will look at it as well. In the U.S., I can't give odds because my odds are going to be just as bad or as good as anybody else. Right, you're making a guess that's not based on any data, so it's not really educated. What we do know here is that Netflix is not looking at the linear side of the business for WBD, so you're not going to have the FCC involved because it doesn't involve broadcast channels. That said, we've already seen some members of Congress and Senate coming out and saying that Netflix will have too much power.
I'd like to know the reasoning behind it.
For instance, they're saying Netflix will have over 50%.
Morgan Stanley downgraded the company's stock rating equal weight to overweight and raised the price. They raised the price
Part of
target.
the problem we're going to have in this deal is people are using lots of different numbers without definitions, without any sort of.
But they downgraded.
This is going to come down to one thing and one thing only in these deals is politics.
Does that make sense?
It's going to determine what happens from a regulatory standpoint. It's not about what's on the balance sheet. This is about politicians getting involved. Which way that's going to go, I'm not going to take a guess at this point. As far as the EU goes, they're going to take a look at it. But historically, the EU has not tried to stop mergers. What the EU has traditionally done is put terms in the merger. So if it does happen and we approve it, these are some of the terms we want to see. But it's rare for the EU to really stop or try and prevent mergers from happening.
All right, so let's now add Paramount into this conversation. They came out, they said, we're coming back with this hostile all-cash bid. It does appear to be the same.
They downgrade Tesla to equal weight, but raised the price target to $425.
They're going right to the board and to shareholders here. You know, how seriously should the markets take this challenge? And also, I'm adding a second part to this. They're arguing that their deal would face a much shorter regulatory path. Do you think they have a point there?
Yeah, it's a good question. So on that, we don't know. Because again, we don't know the politics behind this of what's already been discussed with whom and who might say, hey, if this deal is proposed, it would have a shorter time to close. We just don't know. That's speculation right now. But keep in mind, too, that these deals are very different in the sense that Paramount is looking to acquire all of WBD, which includes the linear channels, which Paramount is already in the business of. Netflix isn't. So you have to keep that into perspective. Also, the $30 per share, all cash. Yes, I see some reporting it's $18 billion more than Netflix is offering. But again, that includes the linear TV business. So it's not really fair to say it's $18 billion more in value because Netflix is not trying to get the linear TV assets. So it's a little unknown here. I do think if you just look at this on paper, as far as regulatory goes, Paramount is obviously a studio, right? Netflix isn't the way most people.
I'm still in my calls at 95.
Studios and movie
We're
studios.
at 92.
Paramount also has linear channels, and WBD does as well. So on paper, do I think a potential acquisition by Paramount is easier from a regulatory standpoint? I think it is, probably with terms. But that said, you know, this $30 deal per share was already offered apparently, and WBD's board approved the Netflix one. However, as you and I well know, this all comes down to what shareholders approve and what they vote on.
Yeah, certainly. To be in the room where it happens, right? To know those details. But I guess my last question is, do you think there's a realistic scenario where the board comes back and just says, we're walking away from Netflix, we're going with Paramount, or that they use it to extract more from Netflix? Or let me throw the third possibility in there.
She looks hot today again.
Comcast comes back into the conversation and says, no, we've got a better deal. Well, what's the outcome here?
Yeah, all great questions. I don't think the Comcast one, though, I think they're out of the running there. Those are all great questions and things we don't know. But let's go to the root cause here. What consumers really want to know is my price going to go up? What's bundling going to look like? All these things we don't know. However, I will end with saying this. It's interesting how many people are saying they don't want these two services to combine because Netflix will be too big. And yet, as consumers, aren't we complaining that we have too many streaming services?
Mr. bounced stuff off that support.
So wouldn't two services combining into one where we can get more content, only pay one price with only one?
Not much, but it bounced up.
Would that be beneficial for consumers? I think it would be.
Yeah, it bounced
But
up.
It's interesting how many are saying
$5.
they don't want to remove another competitor in
Come
the
on,
market.
Spy.
We already have so many.
Don't let me
Dan,
down.
I am on team, let's just pay one bill for the streaming services, because
Yes.
I think I may even have two Netflix accounts at this point.
There you go.
I'm not even sure, but I am consolidation, pro-consolidation. Appreciate you being with us to walk
Thank you,
through
ma'am.
this story that's getting ever complicated by the day. We appreciate your insight. That's Dan Rayburn, streaming media analyst. And coming up next, we've got the disruptors. We're taking a look at Marvell today following a downgrade and reports of a potential loss of a major customer. We'll tell you who when we come right back.
Back to even.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on
We
Schwab
did break out of the channel on the
And
SPX.
streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started,
God darn it, back
Charles
down to
Schwab offers a
89.
webcast that's right for you. Do you like using charts when analyzing
Devastating.
stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Let me try something here.
Welcome back to Trading 360. I'm Marley Caden here in our Chicago headquarters. Let's head out to the New York Stock Exchange. Welcome in Nicole Petalides, host of Opening Bell and The Watch List. Nicole, good morning to you, and thank you for being with us today. You want to talk about Apple right now. Shares were down, more than 1% earlier, recovering slightly on two bullish price target hikes that we're seeing. One from a very influential name on the street. Of course, I'm talking about Dan Ives at Wedbush. Can you walk us through the note and why we're seeing these increases?
Yeah, really interesting. First of all, Apple has been the come from behind Mag 7 name. Sometimes people thought Apple wasn't innovative enough, didn't have enough new products. It turns out the 17 is selling very well. Even in China, we were talking about how much it was doing so well there. So I'll tell you the Dan Ives one first, since you brought that up here. So Wedbush now has a price target of $350, up from $320. The stock is trading at $277. So that $350 target really shows upside potential. It's also a winner year to date, up about 10%. And why does he have a $350 target? He talked about, in fact, the solid iPhone sales. also the AI efforts that the company has been making, and so put that outperform rating. Now on the street, the average price target, according to Zacks, is at 290, so he's definitely on the higher end. The other one is Evercore ISI, and Evercore also has a high target, 325. So that is a winner as well. When you see the stock here at 277, of course, Apple has been under the microscope because executives have been leaving, and that's been a big story. They've had about a half a dozen folks leaving or considering leaving, one retiring, the general counsel, also a chief in the chip area. You had AI chief John Andrea saying he was retiring. Johnny Ive left back in 2019. The design lead just got taken and poached by Meta. We know Meta's been paying some big money for AI executives, and poached Alan Dye going over. So he was the design lead. So that's one thing about what's going on in the C-suite with Apple. But the 17 is doing so well, and now it's one at 350 and one at 325. Marley.
Yeah, and like you mentioned, well above where they're trading right now, right at 277.21. Shares down about 0.5%. Nicole, we appreciate you walking us through those analyst notes this morning. That's Nicole Petalides. And now it's time for the disruptors. George Tillis, our senior markets correspondent, here with today's company. We're talking about Marvell after it got downgraded to hold at benchmark. The information reporting the potential Microsoft loss, also another potential client loss. A lot to unpack here. None of it good for Marvell. Shares down almost 10% today. Can you walk us through the latest, George?
Yeah, Marley, if you take a look at Marvell, which we still have a trade on from about a week and a half ago from prior to earnings on December 2nd. We'll talk about it in a sec. But if you consider Marvell in terms of what they do, this is important because they're mostly in data center sales, about 75%, which primarily include their ASICs chips or application-specific integrated circuit chips, known as XPU.
Marvell downgraded to a hold at benchmark.
Smaller player in this space, considering the behemoth in the market, which is Broadcom or AVGO. And if you look at essentially their breakdown in sales, also they also have enterprise networking and of course carrier infrastructure, semiconductor solutions.
I'm still in these spies are at 92.
But the data center market is really key for Marvell.
The 684s.
Marvell, which
Marvell.
Insulated,
Marvell down $13.
Is the percent of sales of Marvell's technologies are still pretty concentrated in areas like China, with about 29% based upon last reported earnings in terms of deliveries. But that's actually come down from about 40% last year. But nonetheless, the news today, actually is quite concerning. If you look at Benchmark's call, I mean, first off, they did not, reiterate any price target. They basically removed a price target, and they moved their rating to a hold, basically from buy, or they placed it on hold. And what they see is, based on industry group meetings that they've had, there's a pretty good chance, based on what their estimates are, that Marvell's deals that they have with Amazon may may fall through the cracks. In other words, what I suggest is possibly a couple of competitors, including AI chip out of Taiwan, maybe Broadcom.
I hate being in these trades like this for so long, 5, 10, 15, 20, 25, 30 minutes.
Doing the same thing, but at the same time, Marvell's
35, actually longer than that.
Irrespective of that, if you look at some of the analysts too, just going back on the 4th,
it's at 90,
report, which was actually quite good. There was a little bit of a hang-up in terms of gross margins, but there was a stock buyback to help make up for that. UBS actually increased their target to 120 from 110, and like I said, this is just about a week ago. Consensus right now, from an analyst standpoint, is at 116 with a high right around 156, low on 67. So Benchmark's call is more subjective in nature, based on their interpretation from their discussions in industry group, conversations. But nonetheless, the stock is down. It's backfilled the gap since it moved higher on earnings.
Yeah, and that average target you mentioned is well above where we are right now at 89.43, but a very choppy chart. The last 6 months up 30%, but if you go out the full 12 months, down more than 20%. So as you're structuring a trade here on the heels of this note and some of the potential losses of these big customers here, how would you approach Marvell right now, George?
Well, I think you bring up great attributes on the chart. The stock is down year to date, very choppy. So in my interpretation, the stock price really reflects the challenges the company is already facing. So even though the stock is down today, by quite a bit, it's backfilled the gap from earnings, but it may just end up holding or drifting sideways for a while. I don't expect a lot of movement is what I'm trying to say. If you look at the area of support that it's coming into or possibly coming into, the 50-day moving average is right around $87. So I'm going to play this as a potential backfill hold going out to January. I'm going to sell a cash secured put. So in this case, I can earn some yield while the stock sort of settles out or tries to decide in which direction it wants to go. So I'm going to sell the 85 put for January with over 40 days to, or close to 40 days to expiration. You can actually earn about $4 a share by structuring this trade, or $400 a contract. So in essence, the objective of the trade is for the $85 level to hold. You'll still achieve max profit, and so in other words, the stock could actually fall.
I got stopped out of the SPX.
And still achieve max profit. You're earning about 4.9% yield to the strike price, and the stock could also fall approximately 9.5% based on current levels approximately to break even, which is $81. So again, if you structure this trade, you have to be willing and able to take ownership 85 with a cost basis of 81. And again, the technical pattern fits.
Damn it! There it
alongside
goes.
the delta on that put option that I'm selling, which is around a 34 delta.
Yep.
George, we appreciate you
I'm about
being
ready
with
to
us.
sit this
Trading
one
just
out
above those levels you highlighted, the 85 and the 81 right now at 89.48 for Marvell, down about 9.5% on the heels of those notes from Benchmark. Appreciate it, George Tillis. Thanks for that example trade and for walking us through the news. Now it's time for our 360 round. For that, let's bring in our panel to discuss the latest in large language models and the race that is ChatGPT versus Gemini. Joining us, Shai Valor, the chief market strategist at Futurum Equities, and Thomas I, the founder of the Sevens Report. Thank you both for being with us. We got this Gemini release. It came out
Had
with
some
pretty
hope there.
rave reviews. Then we hear about this code red from Sam Altman over at OpenAI, and now hearing rumblings that ChatGPT may be putting out.
Even when I have a
as soon as
tough day, I want to
tomorrow.
walk away.
Shai, I'll start with you. What are your thoughts overall just on one against the other as they currently stand?
All these downgrades came in today. It's like the fat cats went to the back door and, well, we're downgrading this, but we're still calling it a hold.
What I mean by that is the cost
We're downgrading this, but we're raising the price target up.
The gap between the models is also closing. So the moat no longer is the model itself. It's who can distribute AI at the largest scale across hardware, apps, devices, and enterprise workflows. Sam Altman knows this better than anyone else, and that's exactly why he called it code red last week. If ChatGPT is not clearly better than Google's Gemini inside Search or Android, or better than Microsoft's Copilot inside Windows or Office, or even better than Meta's AI inside Instagram or WhatsApp, then people will not switch.
It don't take long till you're in the hole.
What's happening right now with the dynamic on Sam Altman's getting the second gear of like code red. We need to
Just like that.
because if OpenAI cannot beat them on quality, reliability, and cost, then willingness to pay will collapse, and that is a real threat to OpenAI.
And Tom, I know from your notes, your argument's pretty clear. Gemini 3 is now better than the current ChatGPT. There are a lot of benchmarks and research to back up your thesis there. How big do you believe that performance gap
684s
is right now, and why is it important for real-world usage behavior?
So I think the performance gap is pretty sizable.
Support.
I think that the Gemini 3 update really caught a lot of people by surprise. And what's important for investors is to not look at this as just a one-off event. Right?
Damn
This
it.
is a culmination of an enormous race that's been occurring for nearly 3 years. 3 years ago, ChatGPT came on the scene, burst onto the scene, and sort of caught all of the major tech companies flat-footed, right? And since then, a lot of the spending that we have been seeing, this CapEx spending, buying semiconductors, is that the major tech companies were trying to catch up. Well, if Google has caught up and surpassed ChatGPT and they can't leapfrog them, then that's a very big potential issue for OpenAI to begin with. But from a user
Yeah, I'd be
standpoint,
careful.
it's
Today's
much more
just not a good
positive
day.
for AI adoption, because Google is obviously the market leader in search. It's much more natural for the vast majority of us to go to Google and use Gemini AI, especially if it's essentially built in on the back end, than it is to go to ChatGPT, because a lot of what you're seeing is bifurcation. So the fact that the market leader in search, by far and away the largest market leader, now has potentially the most useful
What are you asking, JM?
is a tremendous game changer and very positive for overall AI adoption. Very good for Google specifically.
All right, Shai, I want to come back to this argument you made about Gen AI moving into this commodity infrastructure here. What does OpenAI need to do to not get boxed out by Google, Microsoft, even maybe Meta as a part of this conversation? Because they already control some of the channels that you've mentioned, workload, hardware, operating systems.
To be honest, like the answer is going to be AGI, but we are ways away from that. I do think
You're at 70 cents now.
Approach on building a system where intelligence gets priced into every action that they do. And
Yeah, I'm still in them,
almost
but
be the centralized
I didn't get out in
marketplace for
time.
A bunch of different applications that want to go there, and they can start partnering up with all these horizontal SaaS or application companies. Try to find a way where every AI interaction has a somewhat of a cost and be the cheapest meter that runs across all these different types of functions. But it is a very tall
Check my
ask, because
emails.
when you have all these ecosystems, like I mentioned, that like Meta controls billions of people spending their time on their apps. You have also Gemini essentially trying to sell. They're not selling a standalone AI product. They're building a system where everything is into their ecosystem, and they have the cheapest meter to use AI across the board, and that's exactly why their Gemini 3 is such a chef's kiss, essentially, to the model race, because they have the cheapest economics for it, and also they have the best distribution. Those are the two levers to pull for model quality. So I do think that OpenAI probably will have to start pivoting towards more.
Warren Buffett is sending a clear warning as 2026 approaches.
Over the course of the next decade, and I think there is also a new, somewhat Sam Altman premium risk now that's being signed by the market.
Investors shouldn't panic despite fears in the stock market could fall.
Build-outs in the industry, mostly to support OpenAI, and they've gotten paid too much because of that Sam Altman premium risk. So now it's not going to be an easy level to pull of just spend. They have to be more conscious of what they're spending money towards, and they kind of need to have the meter of how they're going to pull the profitability a lot sooner than probably Sam thought he had to 6 months ago.
And Tom, last question to you. We're running a little bit tight on time, but we got some new data from Sensor Tower showing that Gemini's monthly active users are up 30% since August. ChatGPT only up 5%. Now, we know that we're getting a new ChatGPT likely this week. Do you think that that is enough to reverse these trends, or have we already started to signal a permanent shift?
Unless it's much better, it's probably a permanent shift. I mean, this is a code red for ChatGPT. There is a long history of first market movers in new technologies not surviving till the end. And I realize that's a bit parabolic to say, but just look at Prodigy and look at MySpace. First movers in the end were leapfrogged and didn't last. So I think this is very serious for OpenAI. They need to put out something awesome.
We appreciate you both being with us to talk about the ongoing chat models with ChatGPT and Gemini. Appreciate you both, Shai Valor from Futurum Equities and Thomas A from the Sevens Report. Also want to thank all of you for joining us today on Trading 360. I'm Marley Caden. You can download the free Schwab Network app available in the Apple App Store and tune in 24/7 on schwabnetwork.com. I'll be back with Sam Vadas with Market on Close at 3 p.m. Eastern, 2 Central. But stay with us. Fast Market with Diane King Hall is coming up next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab.
6845 level.
Tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas.
Well, if we don't hold this 50,
The show's built for action. We break it all down in real time with speed, accuracy, and precision.
I think one of the most
68, 45, 46.
defined way here going into earnings.
So that would be a further downside area.
The hour, the next one's right around
Actionable data, veteran traders, and trusted
23.
journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December 11th for 2026 Market Outlook, your guide to the forces shaping stocks, global markets, inflation, rates, and more. Hear from experts on where the markets may be headed, spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m.
68, 23, 60.
I'm Sam Bartis, live from the New York Stock Exchange. When the market
We hit the
moves,
50
we're
before
on
and
it,
bounced up
getting
off of
the
it
reaction, the strategy, and
Thursday.
sentiment in real time. Stream Schwab Network at schwabnetwork.com.
On the 1 hour, the SPX.
Welcome to Fast Market here on Schwab Network. I'm Diane King Hall. Coming up on noon Eastern here at the New York Stock Exchange, and trading activity has been choppy so far today as investors look ahead to the Fed.
Livid Goose Tesla's at the 200 EMA on the 1 hour.
On Wall Street.
My little support channel.
On the S&P 500 off by about 1/3%. You only got
And 435 is next if this doesn't hold here.
Information technology. Where is the biggest weakness? That would be communication services
And they got a price target
discretionary.
lowered to 420 or raised to 425. So we could see close to that.
100 is off by about 1/3% there. Russell 2000 small caps have the gains today. They're better by 1/4% as, again, we look ahead to the Fed. Here's the roadmap for today's show. We'll look at example option strategies for Tesla. It's being dinged
I've made most of my money on Tesla.
Plus, the team from Likefolio will be along with new sentiment data on Carvana. That one's been gaining
Tesla
ground.
and SPX and SPY
On our radar
are my top 3 winners.
now that we've got the roadmap for today's trading action,
But I've been
it's time
trading
to bring
Tesla
my
since
co-hosts and trading veterans. You've
2010.
got in our Chicago studio, and Kevin Higgins joining
When
us
it was really
live
moving.
from the SIBO. As you know, we've got
We're kind of at a
from
resistance
Exchange
level.
and beyond. All right, guys, the spotlight is on Netflix today. You've got the streamers jockeying for
And the
Warner
fat
Brothers
cats hate it.
Discovery. Latest now,
They don't like
the latest
Elon.
development, Paramount launching this hostile bid for WBD. Tom, what's your take when you look across this landscape?
Yeah, it's not surprising
I'm
that
gonna
we're
go put
getting
my
a little bit of turmoil
plate
here,
up.
you know, with this
I'm not gonna
deal
trade
because
much.
of the fact that this is an all-cash deal at $30 a share.
There's
maybe it's
support
a little
right
bit better
there.
than Netflix's. You do get some stock.
Let me look
with
at
the
Tesla,
Netflix
just to look
bid.
at it.
I think this is just kind of reflective that this is going to get
SPY
drawn
at
out.
50
This is
cents.
going to be a fight at this point as far as the takeover of Warner Brothers Discovery, and maybe that's what David
Yeah,
Zaslav
nothing's
wants
holding.
at this
Nothing's
point.
holding today. Nothing.
You know, because of their
Nothing I
shareholders
like.
have been rewarded pretty handsomely.
I'm not gonna
without
call any more
anything
trades out.
concrete right now. But one of the things that kind of stuck out to me on this proposed deal from Paramount, you know, is the fact that basically Warner Brothers Discovery didn't come back to them, and you know, Paramount didn't say that this was going to be their best offer. So to kind of go with Netflix on this, maybe there's some more due diligence that's due on this. It's going to get dragged
take a
out
couple aspirin.
regardless whether there's going to be
My legs are killing me.
you know, that that antitrust.
I'll show you what I did
concerns
this
here,
weekend.
Does it even pass?
Oh,
they
God.
agree to get acquired
It just
by,
really hurt my
Netflix
legs.
instead of Paramount. So a lot of questions still up in the air on this one. But
I'm getting too old, I think,
Paramount
to be working like I do.
Discovery on the news.
It's interesting to see this. I mean, the street likes the idea.
But I don't do this
with,
very often, but I did this
Skydance
weekend.
rallying more than
I pushed my
7%
limits.
on this. And I was listening to part of that interview with David Ellison on CNBC, and one of the points that he made was that they had obviously tried for this, and they said cash is king. So to them, I mean, that's really trying to do something, I guess, for their shareholders. Kevin, what's your take?
Good morning, Diane and Tom. Yeah, David Ellison was probably only 20 or 30 feet away from you, Diane, making his case. And frankly, I listened to the whole interview. It was a good case that he made. And so you can just see
this
the
trim
this stock. Remember, we said last week when this deal was
goes
announced,
all the
that it
way
was gonna
around.
take some time. Well, now it's going to take even longer.
About an 8,000 square foot building.
When you've got a last name
And it's on
Ellison,
every door, every wall. And then you got two or three of
and money
these.
is not going to be an issue. And so now you've got.
And they came in and replaced this carpet.
The Trump
They had flooding in the back here. They had to go and cut out walls and
This is going to get real interesting.
fix the
Final
flood.
chapters on this have not even been written yet.
So they just put the carpet in.
Why Netflix is selling off today? Not
And I had to go in here and clean up
they're
all
gonna
this
lose.
trim with
I
dust.
think if they lost,
And I went
the
all
stock
the
might
way
actually
around the
rally,
whole building.
but because it might cost
Took about
them
9
more money
hours.
Is why it's not rallying today. So
Wipe
Diane,
it down
I said
and
this earlier today when I was speaking to you. This
oil
is
it
just
down
getting
and
started,
pledge it.
And you got to look
I'm
out.
getting on my knees, crawling on my knees
18, now maybe even
all the way
24
around.
for resolution in this matter. It's
All
going to
the
be
way around.
it's going to be lots of chapters and lots of headlines in this story.
Which is, when you think about 24 months, it's a long time
Oh,
for
there's a piece of
investors,
tape on that door.
especially, if they're
Hope I
just
got
looking
that.
for, kind of a short-term
I think
play
I did.
here. All right, but you can't think of it that way given the long, drawn-out process
I know
this
I
may
did.
take. All right, guys, we led into the show talking about the Fed. We've got to focus on the Fed this week.
But
The
I mean, there's
expectation is
dust
we'll
all
get a
over
rate
the
cut,
stuff
but the
and all over
question
the
is,
shelves.
what does the path forward for 2026 look like, and possibly more dissent?
And I got
Tom,
me
what's
some
your
knee
take when you think about
pads
the Fed
and
this week?
for 9 hours I was on my knees, up and down, up and down, up and down.
I think
I'm so
a lot's
sore.
going to have to do with the commentary from Fed Chair Powell and the narrative that they have. Are they going to be, a 25 basis point cut with a dovish take or with a hawkish? I think it's probably, bifurcated at this point. Remember, the last vote at the contentious meeting in October was 10-2. With a couple dissenters. Somebody didn't want to cut at all. Myron wanted 50 basis point cut. So we'll probably see more contention in this meeting and maybe some of the commentary. Now, we won't get a read on that. Maybe Fed Chair Powell during his Q&A will answer those questions. Fresh dot plots are going to be released. It's not clear how much the medians have changed. Last quarter's medians, they showed a 3.6% rate for this year, 3.4% for 2026, 3.1% for 2027 and 2028. I think one of the interesting things is, and maybe why we're under a little bit of pressure here today, is the fact that the 10-year yield hit 2.5-month highs.
I should have counted all the doors I did.
Earlier on in the
I know the
session.
front
So,
alone had 1,
everybody
2,
wants these
3,
rate cuts,
4,
and it's going to be beneficial
5,
maybe
6,
from the
7,
consumer side, maybe on auto loans or something like that.
8.
Is it going to help
Just
the
in the
housing
front.
market when you've got the 10-year yield, which the 30-year
With all that trim.
mortgage rate is based off of, is actually firming up?
1,
and getting
2,
to
3, 4,
2.5-month
5,
highs. It's
6,
not gonna
7,
help
8.
The
Yep.
the housing market at this point, just because they've already been in a recession. We just haven't called it that at this point. So, yeah, I think there's,
put new
there's
carpet
a lot to
in.
take away. If you saw the New York Fed came out with numbers, their inflation expectations for 1 and 5 years did not change, just about 3%. So that's a positive. That PCE data that we got on Friday, I wonder if that's going to work into any of their discussion. But yeah, get ready. There might be some fireworks this Wednesday.
Okay, buckle up is the word there from Tom. Kevin, what's your take when you think about this? One of the things I do find interesting in the run-up to the Fed's decision is watching the move in small caps, right? The Russell 2000 has been the outperformer all last week, still holding on to some gains today. What's your take when you think about the Fed?
I think we're going to get a lot of answers this week. That will, Friday at the close, we're going to talk about all the answers that we got this week. And I think the 10-year yield and the markets in general are a bit nervous because the last time Jerome Powell did a hawkish cut.
Well, we got to regain respect of the 683.26.
Now, I don't think Jerome Powell should do a hawkish cut because the labor market is not as solid as he'd like it to be. I think inflation is on a good path. It's on its way down. It's coming down slower than we'd like, but it's coming down. And
Somewhere in that area.
Inflation is the concern. I think it's the labor market that requires more cuts. Remember, Bank of America came out last week and talked about guiding to a January cut as well. Or does he say we're pausing in January, maybe March?
It stopped out of these suckers.
Here's the key players in the dissent. It's Stephen Myron, obviously. It's Michelle Bowman and Christopher Waller. They're on the dovish side. Then it's Jeffrey Schmidt.
I'm just not too excited right now.
He dissented last time on no cut, so you know he's going to dissent again on this one. Jeffrey Schmidt, Lori Logan, and Beth Hammock both
Mr. Hickey
pausing here because of inflation. So I think it's going to be, it might be a significant amount of dissenters. So I think it's going to be real interesting how Jerome Powell frames this. I think the SEP is very important. Yeah, I think that's why
638,
that's why
683859.
That's why yields are higher. That's why the markets are soft here. I think we need to get to Wednesday afternoon, get all these questions answered, then let's move on.
Let's move on to this one. Apple. It is getting some love on Wall Street today. It's not reflected in the share price. It's not just Wedbush's Dan Ives. You got Evercore ISI out with a more bullish price target. They're increasing theirs. Both of them in the 300 range. Evercore ISI is 325. Wedbush is more bullish than that. Not surprised, obviously, about Wedbush. Tom, what's your take on all of this?
Yeah, you got good data out of the iPhone 17 launch, both domestically and internationally, especially in China. So that's given the stock a boost lately. Now you're starting to see all these guys come out and say, hey, that AI monetization is going to be a real thing in 2026, even though, they've kind of dropped the ball as far as AI. But did they need to have the ball in the first place? Because if they integrate AI into Siri with Google's Gemini, that's probably going to be a win. And I think that's what the Evercore ISI analyst basically said. It was like, hey, this is going to be a big boon for them. And we've seen all the positive commentary around Gemini. So if they're able to integrate that into their new Siri assistant, that's going to be a positive. Dan Ives always bullish on Apple, thinks it's going, to the moon every time he opens his mouth. But he also noted that AI monetization is going to be the next step for Apple moving into next year. And I think that's what everybody's kind of betting on at this point, because the valuation on a historical basis pretty rich in this.
That's funny.
Yeah, it is. One of the things I do think that's interesting in the Dan Ives note, because it hit my inbox early this morning.
Dan Ives is a pumper.
You can tell there was still, or actually it was last night, he said it's Sunday night. I saw it early this morning. So he says 2026 is going to finally be the year that Apple actually enters the AI revolution. The word finally stands out to me because I do think, to be fair to Dan, is he's been a little frustrated with where Apple is on AI. Kevin, what's your take when you think about Apple and these bullish price targets?
I think an aspirational note that Dan Ives put out is kind of required. It's kind of expected for this time of the year, but Apple at about a 37 PE is not cheap. But guess what? Last time it was up at these levels, it was a 42 PE. And so it's earned its way to a lower PE. Why? Because of the E in PE ratio. So it was a lot higher in terms of PE than it was. So if you don't think Apple can go higher, it was a 42 PE about a year ago. And now it's a 37 PE. So it can certainly go higher. If they do get in the AI business that we've been waiting for, the iPhone 17 is doing extremely well. It's the Christmas season. I'm embarrassed of how much money I've already spent at the Apple Store. So it's probably going to be a good Christmas shopping season for them. And I get it. Remember, it's a 37 PE. It's not cheap, but it's been higher in terms of the PE, Diane.
Kevin, since you're feeling generous, I'll send my wish list over to you later today. I'm joking. All right, let's talk Marvell, Microsoft, Broadcom. It's like a three-way story here. Marvell, that stock is down. It's powering down after this report that Microsoft is in talks with Broadcom about custom chip design. So Microsoft a little bit higher right now. Broadcom is higher as well. But there's also this downgrade for Marvell that's hitting that stock as well. You got benchmark downgrading it to a hold from a buy. Tom, what's your read-through on all of this?
Yeah, I mean, that didn't last long, the honeymoon post-earnings for Marvell, because the stock's getting hammered about 9% on this news. Now, remember, Marvell's got a few big customers, and Microsoft's one of them, and that they're reliant on these big hyperscalers and cloud-based companies. If they lose this business to Broadcom, that's going to be a big hit. I don't know if that's confirmed. It seems like this benchmark analyst basically came out immediately to downgrade the stock. It's been a choppy ride for Marvell based on the fact that one segment of their business might be doing well, while maybe their custom chip building not doing as great. If they get this pulled from them, that's not a positive moving out forward after they gave pretty decent guidance on their last quarter. So yeah, I think it's still a lot of uncertainties on this one, but if you take a look at what inputs in this AI infrastructure build-out Marvell is a part of, maybe they can transition to other big clients that might need these custom chips that Broadcom and Marvell both make, and then they're in the hyperscaler industry also, in the data center build-out, so that's a positive for this company. But yeah, you've got to get more clarity on this, I think, before making a decision, because we're now below the levels pre-earnings when the stock spiked up.
Yeah, and listen, this has been a big underperformer compared to the S&P 500 this year, and a year-over-year basis is not much better for Marvell. Can we look across this landscape? What's your take?
Yeah, we're moving into the next chapter in AI, and that is winners and losers. And it's real simple. Remember, Broadcom, their niche in AI is custom chips. And if Microsoft trying to make custom chips with Marvell isn't doing well, and they were to move to Broadcom to help with their custom chips, Broadcom's specialty, yes, who would be left out in that deal? Microsoft would choose Broadcom and exit Marvell. So yes, I can see why. Now this deal's not announced yet, but the rumors are out there, and that's the deal. Broadcom would be the winner, Marvell would be the loser, and I think that's the next stage of AI that we're about to enter. Winners and losers, and it'll probably be harsh in some of the pricing here.
So Broadcom shares rallying at 2 3/4% right now, adding to its strength and outperformance year to date. On the flip side, you have Marvell. To your point, it is down right now and down year to date, double digits. All right, guys, let's put a pin in it. We've got bull versus bear coming up. You guys should get their example trades put together for Tesla. After Morgan Stanley came out and downgraded shares this morning. Fast market. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on Schwab Network. Shares of Tesla hitting a speed bump today after one analyst moves to the sidelines. Morgan Stanley is cutting its view on the stock from overweight to equal weight. At the same time, MS is boosting its target on shares to 425. The reasoning, the analyst does believe that Tesla will lead in autonomous driving, clean energy, and robotics. But from his view, the moonshot bets are already priced in. All right, let's throw on the trading glasses now. Welcome back in our co-host Tom White and Kevin Hinks. It is bull versus bear time. Before we get to your example trades, got to get your takes on Tesla. Kevin, I'll start with you. What's interesting to me about this, view one is Adam Jonas, who used to be the analyst on this, is switched out for a new analyst. And the new guy has a new valuation approach to this. What's your take when you think about Tesla?
Yeah, a downgrade but a price target raise is kind of interesting, as it looks like Morgan Stanley's playing catch up in terms of their pricing here, but
they're pumping it. They want to get in it.
With it is, if you think that robotics and full self-driving and robo-taxi.
Okay, we got 68.23 for SPX.
That's where I don't agree with the theory here. You can think, based on automotive and speculation, and there might be issues with all these, or they may be longer to take out, to roll out, than we thought. But if they hit on one of these two, like robo-taxi or robotics, if they hit on either one of them, I think this stock is way underpriced. That's just my personal opinion. I don't think as much as priced in as everyone thinks. That's where I get the justification, what Morgan Stanley's doing. I just don't agree that these are priced in. So it's interesting here. I think it's definitely tradable, and I think it's very interesting. Tesla broke down through its 50-day moving average and now is rallying right back up to it. So it's sitting right at its 50-day moving average. So I'll watch how it closes there from a technical perspective. But boy, I think the future for Tesla, if they get some of these things right,
I'm gonna say
it's going to be big.
I'm more accurate.
If you remember, the guy who was leading that research team, Adam Jonas, who's still with Morgan Stanley, but moved over.
I'm more accurate than Morgan Stanley, so I say 435
He's taking a different approach to how
for Tesla.
Valued.
So it'll be interesting to see how his approach diverges essentially with how Tesla trades. But Tom, what's your take when you look across Tesla?
Promises. That's my look. Because you look at this as Elon Musk does. He promises, hey, we're going to ramp up production on full self-driving next year. So everybody's hopeful for that. The humanoid robots, he says there's going to be millions of them in use by the end of 2026 and 2027. Okay, but there's been a lot of things that he's stated before. These I love them. They're pie-eyed. Big sky, big wide open, expectations.
The bald-headed guy on Schwab is a prick. He is a prick with a small dick. The bald-headed guy on Schwab is a prick. Don't be bad-mouthing Elon. He's got a little dick. Yeah, we make promises sometimes we can't keep. COVID got in his way. Little bald-headed man named Tim on Schwab. He's nothing but a prick with a small dick. Every time he speaks about my buddy Elon, it's never positive. It's never positive. Tim on Schwab is a prick. The man's got a small dick. He's nothing but a prick.
$20.50. So, Tom, this was just a buy the dip, a moderate, only a 13 or 14 delta spread, Tom. A calendar spread, aiming for the 460 mark, Tom.
Yeah,
I think you know, and that's the nice thing about calendars is, yeah, you're shooting for 460. It's a bullish
trade. You need to move to the upside, but you still got a nice wide range for this kind of trading.
The little bald man.
A lot of option premium in those near-term options that you're selling, and that potential ability to roll that short option.
Doesn't know when to shut up. He doesn't know when to shut up. Nothing but a prick with a small dick. He's calling calls. It's hard to believe. Promises kept. Promises denied.
What type of credit you receive on that one, but you do need a move to the upside, not that much.
Is that a good song or what?
As I mentioned, anything above maybe 440 can be potential profitability on this, and the idea here is positive time decay works in your favor as that short option that you sell starts to lose value at a quicker pace than the long option that you're long out in the December 26th weekly cycle. So call calendar to the upside. But Kev, I looked at something that a little bit more passive on a bearish take example here in Tesla. Just by looking at the chart, it seemed like the stock kind of bailed at the 460 level, settling above it probably for the last couple of months. So I picked that strike, giving myself better probabilities of success to sell now when you call for it here. I went to the December 19th monthly options, 11 days expiration. We're going to sell the 460 strike call, buy the 470 strike call, so we're short down the ride, neutral to bearish call. We got 220 credit on here. That's where it was trading earlier. It's trading closer to $2 right now, but the credit you collect is going to be what you can make on this trade. So if you collect 220 bucks with $780 in risk, but that's all the way above 470. So Kevin, a little bit more passive on this one, but at the same time, you might not make as much on something like this, but at the same time, you've got better probabilities of success on this neutral to bearish offer.
Expected move out to December 19th about $32. You're about 73.5% probability of finishing out of the money for that 460 call. So this is just one that says we don't think it'll get there in the next 11 days. We don't think it'll get back to 460. It could rally, but as long as it doesn't make it to 460, you're profitable on this trade now. And actually, if you sell it for what is it, $2? You get a little over $2. You're going to keep it below 462. So this is one of those obviously the risk favors the downside because you're selling for $2. That's the most you can make. The risk is the difference between $10 and the credit you take in, so just under $8. So this is one that just says it may rally, but it's not getting to 460 in the next 11 days.
Yeah, I like that, you look at this and you can be wrong because you're bearish on this example trade, but not really. It's more passive, a little bit more conservative with that big cushion up to that break even just above 462 to the outside on this neutral to bearish short call vertical. So there you got it. Diane, you need to move to the upside on Kevin's. Mine, profitable in 3 out of 4 scenarios as long as it doesn't continue to rally through that 462 level.
Okay, neutral bear debate. It just reminds me of how analysts looked at this stock because you have views all over the place and how it trades off and all over the place. Thanks, guys. Got hashtags coming up. We'll be joined by the team from Likefolio. Take a look at social trends on Carvana. It hit an all-time high today. It's rallying double digits after an announcement that's included in the S&P 500. Stay right here on Schwab Network. Fast Market. We'll be right back.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes you could have done better.
You could have shaved too, buddy.
Invest. Level up and invest smarter with Schwab.
I'm Sam Gladys, live from the New York Stock Exchange.
With
When
video.
the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Well, today's continuous sell-off has possibilities. There's another nice setup right here.
Giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade fluently.
And when we break this, the 21, it doesn't last
Whether
long.
you're an experienced investor or just getting started, Charles Schwab offers a webcast.
So you scalp it to the 50.
Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis,
Technical analysis.
and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning.
I have
at
to
its
say,
finest. Tune in live.
the way he says analysis is probably the sexiest I've ever heard. Technical analysis. Let's see if Marley Keaton is married. Ooh, looks like she might be. That was back in 2018, so it might not be. Seven years ago, on a day much like today, I married the what? Seven years ago today, See, I'm kind of thinking about jumping in that trade, but I didn't think I was going to do it after all. It pulled back. It kind of let out with 3 white soldiers and then tweezer topped and gave up. It's now 12:36 Eastern Time. What's the prison guy have to say?
And now it's about $400 and a lot of change there. I think to kind of further extrapolate Tom's question, because that's one of the things I thought was like when you look at the P ratio, it is expensive. Is it justified? Like, is there a shift that's happened in how consumers just buy cars, especially because you're the way you all track data, it does seem to like really play out well when you're thinking about this, because this is online.
Yeah, there's a massive shift happening. The great news for Carvana shareholders, and it was true at $4. It was true that more and more people are buying cars online. What was not clear is whether or not Carvana was going to survive some of the loans that
it'd be hard to do.
Some of the debt that it had on the balance sheet.
Would that be hard to do, buy a car online without looking at it? If it was used, it'd be hard to do.
Got to get an earnings score on this one because I look at that chart and I'm like, I'm not buying this, because it's so extended at this point. I mean, wait for pullbacks or something along those lines. I mean, would you tell people to buy it just because I understand your data is really good on this, but so is that chart.
Yeah, it is. And I would say if you're looking for a short-term play on Carvana, I would not bet against this company, period. There's no reason. There's a lot better companies out there to bet against. But short-term, I think that we've probably, kind of hit levels that may be a little bit unsustainable. S&P inclusion as a tailwind. A lot of things going right for Carvana. If your lens is short-term, then I'd say, let's just sit out and watch for a little while. If your lens is long-term, and by that I mean 6 months to 10 years, then I think any pullbacks in this stock until further notice are buying opportunities, as they have been for the last 18 months.
Oh, stop pumping it. Andy.
And now from the trading perspective, all things Carvana, I want to yield the floor to you, Tom, and bring Kevin back into the conversation. Tom, I know that you have used Carvana, you sold a vehicle on there. I, myself, shopped around them on there. And it's a great platform to use. I didn't ultimately go that route, but I'm not against it. What's your take before you guys get into that example trade?
Yeah, it's just, that whole car buying, scenario is just a nightmare to begin with. So maybe that's why, Carvana's done so well. You don't want to sit in a car dealership for 2 or 3 hours trying to figure this stuff out when it can be done in 15 minutes. And maybe that's why, it resonates with people. Buying something online that typically you'd go into a dealership, you want to walk around, you want to see it. Well, now you don't have to. Maybe that's the reason. But Kevin, I'll bring you back in here because As I mentioned with Andy, I mean, this stock trading, just under 450 bucks a share. RSI is 77 at this point, Kevin. So it's extended, but hey, it's been good news for this company, left and right.
Yeah, I think the RSI is problematic in this bullish scenario. Why is it problematic? Look in the last year. When it gets over a certain level of an RSI, it does correct. But it's got news on the horizon. It's going into the S&P 500 December 22nd. So I don't see that happening before that. But is there risk to this stock correcting? Of course there is. So
there's my car right there.
I think what you do is you keep your duration.
They want 18.5 for it.
And trade this from, if it does correct, you can be bullish with
only 38,000 miles? God.
That's the other eye-opening event. Now, you can't keep up today with trying to choose a strike for a short put vertical. That was the trade, but I was keeping it to this week, Tom. But the stock is moving up so quickly. I started out with the 410, 405, 400 put vertical, had to move it to
That's my car right there, exactly.
Vertical, and now it's blown away from that. So anyway, find the high probability trade I looked at the time that, of this trade, the December 12th, 415,
Sunroof, got everything on it.
It was trading about $2.10 credit. Now it's trading about $1.30 credit because the stock keeps moving higher. And this is my second attempt at finding strike prices to sell a put vertical. So at least the short put vertical priced this week gives you some downside without violating, the short strike. Now, there is risk if it were to correct. And if you look on the chart, it does correct in line with that RSI. But Tom, I think with the December 22nd going into the S&P, it may not happen anytime soon.
Let's break this one down. Because, the price has changed, but so has your probabilities have actually improved quite a bit because the stock has moved higher. So you got to take that into account.
You got to bounce.
When we look at these example trades, let's break this one down that Kevin brought us. December 12th, weekly option, 4 days to expiration, end of the week, right? Really short-term positioning. Sell the 415 put, buy the 4.
Now we're going to see if this breaks a 63. I'll jump in it.
Put vertical, we got.
But that's it right there, the 80 to buck. 63, 63, 63, 63. So the question is, are we going to hold this time? How many times? This is the fourth time. I know if I jump in them, it's going to dip. I could take another chance. $800 bet. $68.70s. If I can get it at 80. So far, my luck's not been that good today. No. There it is, 75. $68.70s at 75 cents. See, it didn't hold. I can buy them for 80. Be in the trade. There's 75. Well, here we go. We're at 90. Break it. We're at resistance here, so if you got in at 75, if you were lucky enough, you had about a minute. It's number 5. It's getting, I think I've talked about this before. One of them 2 bits, 3 bits, 4 bits, 5 B. 6. 60. That one did break, and that one broke. So, 60. One of them 2 bits, freebie, 4 bits, 5 B. It's 60. George, take this to $1.50.
Compared to last year. Now, if you look at the guidance the company provided when they posted earnings last, they were expecting about 3,350 units.
They're now at 95 cents. You could make a business decision here and sell them and be out. But I'm not going to do it. I'm going long on these for the rest of the day. So the market's skittish over dumbass Powell. The only thing I can come up with. Fed week. There's your dollar. You might get out of $1 here. There it is. You will get out of $1 now. Okay, I see a 2-headed snake. Will you show us the two-headed snake, Jimmy? I sure will. Narcissistic Jim belches to the 200. Come on, George. Don't let it dip. This is a major breakout. Dippity-doo-dah, zippity-day. I'm up $250. No, I was going to take an aspirin or two. Randy, my legs are hurting me. My calves, my upper leg. Feels like the day that I played catcher. The day after. That's the hardest. What's one of the hardest positions to play on a baseball field is being a catcher. It's not the boringest, but it's one of the most difficult. Accuracy is now I say shortstop. There's 115. Now we're talking. Jimmy should sell here. Yeah, we're getting old. Livid Goose agrees with me. Catcher's the hardest position to play. Might go for an Asian massage tonight. Baby, will you work on my legs? Oh! Woo! Let's go! 180. I'm up $1,000. I'm up $1,000. I'm up $1,100. $1,150. Randy. Randy. I'm not at no green no more. I made my money back. What'd you think about that, livid goose? Are you at all? See, who's the best trader you know out there besides yourself? Livid goose nailed it. Hogwash. No, it wasn't. That's pure hogwash. Hogwash. Let's go, baby. I don't know how he does it, but he did it. Now we got to maintain this support level here. Right now, this is it. Got to hold. Washboardjim. Let's go. We're at the 9. So if you're not in the trade, we had NVIDIA news, YouTube. Uh-oh.
Right now, and almost scrutiny we're seeing from the street on that potential deal. And we'll close things out with CFLT as we are seeing some talks with IBM. And this name is actually seeing some interesting movement today. We're up now 49% in Confluent, and name I don't believe we've ever discussed on the show before.
She looks like the girl that works at church today. Thank you for the compliment, Jimmy. I've been admiring you on YouTube, but this morning you were having difficulty, and I heard that you're going to go get an Asian massage tonight. Yes, I am. Okay, prepare ye to get back in the trade. Prepare ye. Rodney. Back in at 120. Okay. I was down. Hello, is James Howard there? Yes, I'm from the ABC News Report room at Wahoo Finance, and we noticed that you were down over $1,200 today on your first couple of trades, and we want to know what kept you in. And you weren't feeling too good about it. And you applied patience, waiting for the right setup, and with a little bit of help from the room, mentioning no names, Livid Goose, and Randy, Magnificent, and Sheba, and Link, Jesse, Bobby, and Ricky, and Call Me Everything, Angel. Yes, that pop was nice. Not as the pop I'm going to get tonight when I go to my Asian massage. But it was nice. And R, Rusty, Ruffles, I mean. I'm too old for happy endings. Come on, baby. You're at 130. We need to break the 200. EMA and SMA. And then approach the double top. Pay attention to these candles. Does anybody know what that is? Anybody tell me what kind of candle that is? Without looking it up. One minute. It's a doji, but that ain't the right answer. You'll have to look it up now, won't you? Can anybody tell me what kind of candle that is? The dragonfly. Did you look it up? Be honest now, Sheba. You would not lie? May I give you a lie detector's test? I think there's 4 of them. I think there's 4 dojis. Second. Remove. That's called a dragonfly doji. And these are inverted hammers. Now, when the red one comes up, you're going to get a small pullback. Uh-oh, here we go. Anybody take the trade with Bobo at 120? I'm always right. We're now at $1.45. We're wanting to break the resistance level here. Resistance would be the doji body. Ginny. We're at 125. 135.
In the sky, where the wild ones soar, a living goose is ready to explore. With a honk that echoes through the day, he spreads his wings, showing the way. When the stars start falling, fears rise high, but this goose won't let the spirit die. He sees the patterns that no one can see, a reverse stock tale making history. The living goose calls it out like a beacon in the night. He's the hero of the underdog fight. With a heart full of courage, he stands up tall. No fear in his eyes, he won't let us fall. Through storms and shadows, he leads us on. In the depths of despair, he sings a new song.
Woo! One more time, baby.
In the sky, where the wild ones soar, a living goose is ready to explore. With a honk that echoes through the day, he spreads his wings, showing the way. When the stars start falling, fears rise high, but this goose won't let the spirit die. He sees the patterns that no one can see, a reverse stock tale making history. The living goose calls it out like a beacon in the night. He's the hero of the underdog fight. With a heart full of courage, he stands up tall. No fear in his eyes, he won't let us fall. Through storms and shadows, he leads us on. In the depths of despair, he sings a new song. In the sky, where the wild ones soar, a living goose is ready to explore. With a honk that echoes through the day, he spreads his wings, showing the way. When the stars start falling, fears rise high, but this goose won't let the spirit die. He sees the patterns that no one can see, a reverse stock tale making history. Living goose calls it out like a beacon in the night. He's the hero of the underdog fight. With a heart full of courage, he stands up tall. No fear in his eyes, he won't let us fall.
Woo!
19th would be that strike. So layer that expiration selected. So that's what we did. And then Rick talked about that 1 month EMA being basically right where we are. Say you think that's going to hold through earnings.
1 month EMA.
Basically looked at the pretty much at the money short put vertical here in that December monthly expiration. It's the 135, 130 for this example.
God, come on.
75 credit would be about a third the width of the strike. So you risk $325 chance to make 175 guys with 133 and a quarter break even. Elongated Z risk profile. Stay above 135. Hold on to that 1 month moving average and sort of that volume zone as potential support. And then this would have a chance to be profitable, not at the end of this week, but at the end of next week, guys. As it's a shortest dated trade we could do, but it's still a week and a half away.
Yeah, so you're not like a true earnings pure play, but like you said, some duration on the back of this example trade, so you have a bit of time to work with as we do approach really the end of this year. We're rapidly coming up on January 1st, which is very frightening. But now as we look to KBH, we did see some analyst news today that was a mixed picture on Barclays, so not exactly hugely optimistic sentiment. We're down about 1.5% though here in KBH, which again, looking a bit weaker on a year-to-date performance basis than say Toll Brothers.
Yes, and the recent price activity, much more range-bound here. What we have now is our 58 level, our green line. We had a low point here. That's about where we bottomed out 2 more times. At the same time, we have an accompanying ceiling, 66. That was our high point recently, but that also matches up with another high here, a breakout point here, and if you were to look back, several more highs and lows and a consolidation point. So 66 really stands out to the upside. That was the site of our most recent rejection. That also gives us this shorter-term trend line we can consider here going forward. So this downward slope would be the relevant point to potentially break out of to the upside in the shorter term. When we do look at our exponential moving averages here, well, everything is clustered basically right on top of each other between about 62 to 62 and a half. Clustered moving averages, sideways trend, shows that there is not a strong directional lean. Either the price is so range-bound that it's not really generating any directionality, or the activity is so choppy that it can't really find a direction either way because the values are so extreme in opposite directions. In this case, though, very much just the latter, the former rather, whichever one's first, the one that's going sideways here. So right around 62 is another point of interest here. If we were to break below it, that would open the door to testing 58 once more. So a similar situation here, RSI right about on that 50 midline. So look for directional clues based on any kind of price breakout and whichever way the RSI moves along with it. When we look at our volume profile study, our point of control is about where we were trading earlier today. That comes in around 64. So a notable upside area to clear. Volume starts to really thin out above that 66 level, as well as below the 62 level or so. So those would be the important zones to cross above or below as we continue forward with this stuff.
Yeah, and KBH here today, getting down to 1.5. We don't have earnings, I believe, imminently, but they're coming in about a week or so, so we have that to look forward to here for near-term catalysts. But we'll leave it there. Appreciate it to Rick, of course, our chart master. And now as we think through now trading KBH for example purposes, I think a good compare and contrast with Toll Brothers, but obviously different size companies, different earnings events, different catalysts to consider as well.
Yeah, similar but different, right? But this chart looked a little bit worse in terms of performance, as you mentioned, and Rick highlighted when we go into the technicals. So this example a little bit more bearish, but again, no weekly options available. So a month-over-month calendar spread in which, for this example, we sold a December option, bought a January option. Looking at the put side to make
well, it didn't hold up well.
The put calendar spread, 55 put is the one that we selected. 50-cent debit means you have $50 at stake here. You see that over my shoulder, the $50 max loss. The Mount Top risk profile, Jenny, the more closely you can project the price at that short expiration.
I got in second time.
Will perform. And so in this case, 55 is the best case scenario. But customizable can be adjusted, whether that's in KBH or another stock, or when you're looking at these type of trade.
Ah, darn it. Just straight across head and shoulders. Should reverse here if it's going to. Come on. You probably won't get back to 120. We're at the right shoulder the second time. Jeez. At a loss. Yeah, I got 70. I'm still in the calls. There's SPXs. We had a double bottom. We might come back and retouch this shoulder line, then break out. Monday. We're retesting the right shoulder now. Left shoulder, right shoulder, right shoulder, left shoulder, right shoulder, two-headed snake. I'm gonna go warm my coffee up. So far, it's obeying.
So I kind of got tired of being at Starbucks with the nice.
Nope. got another wall to break. Well, this ain't gonna work out. What happened to the TV? There it is.
Cloud-native software as a service. It's open source. It's fully operational back-end systems. But I think their movement is to open it up for applications across open source platforms like Red Hat, which is owned by IBM. So basically, data. I mean, IBM really wants a real-time data, plumbing, if you will, that enhances their AI as well as their hybrid cloud strategy. But basically, this is also enabling the aspects of the hybrid aspects of Confluence, so fully managed as well as self-managed aspects of the cloud. So it's really open source integration that IBM's looking for. And I think if you look at artificial intelligence, having used it, it really doesn't have sort of a real-time data feed kind of process element to it. So I do think there's going to be sort of a next level technology associated with adding on real-time data feeds into artificial intelligence front-end interfaces. And that could be essentially what IBM is looking to eventually add with this acquisition. I did look at some of the competition in this space, and there's some of the big players we've talked about, Snowflake, Datadog, Elastic, MongoDB, which reported earnings and has gapped higher the last couple of quarters. So for what it's worth, I think this industry space may be compelling because when one company gets acquired, many of the others in the industry space get looked at, but some of the others that I mentioned are much larger businesses than Confluent, which based on acquisition is $11 billion, about a 34% premium to the closing price on Friday.
Highlighted this, but I want to say, or ask you a little bit more directly. When IBM goes out and makes this purchase, are they buying the relationships, the customers that are using this platform, or is the infrastructure the value here? Because the street's rewarding them, but $9.3 billion, I would think they could create this for less than that.
That's a good question. I think it makes sense for IBM because if you look at Confluent itself as a business, revenues are around $1.1 billion, average recurring revenue started to improve over 100%. So that gives you an idea that more customers are spending on their platform versus customers that are leaving the platform. The customer base is large.
Here we go again.
Enterprise customers across multiple sizes, Fortune 500, 40% use some sort of Confluent technology. But I did notice, and this is really where it becomes a little bit unusual, is Confluent's margins aren't very good. And that's indicative of what we've seen in the price action in the stock. I mean, if you look at it over last year, it hasn't performed all that well. It's sort of a back burner kind of company from a profit standpoint. But I think the average recurring revenue numbers, which demonstrate some improvement, plus the customer count acquisitions, enhancing technology integrations across the open source platform that IBM has. So in this case, it made sense for IBM. They're bolting on a company with technologies that they want, and then Confluent gets essentially what they need as a business, which is a larger scalable partner. So it seems to make sense right now for both companies net in the long run.
I will say that a huge move today obviously implies some optimism, at least from the street's perspective, as far as just price is concerned. But we appreciate that great help into a pretty major deal from IBM with Confluent. George Tillis, senior markets correspondent for the network. And we'll also do it for Alex and myself for Next Gen Investing for this Monday. We have the watch list coming up next.
Man, this is probably worse. I mean, I just up, down.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden
Tessa's about to hit my support.
platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network.
where real-time market coverage meets expert strategy. From the opening bell to the closing bell, we've got you covered. Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time, with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data,
veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December 11th for 2026 Market Outlook, your guide to the forces shaping stocks, global markets, inflation, rates, and more. Hear from experts on where markets may be headed, spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m. Eastern on Schwab Network.
I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at SchwabNetwork.com. Welcome to Watchlist. I'm Nicole Pedalides. It's 2 p.m. Eastern Time. We're coming to you live from the New York Stock Exchange. So glad you are with us. We have some down arrows here today. Tech is trying to give it a go. We've heard some good things about Apple, for example, and also the Warner Brothers deal still in the works. We wait a lot on that. In the meantime, we'll gauge expectations for the markets in 2026, which sectors and which asset classes could really be in the best position for outperformance. We'll look at Charles Schwab's proprietary stats report. Comes from the month of November. We'll gain the insights into trader activity, sentiment from the month, and we'll have our panel to discuss the outlook for holiday travel and the airlines. Some are better positioned than others to travel rush. We'll go through that. In the meantime, after 2 weeks of gains and sort of a mixed start back and forth over the unchanged line, now it's becoming more evident.
It's a huge mixed start.
Because I said earlier, 10 of the 11 sectors were lower. It was only tech that was holding on. Now it's still 10 of 11 lower, but they've gained some traction. Energy, materials, industrials, the worst of the bunch. The S&P is at 6830, down 39 points. The Nasdaq's down 0.5%. And the Dow's at 47,642, down 312 points. The Russell lower by 0.2%. Oil and gold are lower, and oil's down $27, and gold is at 58. I'm sorry. Let's start over. Oil is at 58.79 a barrel, down about 29. Gold is at 42.15 per ounce, down $27. So down there, 90,165 for Bitcoin. And Kevin Hanks is with me, host of Fast Market here on Schwab Network. And obviously we've had a lot of big stories, but the big one here is this hostile bid from Paramount for Warner Brothers, and that leaves everybody at Netflix maybe scratching their heads. We have to see what happens here. What are your thoughts?
Yeah, it's not. It's not closed up just yet, Nicole. Paramount
Back to red again.
Allison put out a $30 bid for Warner Brothers. As you know, he did a lot of his commenting on the floor of the New York Stock Exchange this morning, and so he's got the numbers lined up. He said that basically he gave the best offer and it wasn't really responded to. So some of the story on this, he's got backing from Saudi Arabia, Qatar, United Arab Emirates, as well as Affinity Partners, who is one of the founding partners is Jared Kushner. So President Trump's son-in-law. So I think what this means and why you're seeing the move in Netflix stock and the other stocks is this is not over. At worst case scenario,
it's not over.
Or best case scenario, the price is going to go up more as Paramount has upped the ante going forward. So I think this.
And I'd like to buy open here too to go long.
It's going to take a while. We were thinking 12 to 18 months. It might be 18 months to 2 years now, Nicole. This is going to get ugly as a hostile bid by Paramount.
Yeah, I mean, it's pretty amazing. All cash offer, upping it to an enterprise value of $108.4 billion, and still going. Let's see what
Get back down to $5.
come through this one. How about NVIDIA and the chips to China? Where do we stand there?
Some good news there. NVIDIA up about 1% even in a down market because the U.S. Department of Commerce will soon allow the export of powerful NVIDIA GPUs that are roughly 18 months behind the most advanced offerings, according to a person with knowledge. The move, which would send NVIDIA H200 chips to China, seeks to find a middle ground between those who oppose exports of any advanced AI chips and those who worry that restrictions will merely hand the market to the Chinese competitors. So, pretty good news. Jensen Huang, as you know, has been lobbying for this for a while. They're still not selling the best chips, but about 18 months behind the most aggressive chips. NVIDIA now going to be able to sell chips to China. So we'll see how this plays out over time, Nicole, but pretty positive day for NVIDIA based on that news. Remember, Jensen Huang said in their earnings call, any sales to China would be a bonus over their earnings.
All right, thank you so much. Great to see you, Kevin Hanks. Good breakdown there. All right, let's take a look at the bigger picture now. Don Nesbitt's with us, Senior Portfolio Manager at FN Investments. What are your thoughts on the recent market activity? I mean, up until this morning, we were saying how close the major averages were to their all-time highs. I mean, we had 2 weeks of gains recently. Your thoughts?
Hi, Nicole. Thanks for having me. And you're right. I mean, we're still trading at near the all-time highs. There's a chance we still get a solid Santa Claus rally here going into the end of the year. We've got the Fed poised to cut rates here this week, and earnings still look pretty good. So, you know, and it's really the earnings too that we want to be looking at. We had a great third quarter earnings season. I think at the beginning of the season we were looking for year-over-year growth of about 7%. Came in at about 13%. So it was very well. Now the interesting thing is that in those third quarter earnings, you had about 82% of the companies beating, and that again is very good. When you look at it against about the 14-year average of about 72%. So yeah, 81 versus 72%, very good. But you did not see the price action, the positive price action that we normally see with that kind of a beat. As a matter of fact, you saw a more subdued price action to those beats. So we'll be watching in about a month. We come into the fourth quarter earnings and we'll see how that goes.
Understood. I mean, how concerned are you about market volatility? We saw a spike, but it's taken a breather.
Yeah, and again, in November we saw some worries, over the government shutdown, worries that the Fed might not cut rates because the inflation was high. A lot of that is subdued. It looks like we'll probably get the cut. The big question is what type of wording will the Fed use to back up that cut. So it's more about what they watching about what they say as versus what they do. But again, volatility is not our enemy here. We had a short-lived spike, came back down. I think the other thing that you're seeing here that we're noticing here in the late stages here of the year in the market is that we are starting to get more of a rotation in the lead as you were talking about. I mean, AI, the big tech, that's been leading markets over the last several years, and we need to see kind of a handoff there to the other 490 companies in the S&P 500.
Let's go through some of your themes and why you're picking them. I mean, we start off with AbbVie, not too far off of its recent highs that it marked in October. Some of your thoughts on AbbVie?
Sure, when you look at the market and you look at it on a sector basis, healthcare is very attractive. So it's traded about 18 times 26 earnings. Compare that to the S&P at about 22.5, and then the tech sector's at about 28 times earnings. So relatively attractive valuation. The important thing to look at is growth, and what's that growth going to be? And again, for next year, 2026, they're looking for about 20% growth in the healthcare sector of the S&P 500 versus I think about 28% growth in the IT. When you look at that in terms of the PE versus growth or PEG ratio, the healthcare sector is about 1.1, and the tech is about 1.6, and the market S&P 500 is about 1.5. Now, to get into a couple of specific names, as you mentioned, AbbVie, a large pharmaceutical maker, has a very strong product line, had very good third quarter earnings, and gave good guidance. So those are the kind of companies we like. Dividend yield about 3%, so you get a really good growth name with a reasonable dividend yield there.
Yeah, understood. You also have Medtronic and Microsoft. Let's go with Medtronic first.
Sure, Medtronic, more of the medical equipment maker, pacemakers and so forth. Again, a well-established moat in that area, good earnings visibility, another good third quarter earnings report, and we look for that to continue. And again, you're getting a yield, I think, about 2.8%, which helps you get paid while you wait.
And then there's Microsoft.
Sure. Microsoft is interesting because, as I mentioned earlier, the earnings and the street really set the bar high. And Microsoft came out in the third quarter and has a stellar report. They beat on earnings, they beat on revenue, they beat on their guidance, and yet that report was not rosy enough for the street, and the stock actually took a sell-off there. But long term, again, you have a company that's at the forefront of AI. They're using their Copilot with their Office suite, and they are positioned.
This is just incredible.
To continue from the AI, and this recent sell-off might be a chance to get into the name.
Understood. I mean, where do you think we're headed between now and the end of the year? Are you waiting for a Santa Claus rally?
No,
Given the rally we've had so far this year, I don't expect it to be
not on the 5 minute. It's more.
Even if we kind of move forward and maybe hit some new highs by the end of the year, that would still be good. And again, it goes back to what are their earnings going to be. For 2025, the earnings on the S&P 500 are expected to be around 13%. Next year, 26 is 16%. So as long as the market keeps making those earnings, we're going to be okay.
We're at the 200 on the 5 minute, on the 1 hour.
Put support under a rally as it brings down the discount
/
rate,
ES.
expands the multiplier. I don't think you're going to.
This is the biggest sell-off day we've had.
We are already at 22.5 times earnings. And when you look back, when we had zero interest rates from 08 through early 15, the market traded at about a 14 PE. So I don't think lower rates
Since
are going to help expand that market multiple. It's all going to be
this day right here.
The one area that could benefit from the market rate cuts would be
Hello?
the smaller companies, so your small mid-cap stocks that
God damn, man.
They're financing.
Don Nesbitt, thank you so much.
Yeah, who in the fuck is this?
FM Investments. Good to see you, Don. Thanks. Coming up, Options Corner. Tom White is
Get me off your call list, you bitch.
Unusual options activity from the day and how investors are looking to trade on recent news of Tesla, Micron, and Citigroup. We'll get through that in a moment. Want to show you these actual trades. We'll be right back.
Biggest sell-off since 11/20. We're out of support. 3 different confirmations on /ES. It's a fallen wedge on the 5-minute.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Well, I'm way too far out of the money on these calls now.
It's time for Options Corner, where we analyze unusual options trades that we're seeing throughout the day. And Tom White, host of Fast Market, is here with me on Schwab Network. And I know you have a few names and specific trades you're going to share with us. But what are your thoughts, big picture, on the market? I mean, I thought it was interesting when Ray Dalio was saying you don't sell during a bubble. If you think there's an AI bubble and it's still sort of growing, you sort of stay, I'm paraphrasing, but you stay on board until it starts to get pricked. You know what I mean? You stay for the ride. You don't get out too soon. So he was on board for more upside. Some of your thoughts on the market?
Yeah, I think you have to take that into context. You know, if we're going to keep on seeing valuations expand, right? We're in a rate cut cycle, right? Expectations for a rate cut on Wednesday above 85% from the Fed. Now, is it going to be a hawkish cut? So you have to take that into context. I think we're seeing a little bit of weakness here today, Nicole, based on the fact that we've seen yields trending higher, those longer dated yields. The benchmark 10-year yield got hit nearly 4.2% today. Highest level in 2.5 months. So that's causing a little bit of volatility in the equity market. And I've been kind of stating this over the last several months is until we get volatility in the bond market, in the yield market, that's when you're going to see it kind of flow over into equities. And we're finally starting to see that now after a couple solid weeks of gains. But yeah, it's all going to be about the Fed. It's going to be about the tone of the Fed. The dissension among the Fed members as that continues to bifurcate. And there's a lot to watch this week, just from that and some of the data, most of it delayed.
Yeah, I mean, every time I've been looking up, I see the 10-year bond yield up 1 bip, 2 bips, 3 bips, you know, like little by little, but it's been a pretty big run because we weren't at 398 that long ago. Do you know what I mean? So it shows that we're at 417 now. Let's talk about Tesla. I saw multiple downgrades today on other names like Rivian and Lucid and Carvana. But what's going on with Tesla in particular, a neutral to bullish trade you found?
Yeah, it's a downgrade out of Morgan Stanley. They changed, as far as who covers it within their company. Adam Jonas used to cover it. Now they got a new guy in there, Andrew Percorco, that's doing it. And they basically raised the price target to 425 from 410, but they cut it to an equal weight from an overweight. And they said that a lot of what's already built into the share price is that, you know, autonomous vehicles, it's the robots. So, you know, Tesla's not priced on the back of EV sales, right?
There's a lot of history of these things selling off for the last
that we're going to have full self-driving, that they're going to start ramping up production of their
7 or 8 days.
As early as April. We're going to see 1 million humanoid robots working in factories over the next, 12 to 16 months. That's what the valuation of Tesla is. He's already saying that it's already built into the share price at this point. And this comes on the back of they launched a lower price version of its Model 3 car in Europe. They've seen some slumping sales.
You could probably run back to 6851.
But taking a little bit of a hit today.
/ES.
It's still down, 4% today, but still up about 8%.
I'm moving my money out of U.S. stocks,
record highs
just like Warren Buffett.
December. But 460 looks like an area where it hasn't settled above
Who's
over the
this?
last several months. And I think that's what this trader was doing as far as unusual option activity. This is out in the January 2nd weekly cycle, so 25 days to expiration. Traders sold over 10,000.
You have made a lot
weekly,
more this year investing in non-U.S. stock market. Oh, that's not true.
Just under $17 for each one of these calls. So the break even for this trader where they start to lose money is above 476.90 to the upside over the next 3.5 weeks. That's about 9% above the current share price in there. So it could be somebody, Nicole, speculating that, hey,
that is if you didn't.
Up much above 460,
who said this?
Or it could be somebody that's long a bunch of stock and just wants to sell some upside calls against their long stock position.
Paul Brandis.
Yield, and pretty hefty yield because those calls have a lot of option premium in them. But yeah, neutral to bearish. This trader is selling some upside calls in Tesla.
I understand. I mean, and as you say this, I think about some of the other Mag 7 names that have the up arrows and are doing a little better here. I mean, we talked about Apple with the Wedbush call for 350. You have NVIDIA now probably getting the okay to send the H200 chips to China. There's lots of different pieces of news on all these Mag 7 names.
Yeah,
Stay nimble, folks. Tesla down 4% there. And then what about Micron? You found a bullish trade.
Yeah, this has been one of the big winners so far this year in the market. In tech, up nearly 190%, just about 6% off of those all-time highs that we saw last
Looks like a
month.
liberal.
But,
see.
Doing okay today. They report earnings on the 17th of December, so that's going to be the next major catalyst for not only the stock but for the memory chip space at this point. They announced that they recently will exit their consumer memory business. That includes sale and products under its Crucial brand. They're going to focus more on those high bandwidth memory chips. They're competing with Samsung and SK Hynix out of Korea for these, and their margins are a lot higher, but this is the growth area of their business. The building out these AI data centers, the amount of memory needed, high bandwidth memory, is what Micron specializes in. They've got over a third of market share in there. B of A did come out, raise their price target on Micron today to 250 from 180. Keeps a neutral rating on the shares, though. They raised their estimates on DRAM and NAND pricing also. So getting into the high bandwidth memory chip space, but even their legacy parts of their business, Nicole, have really been supportive of the stock because the DRAM and NAND pricing has been pretty robust.
Never heard of the guy
because
before.
Demand has expanded. But we did see
He
some
worked in
bullish
Moscow
activity,
for 5 years, if that
here
tells you
also. This
anything.
is in the December 19th monthly options that expire in 11 days. A trader bought over 3,000 of the 250 strike calls, paid an average debit of nearly $12.30 on these. So the break even where this trader starts to profit is above 262.28 over the next week and a half. That's about 8% above the current share price. I think this trader's setting up for some good news post-earnings because it's December 19th. You're going to capture that earnings event on the 17th. But, yeah, buying some calls, maybe an earnings play here.
Okay, good to hear. I mean, when we think about that, last but not least, let's take a look at Citigroup. Are you seeing something bearish? What's the telltale here?
Yeah, I mean, the banks have been rocking financials leading markets over the last couple of months. Citigroup hit 17-year highs earlier in today's session. We haven't seen these levels since the financial crisis, 2008, for this stock, up over 50% so far in 2025. So it's had a good run.
Looks like it hit right to the penny on my trend line.
Yield curve, right? Business has been pretty robust.
The SP/ES,
whether it's investment banking,
right
whether
to
it's
the penny.
Banking. CEO James Frazier has done a good job at divesting some of their lower profitable areas, like getting rid of Mexico.
Again, this thing's moved too far out of the money. I'm 7 notches out now.
Globally, as far
so we
as
got to do something fast. It's 1:30, 1:22.
What's working.
We got an hour and 38 minutes.
Side, compete more on IPOs, and offerings and such against Goldman Sachs, against JP Morgan's in that area. But we did see some bearish activity in here. Maybe somebody betting against this stock, maybe somebody speculating to the downside, maybe somebody with a long stock position wants to hedge maybe some downside after this spectacular run this stock's been on. But this was out in the December 26th weekly cycle. So just 18 days to expiration. Trader bought over 13,000 of the 105 strike puts. Paid an average debit of about $1 for these puts, so the break even of $104 to the downside. That's about 4% below the current share price. You got 2.5 weeks in this position. Puts are out trading calls today in there, which is surprising. Stock was positive by about 1% earlier, but now negative. But this trader either hedging a long stock position, Nicole, or speculating that, hey, this has run up too far too fast, and hey, maybe in over the next couple of weeks we're going to get some downside here in Citigroup.
We have to see. Tom White, thank you so much. Everyday Options Corner with Tom White right here on the watch list, where he looks at 3 companies and some options trades, real trades based on real news that he's looking at. Thank you for sharing those with us, Tom. And coming up, we'll gauge expectations for this year, next year. Which sectors really, which asset classes could be really poised to outperform? Let's get the details. We'll be right back.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching.
Identifying who's buying, who's selling, how it's going to impact the markets. Watch live on the Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to the watch list. I'm Nicole Ladies. So glad you're with us. We're live on board the New York Stock Exchange. I have a food movers for you right now. We're looking at Apple is on the receiving end of a price target hike over at Wedbush, where Dan Ives raised the firm's price on this iPhone maker to
But he's a pumper.
$320, maintaining his outperform rating. And Dan Ives believes 2026 year Apple will enter the AI revolution and knows that iPhone sales for the 17 have been trending well into year-end. Price target hike comes as several Apple executives have announced their departures in recent weeks. Then there's Marvell. The shares are under some pressure today following a downgrade and a report from the information regarding one of its major customers. Benchmark downgraded shares of chip designer to hold from buy while removing its price target. The firm says it has a high degree of conviction that it has lost 2 of Amazon's chip designs to Taiwanese competitor Alchip. Now, the information also reported that Microsoft is looking to design custom chips with Broadcom switching away from Marvell. Let's get some big picture thoughts months, I mean, will we get a Santa Claus rally? And what happens in 2026? Our next guest, Juan Moreno, is with us, managing partner of investment bank Nassau Street Partners. Thank you for being with us. So, look, you know, we have 2 week highs. We started off trying to search for direction. Tech trying to give it a go, but everything's down today. What do you make of the market action?
Look, I think a lot of it is driven ultimately by a few names, specifically in AI. And the market is very one-dimensional right now, at least on the public side. And what we're seeing in Nassau, we sit more on the private side, is we're seeing a lot of interest from investors in diversifying that risk. Maybe they've made their wins with some of the bigger public AI names, and they want to de-risk it a little bit, while still having that upside of being in the private markets and being in the AI space.
Do you think it's still, AI is still, continues to drive everything?
I think it does, but I think we're going to start looking at AI-adjacent industries. We're going to start looking at, okay, how does AI then lead to efficiency improvements, then lead to higher revenue, higher profitability in adjacent sectors, whether it's chips, or whether it's your mom and pop, or companies that leverage AI in order to really boost their bottom line. That's, I think, where 2026, the focus is going to end up being.
So you said likely there's no bubble in AI at this time. Is it starting? Is it near? You know, is it the mega bubble? When is the real bubble burst type of thing?
Well, I think that in the public markets, things look a little bit more overheated than in the private markets. In the private markets, we're still seeing a lot of the investor interest is focusing on valuations that are grounded on revenue, at least a path towards profitability. When I look at the public markets, and I think a lot of investors that we speak to have this same line of thinking, they're looking at a lot of the CapEx spending that Oracle and Microsoft and Meta are doing, and they're questioning what kind of ROI is going to come from that.
Yeah, but at the same time, that they're saying, well, we have CapEx spending, so it's good. Right? And one is like, does it have value and merit, and what kind of ROI is coming back, right? They're looking for the return on investment. At the same time, they're like, listen, you can't grow AI without the capital expenditures.
Yeah. Well, that's why the thesis that we're seeing play out is that the new opportunity in AI is not so much going to be the AI companies, the OpenAIs, the Anthropics. It's going to be the companies that are already established that can leverage AI to continue to grow and improve their operation and make efficiencies. Those are going to be the real winners, ultimately. Whether it's in aerospace, whether it's in healthcare, whether it's in ed tech, what we're seeing is that companies that can do that, not just from a workforce reduction standpoint, making their workforce more profitable, more productive. Those are the companies that are really winning here.
I thought it was interesting how you said about healthcare and biotech, for example, right? Where does that fit in?
Yeah, I think that there's a lot to be seen in healthcare and biotech as to how they can leverage AI. They can definitely leverage it more than other sectors. In my opinion, from what we're seeing in the biotech space, the kinds of companies that are leveraging AI either in their process to reduce their costs in the drug discovery phase, or earlier on in their trajectory, in their journey, are generating a lot more investor attention. And what we tell our clients at Nassau is, any way you can integrate AI into the way you do business, and we can position that to investors, you're going to see a lot more interest.
So the best sectors for 2026, I know you also have renewable energy and non-renewable energy. You talked about tech AI, the tripling out of tech AI. Tell me, what are the best sectors of play so someone can say, this is the soundbite, this is what Juan told me, 2026 best bets?
I think anything that's being prioritized by the new administration is going to be a really good one. So energy, anything around energy independence, anything around AI dominance is going to be a really, really good sector to continue to focus on and to continue to benefit from those tailwinds. You look at healthcare, I think anything that's designed towards improving the ability to go to market faster with new drugs, with new products, is what we're going to focus on.
Are we worried about private equity at all?
Not so much. I mean, I think that private equity has been on the sidelines in the AI trade for a long time. It's not really in their wheelhouse here. I think what we're really seeing, and this is very interesting to me, I've seen it over the past year, is a lot of family offices are really entering the space in terms of direct investment. And they might have missed the boat on something like an Anthropic or OpenAI, and they want to get their own AI exposure into their portfolio.
Right. Well, it sounds like you still think, the economy is poised to grow, AI will continue to be a driving force. Thank you so much, Juan Moreno. Thank you. Great to see you in person. Thanks so much. All right, so there you have it. And coming up next, we're going to be taking a look at some of the details from the Charles Schwab Stacks report. All the details on what people are buying and selling, the sentiment. We'll be right back with all the details at Joe Mazzola.
SPY's about to break to 63 again. Same as the SPX, but it ain't got much higher to go. 68.41.95, $5. If it breaks, it's an ascending triangle with a double top.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings, breakdowns, and trade-ready insights. Follow me on X@_Barnabas and connect with me on LinkedIn or Instagram for more.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, CBOE, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to Watch List. It's time for Charles Schwab Stacks Report. It's a proprietary wealth of information, and joining me to go through this, Joe Mazzola, head trading and derivative strategist at Charles Schwab. To come through this, I did see that we had it increased to an 8-month high ever so slightly, but we'll take it. What do you think?
Hey, Nicole, how are you? Thanks for having me. Well, here's what I think. I think that, clients use the opportunity beginning of the month, middle of the month of November to scoop up some, what they looked at as some value. It's, whether it was NVIDIA, Palantir, Meta, those stocks pulled back around 20%. during the course of the month, from their recent highs. And those were the three that they really gravitated towards. I think one of the big differences in this month that we hadn't seen in some of the prior months was just this real affinity towards IT outside of just the AI. Right? Traditionally, we talk about NVIDIA being the top of the list, and here being the top of the list, and we realize that those are IT names, but what you tend to see is that the IT sector as a whole isn't bought to the same degree that it was in November. There was only two, Nicole, only two of the 11 sectors actually had net buys, and they were discretionaries and they were IT. And when you look at the discretionaries, it was Amazon, it was Tesla, and since they represent such a large footprint within that sector, it skewed towards the net buys there. But yeah, it wasn't the same type of broadening that you saw in the overall market. It wasn't, you didn't have the sector leadership of like the healthcare, financials that you saw in the overall market in terms of the stacks. It was really kind of concentrated. But it was a pretty decent move considering it was up about, just under 1.5% was the stacks. But the overall market was only up about 0.2, 0.15, 0.2% for that month. So it was, it was another consecutive month of more buying in the stacks on a percentage basis than you saw in the S&P 500.
University of Michigan came in, that was slightly better. You did see some appetite here for some Mag 7 names. I saw that you had the heaviest buying for names like NVIDIA and Tesla and Meta and Amazon, right?
Yeah. Like I said, the one thing they all have in common is this idea of buying the dip. These were stocks that pulled back, and if you look at the ones that were sold, I mean, look, Apple, Broadcom, Lilly, I mean, those stocks ripped. Rivian was the first time on the net sell list. So you had a stock like Lilly, just think about that, went from like 850 up to around 1100 or so. I think the RSI on that stock got up to about an 86, and as opposed to chasing clients trending into that strength. I think that's smart. I think they're doing the right thing. I think they're looking for opportunities when they get the pullbacks in the market to scoop up some of those shares. I think, to be honest with you, they're probably stepping their toes into the water maybe a little bit more than the institutions have, because if you look back at November in terms of what we saw on the institutional side, it was a different story. It was a story of hedging. It was a story of reducing risk. And they probably missed some of that movement that we saw that post-November 21st rally.
I thought it was interesting, Gen X, the no cell phone, dance on the speakers generation, was a little more aggressive. Traders were a little more aggressive than, say, other groups like Gen Z, for example.
Gen X, but I can't say that I dance on speakers, Nicole. I don't know if anyone wants to see me up there dancing on the speakers, but yeah, Gen X, a couple things. So not only did Gen X show a little bit more of a bullish sentiment, quite a bit more actually, than say Gen Z. I think you can make a case that there might be some of that K-shaped distribution that we've talked about for so long, just in terms of the wealth effect, right? I mean, people look for opportunities when they have that additional wealth and they see the dips, they see the opportunities to buy, they're going to do that. But if your finances are stretched a bit, maybe saving for a home or a car or something like that, when you're in a generation where you haven't had an opportunity to save as much, even if there's a dip in the market, you're not really looking at that as maybe to the same level of extent as a buying opportunity. So I think that was probably some of it. The other thing I noticed too was the traders versus investors. Traders were, we talk about the two hands, right? The traders were buying with two hands. They were looking at this as a great opportunity, whereas investors were a little bit more cautious actually, and that the spread between the two was probably the highest that we've seen all year.
And I guess people are concerned. I saw notes, people are concerned about an AI bubble. Sometimes people go to ETFs or mutual funds or fixed income funds to sort of hedge, or they get more of a basket rather than picking one name. I saw they were going to influence that word positive into the ETFs, mutual funds, fixed income, and international new addition to the stacks reporting. What did folks step away from?
Well, I can talk about this. Apple, Broadcom, Lilly, those were three, Rivian. And then any sector that wasn't IT or discretionary related. I will say this. Even if you look at the activity that we saw in November, some of that is carried forward already into week one of last week. If you look at overall fund flows in the market, the overall fund flows for equities is basically the highest that it's been all year, 1 week into it. right? So yes, we got 3 more weeks for, there could be some net outflows, of course, as well, too. But just to kind of see that on that 1 week basis, we were looking at equity inflows for the industry as a whole that were comparable to the entire month of October and November, just in the 1 week. So that enthusiasm's carried forward. Now, if I were to look at this in terms of percentiles and say, because I make a statement like that, I get it. The viewers are saying, well, wait a minute, this is screaming FOMO. I don't see it as FOMO just yet. Now, when I look at this report, the one we just published, it puts us in about the 65th, 66th percentile. So that still means that there's been about a third of the time where there's been more net buying than what we saw in this latest report, and we're still not even close to the levels that we saw in 2021. So yeah, we're moving with a really bullish sentiment as a bit of a tailwind to us, but I don't think we're to that area where we're kind of our heads are in the clouds and it's a little bit the air is a little too thin up here.
It was interesting because we were above the 50-day moving averages, 50-day moving average for what, like 136 days or something that we broke down, but now we're back. Is there follow through? Look at market breadth. What is important here when we look at some of the technicals?
I think in order for the bulls to feel comfortable with the case, they're going to have to challenge that all-time high again. We got close last week. I mean, the bottom line's about 1% away. It's not a big deal, but here's the thing. When I look at the sector rotations that we're seeing right now, I mentioned this a little bit earlier. It's healthcare, it's financials, it's industrials. Those are great for cyclical stocks, but I don't know if those are the generals that you want leading the charge to push it all-time highs. We got to see a little bit more of overall buying, just not stacks buying, with some of the consumer discretionary, communication services, and IT. I think if we can get those moving back in the right direction and improve breadth, because last week breadth was okay. It was basically even advancing decliners. But if we want to get back to the level where we're pushing all-time highs, I think you need those 3 sectors to be the generals.
Look, we're getting into some delayed reports, CPI, PPI, the jobs will come after on the 16th from the Fed. What about here until the end of the year?
Excuse me.
End of the year.
Yeah, here's the thing. I mean, the data is delayed, so you're going to have to take it with a grain of salt. I mean, the big announcement this week is the Fed announcement. The CPI, PPI, as you mentioned, that's October data. So, we still get things that you should be paying attention to on a weekly basis. ADP now, jobless claims is called back up. So I've been looking at jobless claims probably a little bit more than non-farm payrolls, just because it is more of a more recent number, especially kind of given what we've seen with the government delays. We're getting ISM data that gives us a little bit more of a snapshot. So that's the stuff I'll be paying attention to. Oh, and don't forget, Nicole, we still got a couple big earnings, and I realize we're at the end of our earnings season, but Oracle's really important to tell the story whether or not the AI spend, whether it's circular or whether there's actually an opportunity there. We went from paying cash for everything to now financing things, and Oracle was one of the first companies to do that. So that's going to be a big question you're going to hear at their investor report and with their earnings report. And the other thing is you got Broadcom coming out at the end of the week. Given the move that's had, that you want to see if you're a bull of that company, you want to see that pushing towards all-time highs.
Yeah, we'll hear from Oracle on Wednesday, as well as Adobe and then Broadcom on Thursday. As I watch the 10-year bond yield here at 4.17, every time I look up, I sort of cringe because it keeps going up one bit. So when I say 4.17, I was like, oh geez, is it a 4.18 now? You know what I mean? It's just been creeping higher in that way, so I have to double check. But everybody's looking at the credit spreads very carefully. They're looking at private credit. They were worried about maybe some sort of crisis or credit crunch. That hasn't happened. What's the big picture? And, well, we don't know, right? So what do you think? What do you think here?
Here's what I think. I think that we've seen, even though we're at the top of the range for yields, the big move down kind of already occurred. We had that
13 more minutes left.
4%, 4.2%. We basically been in that range now for 4 months. As long as it stays contained within that range, what happens is when that bond volatility.
Just a weird day. I can't quite figure it out.
So, at this point right now, I think everybody's kind of sitting there waiting to see what the Fed has to
It's
say.
like a
whether it's
whole,
hawkish cut or
it's
not.
like a
And
roller coaster ride.
I do want to run real quick plug, if I can, Nicole. Our market outlook on Thursday, you're going to hear from much better, smarter people than I when it comes to fixed income when Kathy and Colin are on at 7
I mean, this is
Eastern.
really a
I'll
rough
be there
day.
with
It's,
Lisanne and
for
Michelle.
me, in a way.
Yes, December 11th, we are going to have that market outlook, and you know, looking forward to that. It's after the bell, as you said.
It's like
7
this
p.m.
slash ES. I'm right to the penny on my final support.
Hayden will be hosting from Chicago, so really looking forward to hear everybody's thoughts. So I'm glad you mentioned December 11th.
Tesla the same way. I was 14 cents off Tesla
Head trading and derivative strategist Charles Schwab.
from when I charted it out this morning.
And of course, it's Fed Day on Wednesday, so we'll have a special.
That's a pretty good sized dip.
At 2 p.m. Eastern time, and then we'll hear from Jay Powell at 2:30. We'll hear what he says, what the language is. In the meantime,
Plus what it was up, it was at 58, I think, or something like
the
that.
airlines are seeing folks looking for traveling. In fact, 2 in 3 Americans are planning to travel during the holiday season. That's a 14% increase. Our panel is ready.
But back in the day, if Tesla dipped 6 or 7%, it'd be a strong buy if it happened in one day. And I'd buy it up at a 6 or 7% pullback, and it'd always run back up. I mean, almost always.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets.
But that's when the stock was at $600 or $700
I bring you real-time sentiment from traders
up to
driving the action.
$1,200
We break
a
down the
share.
data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
But I don't think I want to swing this right
Market
now.
on close,
I kind of do,
live
but I kind
weekdays,
of don't.
3
I'm going to
p.m.
wait.
Eastern, only on Schwab.
Because if he gets down to 425, and then I got that 400, just right above 400 for a long buy.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets.
NVIDIA had that good
All with
news, and it
24-hour
pulled
support
back
from trading specialists
pretty
who
strong.
understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETF,
Like on a day like today, when I get ready to retire, I won't even trade. I just take the day off and go out and do something.
market insights, live support, powerful
I'm going to try to
platforms,
have a system where I come in here for the first couple hours, and then if it ain't looking, if I don't feel good about the day, I'll just take the rest of the day off.
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time.
And trade from an iPad or
Stream
something.
Schwab Network at schwabnetwork.com.
Looks like we got a nice little support here. 1, 2, 3. Falling wedge, and it's about ready to break that wedge. Slash ES.
And I know that we have demand.
I mean, it went right to the penny
Senior aviation reporter at Point Sky and Magna.
on that support level that I did on the hour. I think it was the hour.
Sean, I was grabbed by that stat where you
Might
said
have
there's
been
a
the
14%
5-minute.
increase year over year. Get more into this. We want to hear more about the demand for traveling this
It
season.
wasn't 5-minute.
Hey, you know, one of the things that we've seen over and over again here in 2025 is that we hear from travelers that are a little concerned, whether it's the some of the macroeconomic concerns, uncertainty earlier this year, or obviously some of the chaos that we saw hit the air travel industry during the government shutdown in November.
It was the hour, definitely on the hour, right off the 200. And that's a great support. It's one of my favorites for reversals.
The busiest day ever at
Tempting to swing it, even, just give it a shot.
I expect as we get into the holidays, it's going to be more of the same. You won't have any one day over Christmas
For tomorrow, because today's like one of them days where it just
kind of a prolonged busy period.
real hard to sell off to where it usually has a bounce the next day.
Are they trying to get bargains? But I mean, we know holiday travel has been busy.
And I'm serious about that. I'll come in tomorrow and watch the market be up.
I think prices are definitely a concern. I think especially the. Oh, I'm there. Did it cut
We're
out?
off the 63. Last time we hit the 63, it bounced up pretty nice. We got a double bottom right now.
I think as we go through that is
Sean, I just want to, I'm going to make sure.
These things are no good.
When we look at what's going
But
on
I didn't buy a lot of them.
When you think about which airlines could benefit,
I bought a lot when it was at 75 cents, and I sold it for 185, and that brought me above even. Now I'm back in the red.
Seen Delta and United turn in, some of the strongest earnings of any U.S. airline. I think there's a growing sense of optimism across the industry, though, here in recent months. This past summer, we heard a lot of
tweezer bottom
complain about kind of
with a
almost too
tweezer
many
wick
flights in the
bottom
marketplace, too much capacity,
and a
which
tweezer
was
body
driving down
bottom
fares.
on
We
the
saw
1 hour
a number
off
of
the
airlines late in
63.
the summer, as we got into August and September, take steps to pull capacity out, so cutting frequencies, pulling back on some of the seats that are out there, and I think that's led to some more pricing power for airlines. Of course, for consumers, it's a little bit less welcome of a change, and I think they may not be in quite as much, quite in the driver's seat quite as much as they may have been over the summer. That said, it's certainly here at the Points Guy, we always recommend, taking a look at, if
In the
you
daily,
wanna
we're
pay that
just
cash
above
fare,
the
see
9.
What award deals are out there. Of course, as we get into the holidays, the award pricing can go up.
And
So, it's something to consider as we head into the holidays.
I also thought it was interesting the breakdown of who will be traveling. When you said nearly 2 in 3 Americans, you had about 65% that were planning to travel from the holiday season, Thanksgiving through the New Year was a 14% increase.
Well, that'd be a hell of a sell-off.
51% who said this last
Be a couple $100 down
versus
if it continues. If not, it holds the 9 and we'll stay bullish.
Here, you have that millennials, 34%, Gen Z, 34%, are more likely than Gen X and baby boomers.
The only time we've held 9 was a couple times back here.
I mean, we're still seeing demand, but people are just being particular.
Yeah, and we certainly are seeing demand kind of across every
Held it
demographic,
there, but that was after a
certainly,
dip.
I think you've seen with the millennial and Gen Z sectors, kind of this. We hear airlines, we hear hotel companies talk about it, kind of the realigning of priorities. Saying I'm going to prioritize experiences, travel specifically over kind of material things. Whether it's a Christmas gift, giving someone a gift of travel, so to speak. Versus that hot ticket electronic item. I think it's just, time and time again, we were talking about revenge travel when we came out of the pandemic. We're well past that now, and yet we continue to set records at airports. I think it's just, something that's kind of here to stay in terms of, people want to get out there, they want to travel internationally, and, I don't think we're going to see that wane anytime soon.
And that's a support there, too, for the last week and a half, 8 days.
TSA lines. We have top destinations. We talk about who's
Where we stopped today.
Megna, I want to hear more about your thoughts, some of your talking points that you have in your mind. I want to hear more what's on your holiday agenda here for the big picture.
Yeah, I think sort of like similar to what Sean has said, big picture, I think it'll be a lot of the same themes that we've been seeing in the past couple of years. I'm pretty sure like this holiday season again will be another very busy one. It seems as if each holiday season has been becoming busier each year. I think one of the big things though is that travel patterns have also been changing a little bit over time. Right now in the fourth quarter, leisure travel has been taking off a little bit more. I think people are starting to plan their vacations more so for the end of the year. Maybe they want to go to Europe and they don't want to deal with the extremely hot weather or the crowds. So the end of the year is becoming a very popular time for leisure travel, and I bet we can expect to see more of that this holiday season as well. And I think also just going off some of the previous talking points, I think demand is just generally going to be very high. And again, I think airlines are, investing a lot more in premium, and I think we can expect to see more of that doing well, as a lot of airline CEOs said last week at an investor conference.
Well, I also saw in your notes, Sean, that you talked about Fort Lauderdale and Hawaii and Florida, Texas, and Dominican Republic, Jamaica, Brazil. I mean, there's a lot of hot spots. Thank you both, Sean Cuddy and Megna Maharishi. Thank you both. That's going to do it for us here on the Watch List. I'm Nicole Petty. Market closes next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
We have 2 minutes to Power Hour.
My point is that they're getting a higher rate of change in sales based on the guidance.
I think I'm going to give it a shot here in the close. We have 3 black crows with a double top right into Power Hour. We got a yin yang support.
I think one of the most important things is you're making a play in a risk-defined way. You're going into earnings.
I've had 3 bad trades today. I don't know. It's unusual for me to have 3 bad trades. You know what I'm saying? I don't get 3 bad trades in one day. Just doesn't happen.
2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on
We broke below support there.
2026 Market Outlook, your guide to the forces shaping stocks, global markets, inflation, rates, and more. Hear
We got
from
a big
experts
wall
on where
right
the
here.
markets may be headed, spot opportunities, and see what could drive your
We got
portfolio
an
next.
inverted hammer,
Tune in
which
on
is
December
bullish
11th at 7
after the
p.m.
crow,
on Schwab Network.
and a tweezer bottom.
I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at Schwab.
Look at the SPY for tomorrow. I might go in small on the SPY for tomorrow. $680 strike or a 682. Grab one contract.
Good afternoon. It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Caden, coming to you live from our Chicago headquarters.
And I'm Sam Vardis, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what is coming up on today's show. Garrett Soloway joins us to look at key levels to watch on the S&P 500, gold and Bitcoin. The CEO of Citrotech joins us to discuss the company's recent uplisting and its wildfire prevention technologies. Plus, we'll examine the latest import and export data out of China and what it means for the global economy. But for now, Marley, take us through what you're watching today.
Well, Sam, we thought the Warner Brothers Discovery story had reached somewhat of a conclusion when the company announced Netflix would be acquiring its streaming and studio assets. But another twist emerged today. Paramount's Skydance is launching a hostile bid to take over the full company. The media giant says it will go straight to shareholders with a $30 per share offer that the WBD board just rejected last week. We'll break down the latest coming up. Broadcom also one of the winners on the day, while Marvell is one of the losers on reports that Microsoft is in talks with Broadcom to design future custom AI chips, a move that could take business away and a key customer from Marvell. And Apple seeing a couple of bullish price target heights today on iPhone sales expectations ahead of the holiday season, and a call that 2026 will be the year that Apple finally enters the AI race. We'll tell you who makes
Marley,
decisions in just
202.
Let's take a look at where the markets stand as we near the end of the trading day here. The S&P is still trading down about 0.5%. They're at 68.3577. The Nasdaq also down about
Market's come back a little bit.
561 right now. The Dow trading down closer to 0.6 at 47,678. We're down about 276 points on the Dow. But the Russell 2000 holding on to its green, not by much though, only up about 0.1% at 25.2367. Taking a look at some of our futures products, though, seeing how they're shaping up. The dollar mostly unchanged, 99.04 today. Gold is trading down more than 0.6% at 42.1640 a troy ounce. Crude oil down 2%, a little over 2% at 58.79 a barrel. And Bitcoin maintaining its ability to stay above that $90,000 threshold, up about 1% today at 90,430. Now, Sam, I'd love to know what stories caught your eye on the floor of the NYSE today. We had no shortage of headlines.
No, it was a very busy day, suffice to say there, Molly. I did see Nvidia shares actually ticking higher after reports that the US Department of Commerce will soon allow the export of the company's H200s to China. Now, Semaphore saying the chip is about 18 months behind Nvidia's most advanced offerings, but it's a way to find some middle ground between those who oppose exports and those who worry about the restrictions. But according to the Asia Times, Chinese commentators warn the offer could amount to, quote, sugar-coated bullets that would slow growth in AI. Now, IBM, meanwhile, striking a deal to buy data streaming platform Confluent for $11 billion. This will be to deliver an end-to-end data platform.
Well, they're really sour about AI now all of a sudden.
Applications and AI agents. The transaction is expected to add to adjusted.
I mean, they pumped AI every single day. And then NVIDIA's earnings were killer last time. I mean, huge. All the earnings have been killer on these things. I just think they missed the boat. I really do. I think a lot of these fat cats missed the boat. It's hard to listen to these people anymore. Okay, we're flagging out again. I'm looking at the 68.40s for right now, or to the 68.35s if we pull back. Oh God, I can't afford 10 of them. If we get down to 150, I'll get 5. We're pulling back right here. See, I didn't want to jump in right there. Now here's the trend line. This is the right shoulder. I'm taking this at my risk. Right to the yin yang. At 175. Right now we're under a wall. I gotta hold this support or it'll drop quite a bit. That'll be my force field right there. So I got the SPX 6840s at 175. Looks like a Darvis box. And it could be an ascending triangle. Or 215. $230. Now we're about halfway through that box. Above the 63. Break it. That'll run me up to the 200. At 250. There's a couple trades today that I could have got out and made money on them, but not a lot, but still yet. There's like this one right now. the 260. Now it's back to 215. Just on a little bitty candle. If we stay above this here trend line in that little foggy area right there, a little bit more and I'll be even for the day. I got two this here's a inverted hammer. That don't look too good. But now I got two of them. See what happens when you get inverted hammers? If I can bring that up, there you go. Yeah, still red. Not what I wanted to see. Now I got two of them. This is almost like a doji right here. And we got 3:14 Eastern time, so it's getting that time for volatility. And these candles come in strong when they go to selling off. There we go. Boom! Right now. I should get out right now. I'm up 500 some bucks. We just hit my resistance level. 310. Out. I'll take that. Yay! So we hit the 200 and Jimmy got out with that triple top. I think I should stop for the rest of the day. I'm green again. Not by much. I've had a rough day. I've had 3 real bad trades. That time I was smart and I got out because back up. back up and right back down. Oh, I just now noticed it. I put that little, maybe I was waiting for the second dip. Yeah, that's what I was waiting for. If that's a Head and Shoulders. That's a good call. I had the nerve to jump in it way too early, too. I mean, are we going to have a big breakout here at the end of the day? President Trump, we will end up putting severe tariffs on fertilizer from Canada if we have to. Trump, U.S. will take a small portion of the tariff revenue to give to the farmers. We will provide $12 billion in aid to the farmers. That won't hit. That won't hit the media. They won't report that. Millionaire YouTuber Hank Green warns Gen Z about NVIDIA exposure. Outlines portfolio shift to protect against AI bubble risk. Okay, here comes the volatility. We're at 180 again. If we get back down here, I'll jump back in it. And I'll go small because then we could have the breakout. But man, today's been a hard day to call. Usually I can just run right with it, but today, I don't know. It's just something about it. If it goes back down here, I'll jump back in. Especially in here. This would have made $625. Okay, get ready. I'm going to grab 3. I'm going to do the same calls. Prepare ye in the name of the Lord. $68.40s. Okay. Right about now. If I don't get in now, it might not touch that trend line. $130. It might just pop right up, right back up. There's 135, 130. Okay, now we're talking. Right here. $125. There. Bam. We're right on that trend line. Oh, shit. Well, let's go. 105, 110. I got 6. 3 at 125 and 3 at 110. This is what I've been waiting for. Let's see. 140. Oh, I got a screw in my shoe. Jeez. Oh, hope that ain't a problem. I've never had a shoe in my screw. God. How big's the... Oh, yeah, I got plenty of... Didn't go through it. That had to happen today. $140. There's 158. In the bottom of my shoe. $175. Now I should go ahead and sell them here. I got 6 of them. But if we get up to the top, this could be a $2, $2.50. $195. Yay. Come on, give me a little bit more. 205, 210. Thank you very much. I'll take it on a day like today. Now that did put me in the green. And watch it go to 5. Oh, yeah. Back to 150. I'm done. I ain't ruined this. I'm green. It's been not a good day for me. Tomorrow will be great. That's the way it works. As long as I got out green today, tomorrow will be like sixfold. You watch. I only see like maybe 5 or 6 of these kind of days a year. And this is the first one, I think this year I've had 3 bad trades. There's 205 again, right to the 200. We're definitely at resistance. If this thing breaks, it'll fly. If it doesn't, that's your exit idea. Now they're only 145. At the resistance. Three white soldiers. We got 7 minutes left. Less than 7. So time accordingly if you're still in it. Not wanting to move. We got right to the 200 SMA and EMA. Hope no one got stuck in it. I'm going to get out of here early today. When the bell rings. So I more or less gave my summary. Today was probably one of the toughest days that I've traded. It was kind of behaving at the end of the day a little bit. But supports were failing and resistance weren't breaking. And somebody was getting paid off, M&Ms, market makers. And all I could read is negativity on the headlines and AI bubble and investing in other countries. That don't work. I'll tell you that. I've been here 20 some years. And they've said that over and over and over and over again, and it's never worked. A lot of these other socialist countries are down big in a way. So it might work a little bit, but I remember when I first started, I can't remember that guy. I mean, he had a real big reputation of, and he took all of his money and threw it in during the Obama crash. And we bounced back big, and he got delisted. I mean, they took him, got fired. He owed billions of money to people. But he was going to invest in Europe. And I've never been a globalist. I mean, some of these companies are global. I mean, they're definitely worldwide, but they have to be American before I'd invest in them. Now, oil's down big, so, you know, Wall Street hates that. I don't know why, but I'll never forget, never understand that. I never was good at trading oil. I never really took time. I traded Oxy for a bit. There we go. What are these things at now? 90 a buck. I didn't see how much it got down to. 75 cents? 25? Look at that. Darn, $3. You might get your $4 here. Look at that guy, options trader. Woo! Look at you. Look at you. Trader of the day. Trader of the day. Come on. Woo! Well, today was definitely a tough day, and I apologize for not having the perfect calls. It's hard. You know how much I'd have had there if I'd have held them instead of getting out at 210. 400 times 6, I'd have had $2,400 more dollars. And that would have really put me in. That's what I said earlier today. I said it's going to be one of them days where you just wait till the end of the day and make all your money back if you still have any. But yeah, it was for a Monday, it was pretty pathetic. The Monday flush, I guess. Well, I got to get out of here. I got to get paper towels, drop some paperwork off to my accountant. What's this important tax notice? Yeah, contribution rate. I should be getting my, got to go to the bank, got to drop off a blower. So I'm going to get out of here. Got to be careful on days like today. I got stuck 3 different times, and it, you know, it's pretty depressing. Hawk 2. She's a good looking chick. She really screwed up. For being a dingbat. She could have been multi-millionaire, or probably is, but she could have been filthy rich. The Hawk 2 girl. Well, okay, I'm going to be out of here. We'll catch you all later.